The Federal Reserve System works every day to support a growing and stable U.S. economy. Across the United States, the Federal Reserve, through its Federal Reserve Education Program, also helps people understand how the economy works, so consumers have the tools to make sound financial decisions. Through this education program, teachers have access to classroom-ready online resources for students from kindergarten to college, videos, classroom lessons, online education, publications, and more. These resources are all free for educators to use in their lesson plans, or as they see fit. Many of the Federal Reserve System's regional reserve banks, located in 12 districts across the nation, also offer in-person and online professional development that allows educators to deepen their knowledge and hone their craft when it comes to economics, personal finance, and more. Students, too, can take advantage of in-person opportunities by taking tours of exhibits in many of the 12 Federal Reserve banks around the country. Whether a student visits with their family or a school group, they get an in-depth look at how the Federal Reserve works to promote a healthy, sustainable U.S. economy. At the Board and Reserve Banks, students also get hands-on opportunities like internships and participation on student boards, which introduce them to key economics concepts and potential careers in economics and finance. Consumers are empowered to make sound financial decisions through the availability of easy-to-understand resources that explain personal finance concepts, the broader economy, and the Federal Reserve's role in it. Federal Reserve Education is committed to equipping educators, educating students, and empowering consumers when it comes to understanding and participating in our evolving economy. For more information, visit federalreserveeducation.org to find links to resources and Reserve Bank programs offered near you, and follow Federal Reserve Education on Twitter at @FedEconEd.
Hi, I'm Ian, and I work for the Federal Reserve, the central bank of the United States. The Federal Reserve System consists of three main entities that perform key functions that serve the public and promote the health of our economy and the stability of our financial system. These key entities are the Federal Reserve Board of Governors, 12 Federal Reserve banks operating around our nation, and the Federal Open Market Committee. Based in Washington, D.C., the Board of Governors is the governing body of the Federal Reserve System. It's an agency of the federal government that reports to and is directly accountable to Congress. The board consists of 7 members, or governors, who are nominated by the President of the United States and confirmed by the Senate. Governors are appointed for 14-year terms. The Board of Governors oversees and sets policy direction for the system, including 12 Federal Reserve banks located around the country, which take the pulse of the nation's economic health from a regional perspective. The 12 reserve banks represent different geographic regions, or districts, and were set up based on regional economic considerations. Although supervised by the Federal Reserve Board, the reserve banks operate independently in many respects. The reserve banks carry out a number of core system functions, such as supervising and examining commercial banks and other financial institutions, enforcing compliance with federal consumer protection and fair lending laws, while promoting local community development and lending to depository institutions to ensure crucial liquidity in the financial system. They and the board also play a key role in another primary Fed function, fostering the safety and efficiency of our nation's payment systems, including distributing currency and coin to banks, operating electronic payment systems, and clearing our checks. In addition, the reserve banks act as the government's bank, providing services such as maintaining the Treasury Department's transaction account and issuing and redeeming U.S. government securities. They also act as a bank for banks by providing key financial services to banks, thrifts, and credit unions. The reserve banks also provide a wealth of information on conditions across the nation, information that is vital to formulating a national monetary policy that helps maintain a healthy U.S. economy and a stable financial system. The board and the reserve banks together help ensure that consumer and community voices are heard at the central bank through consumer-focused outreach, research, and analysis. This helps keep the Federal Reserve's actions, policies, and decision-making attuned to what's going on in American households, communities, and businesses, which are the foundation of our economy. The third key Fed entity is the Federal Open Market Committee, or FOMC, which brings together representatives from the board and the reserve banks to consider the state of the U.S. economy and set a course for our monetary policy in a manner that seeks to promote an economy that works for all Americans. The 12-member FOMC establishes an appropriate position or stance for monetary policy to help move the economy towards two essential mandates set for the Fed by Congress, promoting maximum employment and price stability. This occurs mainly through the FOMC's influence on interest rates and credit conditions, which can significantly impact financial conditions, including economic productivity and even spending and investment decisions by households, communities, and businesses. Working together, these three key Fed entities and the unique Federal Reserve System structure established by Congress more than a century ago help promote conditions resulting in a strong, healthy, and sustainable economy. For more information on how the Fed functions, visit federalreserve.gov and click on About the Fed.
Okay, so welcome to the second day of the conference. The first session is going to be on the transmission of monetary policy. It's gonna have three papers with a coffee break after the first. So the first paper is presented by Luminita Stevens from Maryland. It's going to be on price rigidities, and the discussant is going to be Anton Nakov.
Well, first of all, thank you very much for inviting me to present at this conference. It's a real pleasure to be here. I will be presenting price rigidities in U.S. business cycles, which is joint work with Camilo Morales Jimenez from the board. And these are our views, don't represent the board or anybody in the Federal Reserve System. So the goal of this paper is to try to understand the severity of nominal pricing frictions and the extent to which these vary over time. Surprisingly, we don't have a structural estimation of these rigidities in the literature. So what we're going to do in this paper is provide such a structurally estimated time series of the degree of nominal rigidities in the US data from 1978 to 2023. To do so, we're going to build a general equilibrium model with flexibly specified pricing frictions. I'm going to spend some time telling you what I mean by flexible, but it'll nest Calvo, menu costs, noisy information pricing models, and then let the data speak to what exactly the friction is that's most relevant. And the way we're going to do the Bayesian estimation is by adding information about the dynamics of the distribution of price changes over time. So we're going to add moments from the distribution of price changes in the US CPI. And we're going to use how these moments change over time to estimate how the severity of nominal frictions changes over time. And the use of this distributional data is new in the context of inflation and micro pricing models, but it's similar to the ideas that have been used in Hank models recently that have used moments from the distribution of household income or household wealth to try to inform aggregate models. In each period, what I'm going to show you is the impulse response function, the cumulative impulse response function of consumption in response to a 25 basis points monetary policy shock. And I'm going to show you what that response would have been in each period from 78 to 2023, given the pricing frictions that we estimate for each of those periods. Okay. And then along the way, I'm going to show you that we're going to reassess some aspects of the conventional wisdom on price rigidity. Okay, what is the conventional wisdom? So if you think about models that try to match the micro data on price setting, they find that in order to match the rigidity that we see in the price data, you need to assume, and they typically assume, that the timing of price changes is rigid, and prices get to be reoptimized either randomly, a la Calvo, or depending on the value of adjusting, as in the menu cost model. Importantly, in virtually all of these models, with some notable exceptions, once the firm gets to reprice, the new price or price path that it chooses is the deterministic optimal price based on full information about the state of the economy. Now, this optimal repricing is at odds with overwhelming evidence that has been documented across many contexts that decisions conditional on adjustment are dispersed, and they're only noisily tied to optimal actions. And this comes to us from neuroscience and cognitive psychology evidence, kind of like really at the micro level, on studies of perception, numerosity, probability estimation, closer to us. People systematically report actions with noise. And it also comes in economics from the game theory experimental literature, survey data, forecasting experiments, and so on. So what we're going to do is we're going to build a model of errors in pricing generically, and we're going to allow for errors in both the timing of price changes and the chosen price level conditional on adjustment. We're going to endogenize this imprecision along both dimensions with information costs. I'm going to talk to you a little bit about rational inattention. That gives us a way to endogenize the stochasticity. And in the model, infrequent adjustment will arise due to menu costs. But more importantly, as you will see, this rigidity in prices is going to be amplified by the information costs. And as I mentioned, microdata is going to discipline the frictions. Okay, so in the paper, there's a model. We draw out implications for non-neutrality and for inflation dynamics, and then we do the estimation in the data. We're building on a huge literature, so starting from the kind of first-generation menu cost model, Golosov and Lucas, Gertler, Leahy, going on to generalized hazards, Caballero and Engel, and to the more recent infrequent adjustment literature that has sought to discipline models using microdata. We're also bringing in models on imperfect information, such as Woodford's imperfect common knowledge framework, so starting from there and all the rational inattention papers by Maćkowiak and Wiederholt, and Anton's work on control costs. Okay, so what is the basic economy? It's going to be very standard, plain vanilla model, standard consumers, competitive intermediate input, producers. We're going to put the information friction on retailers, the pricing friction generically on retailers. Demand is standard with an elasticity epsilon. Technology features productivity that has an idiosyncratic component and an aggregate component. Operating profits pi are going to be just sales net of the intermediate input cost. And now the firm's problem is going to figure out how to acquire information and how to set prices to maximize its discounted profit stream, which consists of, where M is the discount factor, consists of its flow operating profit in each period, minus the cost of monitoring market conditions to figure out whether or not it should adjust its price in the period. Then if it decides to adjust, that means this delta indicator is equal to 1, it has to figure out what the new price to set should be. That's this cost C upper script P. And then it has to pay the menu cost, right? The traditional menu cost would have CA0. You know perfectly whether or not you should adjust for free. And it would also have CP0. You know perfectly what price to set, right? P star. So you would only pay the cap on menu cost, right? Okay, how do we model information acquisition? How do we model this cost of figuring out whether or not you should change your price, and then conditional on deciding you warrant a price change, what price to set? We're going to use rational inattention, a la Sims, and more precisely, a la Woodford 2009. And the idea is that we want to model firms who understand very well their environment. They understand the preferences of consumers. They understand their technologies, the market structure, everything. But they just don't have real-time knowledge of the realized states for free. They can acquire this information. Information is abundant, right? In fact, they could acquire perfect information if they so choose to, but it's costly to do that. Information is hard to process and hard to incorporate in decisions. Acquiring information formally amounts to choosing how much your decisions are going to condition on the state of the economy in real time. And how much they condition on the state is going to be measured relative to actions that are drawn from a default, from a reference distribution that the firm has for free prior to acquiring any information. We're going to come back to this, but the cost of information is going to be measured relative to this default, this free default. Okay, so if you think about the decision of whether or not to adjust in our model, the firm is going to decide what is the probability lambda of adjusting, given that my price entering the period, my real price entering the period after all the shocks have been realized is some p tilde, given that my idiosyncratic state, marked here by idiosyncratic marginal cost, is little a, and given that the aggregate state is summarized in this big gamma variable. Okay. And then the cost of making your decision be contingent on your price, the idiosyncratic, and the aggregate shock is going to be measured, state, sorry, is going to be measured relative to some reference probability lambda bar. Okay. This choosing to adjust according to lambda versus lambda bar entails some information cost, CA, that is proportional with a constant of proportionality theta A, proportional to the average distance between the conditional lambda probability and the unconditional lambda bar. Okay, so our agent is going to be choosing lambda, and you can think of an agent that is setting prices according to Calvo as setting prices according to a constant probability lambda bar. They're not acquiring any information. They're not choosing the adjustment decision based on anything about their current price or the idiosyncratic or aggregate state. They're just choosing to update with a constant probability. The menu cost model would have a lambda that is bang bang, right? With probability 0, you adjust if the value is not enough to cover the menu cost, if it's not worth it. And with probability 1, you adjust if the value of adjustment exceeds, the net value of adjustment exceeds the menu cost, right? What we're going to do is we're going to model this lambda to be, and it's going to end up being a continuous function between 0 and 1, right? Rather than constant as Calvo or bang bang 0, 1 as in the menu cost model, okay? And that continuous function is going to be the result of using this cost of information. Well, again, what is the cost of information? It's going to be linear in how far the conditional distribution is from the unconditional, how far lambda is from lambda bar, where this distance measure is given by the Kullback-Leiber divergence. Here's the expression over here, but basically what this says is how wrong would I be if I use the probability Q when the true distribution was probability P. So this is giving you a measure of how much conditioning on the state in a particular state deviates from a constant frequency. The more you want to deviate from the constant, the more information you're acquiring, and so the bigger the cost. The second decision is the decision of figuring out of what price to actually charge. Suppose you've decided, or you've gotten information that warrants changing your price. Now you have to figure out what price to charge. You have a reference distribution, F bar, that we're going to talk about it in a minute, and you have to decide how much you want to deviate in your pricing decision from this default distribution of prices that you could draw from. The more you want your price in the current state, so your price is conditioning on your idiosyncratic state and the aggregate state, the more you want your price to condition on that state, that is, the higher you want the probability of a certain price to be in a certain state, the bigger the cost of acquiring information is going to be. Okay, so the firm is going to choose, rather than choosing a deterministic P star that maximizes the value of the firm, it's going to choose a probability in which the probability of choosing a particular price in a particular state is high if the value of setting that price in that particular state is high. Okay, oops, okay. How to specify the reference distribution F bar and lambda bar relative to which the cost of conditioning on the state is measured. One possibility is to say we're going to impose them exogenously. So for example, Anton Nakov and Jim Costin have done this in control cost models. Another possibility is to say we're going to choose them optimally, as in the pure rational inattention model. So I've done some work doing this. Here, we want to estimate this model with Bayesian methods, so we're going to do a simplification. We're going to consider a less efficient, though still endogenous information structure, in which the reference distributions are the steady state equilibrium distributions. So what does that mean? That means we're thinking of firms that have extensive experience with their environment. They know, on average, what prices are good to charge, right? They know the unconditional frequency with which different prices are charged in the economy. And they know this because they understand the structure of the economy. So then they have this information for free, and then in each period in real time, they choose whether or not to deviate from this unconditional distribution of prices. Similarly, they also know on average the frequency of price adjustment, right? They could choose to just change prices with that constant probability, right? They know what it is, or they could choose to deviate from that probability. So here are the solutions, the optimal choices of the firm. And this is going to be very intuitive, and I think you're going to recognize this expression. So what this says is that the log odds of adjustment, conditioning on a state, are going to be equal to the log odds of the unconditional probability of adjustment, plus a term that depends on the net value of adjusting minus value of staying put at your current price, net of the menu cost, relative to the marginal cost of information, that's theta A, of conditioning on the state, right? So the first term is the Calvo probability. If you have a firm whose cost of acquiring information to make the review decision is very, very high, then it's going to choose a probability of adjustment that converges to the Calvo constant probability. If you have a firm whose cost of information to figure out whether or not a review is warranted is very, very low, its probability of adjustment is going to converge to the menu cost solution. It's going to converge to the bang-bang menu cost solution. So this parameter theta A basically governs the degree of state dependence in the timing of price adjustments. High theta A means Calvo-like adjustment. Low theta A means increasingly more state-dependent price adjustment. This is Woodford 2009. And here's the reference probability where I'm showing you that it just integrates over the adjustment probabilities of all the different firms in the steady state. Okay, what about the pricing decision? So this is telling you the probability that a firm with given idiosyncratic state A and aggregate state gamma, I keep wanting to call it lambda for some reason. So a firm with idiosyncratic state A and aggregate state gamma is going to choose price P with a probability that is increasing in the value of charging this price in this state relative to the marginal cost of learning that it's in this state, right? So it's going to be high if the value of charging that price is high relative to the value of charging, you know, all the other prices or other prices on average in this state, right? So it's state dependent, but it's only partially state dependent because it's anchored by this reference distribution F bar. If the cost of figuring out what the right price to charge is very high, if theta P is very high, then my pricing policy is going to be that of an uninformed firm that just draws from the default distribution of prices that I know kind of work well on average. Whereas if I have a low marginal cost of learning about what the right price to charge, if theta P is low, then the probability that I charge a particular price is going to be really strongly tied to the value of that price in that state. Right, so it's going to be very state dependent. So now we have theta P governing the degree of state dependence in pricing, just like theta A governs the degree of state dependence in timing of price changes. Okay? Okay, good. So I want to spend a few minutes talking about the incentives for information acquisition, starting from a very familiar world, which is the world of the menu cost model. So think about a menu cost model in which the profit function is the one showed here in the top left panel. So here I'm showing you the profit function of a firm that has a pretty high elasticity of substitution, so it's very sensitive to mispricing, particularly to underpricing. Cyan is the flex price, is the static flex price, okay? And here I'm showing you the distribution of marginal cost that this firm is expected to encounter. The bottom panel shows you the adjustment probability of the menu cost model. And like we know, when marginal cost is really low, firms have an incentive to price very accurately so that they can steal demand from other competitors, especially if demand is very elastic. So that means the SS bands are going to be very narrow when its marginal cost is low. Also, when its marginal cost is low, the firm is going to set a P star, I'm now talking about the menu cost model, deterministic P star, optimal price, that's very close to the optimal flex price. It's a little bit above the optimal flex price, but it's very close. So it's tracking the state very, very well for a long time, right, for a wide range of marginal costs. What you see is that as the marginal cost increases, the SS bands widen. We know why this is, because the profit function is not that steep anymore. It's okay if you make mistakes around here. That's not really going to be, that's not really going to affect your profits that much. But what you do see is a flattening of the optimal reset price P star relative to the flex price star. What this is showing you is that the firm's price is becoming less and less sensitive to its marginal cost at high marginal cost states. Now, suppose you introduce errors in pricing. So now the firm, instead of just setting P star that is the red line, it sets prices drawn from the optimally chosen distribution. This is going to generate two things. First of all, it's going to widen the SS bands, endogenous price rigidity, because of the possibility of making mistakes in repricing. Right? So you're going to choose to not adjust because you understand that you might make mistakes. Second, it's going to generate strong state dependence at low prices, overpricing much more than before, and much less conditioning on the state. Notice that basically the distribution of prices, which I'm showing you in this shaded area, has very little dispersion at low marginal costs when accuracy is high and prices are accurate. Very low dispersion at high marginal cost, but it's not because accuracy is high, it's because you choose basically a non-informed price and you stick with it to save on information costs and on menu costs. And in the middle, which is where you spend most of your time, you have the highest degree of price dispersion. That's going to have implications for equilibrium price dispersion and for the welfare costs of inflation. Let me jump ahead and tell you what we estimate for the steady state friction. So we're going to take this model. We're going to put the steady state to be the great moderation period. And much to our surprise, we estimate a large cost of figuring out what the right price to charge is. Theta P is 1. We're going to estimate a much smaller cost of figuring out the timing of price adjustment. We find that in the steady state, firms are very well informed about when their prices are out of line, strongly state-dependent timing. It's just that when they adjust, they make mistakes, theta P is high. And we're going to find a very small menu cost relative to the literature. Okay, these frictions have high, so here's the pricing policy. So you see the adjustment probability is very steep, very strongly state-dependent. The distribution of prices is very noisy, conditional on adjusting. These have large implications, so we estimate that price dispersion is 10% higher compared to the flex price economy, and consumption in the steady state is 7% lower. In terms of monetary non-neutrality, our model generates about 80% of what a Calvo model would imply, parameterized to match the same frequency. This is higher than the model with just weakly state-dependent pricing, which is what I'm labeling here as the Woodford model. And of course, it's much, much higher than the menu cost model. Okay, estimation. Let's now take the model, add shocks to preferences, technologies, and policies. These are not observed for firms. They have to learn about them. And also allow for shocks to the pricing frictions, interpreted as shocks to the attention or efficiency with which firms can process information about the state of the world and incorporate it into their pricing decisions. So the estimated series for the pricing frictions, here they are, the three parameters. So you see theta P has kind of medium cycle volatility, right? It started, it declined with the Volcker disinflation. It was pretty low. Started rising in the 80s and up to mid-90s. Then it started a decline until the Great Recession, when it rose again. Interestingly, this is a really wide range, so I should say, there's a lot of volatility in theta p, ranging from, 0.5 to, say, 3, roughly. The steady state value of 1 is already one in which there's significant noise. So throughout the entire sample period, we're estimating significant errors in pricing. Second, timing of adjustment. How accurately do firms figure out when it's time to reoptimize their price? Well, most of the time they figure it out really, really well. So for most of the sample period, the theta A value is at or below the steady state value of 0.1. We only see a Calvo-like behavior in between, between the Great Recession and the COVID recession. As for the menu cost, notice the y-axis, if you can see it, the menu cost ranges from 0.01 to 0.03 roughly, very small and very stable. So the menu cost is not going to be a big contributor to nominal price rigidities. Now, using these filtered shocks, let's go back and compute the implied cumulative impulse response function implied by these pricing frictions over time. And let's draw out the implied nominal rigidity over time. And here's the series of, if you like, how effective monetary policy has been in the US. A brave statement, but here's our best guess given our model. So our best guess is that monetary policy, so this is the response of consumption, okay? Okay, so monetary policy effectiveness, not surprisingly, rose from the 80s through to the mid-90s, right? So this is consistent with the idea of increased reputation for the central bank, increased effectiveness, a stable regime, more effective policy. Then from the mid-90s or so, it declined. And what's really interesting to note is that if you look at the Great Recession, monetary policy was actually quite effective in the Great Recession and rising. We do not find evidence that recessions are times when monetary policy effectiveness is low. At least it was certainly not the case in the Great Recession. And what's interesting is that monetary policy effectiveness rose, but then something happened starting in around 2016, which is that nominal rigidities started declining. And they declined significantly well before the COVID pandemic. So what according to our model, what this suggests is that by the time 2020 came around, firms were poised to respond with price changes to any inflationary shocks. So if you look at the inflation response to demand shocks, yesterday we talked a lot about demand versus supply shocks and the COVID inflation dynamics. So look at what our model predicts. The inflation response to a demand shock would be, let's start with the Lehman failure. So September 2008, right, the midst of panic, inflation was not expected to move much. Very strong very strong real effects of a demand shock. 2016 liftoff, very muted inflation response, right? Inflation was not expected, according to our model, to respond much at all. But then now, if you look at the COVID onset, the responsiveness of inflation to a demand shock at the onset of COVID in February 2020 was, way, way higher. And today, quote unquote today, March 2023, when our sample ends, the inflation response is higher still. What this suggests to us is both that it should not be a surprise that inflationary shocks, surprise in hindsight, that inflationary shocks led to an increase in inflation starting in 2020. It should also not be a surprise that monetary policy has had, effect on inflation, but with a soft landing since then, because this is telling us that monetary policy can have very strong effects on inflation right now without significant effects on output. This is also suggesting the huge value of monitoring in real time the distribution of price changes, because we are finding that the distribution of price changes is highly informative in real time about the nature of pricing frictions, and that can tell us, hopefully in real time, the difference in inflation sensitivity to aggregate demand shocks and output sensitivity to aggregate demand shocks. I think I'm out of time, so let me conclude here. The approach to estimating monetary non-neutrality has evolved significantly from using just aggregate data and DSG models to micro-pricing data. Here we consider the implications of the dynamics of the distribution of price changes for monetary non-neutrality. We use this flexibly specified pricing model in which we find support for accurate timing of price changes, but significant errors in pricing, conditional on adjustment. And we find evidence that the degree of nominal rigidities varies significantly over time, with consequences for understanding on both the sources and the bounds of nominal rigidity over time and in periods of low versus high inflation. Thank you very much.
Discussant is Anton Nakov from the European Central Bank.
All right. Well, thanks a lot for this opportunity to discuss this paper. I will give an overview of the main takeaways of the paper. Then I will ask some questions and make some suggestions for improvement. So this is a paper about state-dependent pricing with two margins of errors on the timing and the pricing of adjustment. And it builds on earlier work of one of the authors and also on some work that Jim Costain and I have done in the past. So there are two main differences here. One is the reference distribution is not exogenous like we have assumed, but it's the steady state price distribution.
Can you just come closer to the mic or use the other?
You cannot hear me?
Yeah.
Okay. And also they do estimation on time series of microdata that allows them to come up with a series for nominal price rigidities that has some important and interesting implications for the transmission of monetary policy. So the new findings here are in particular that menu costs are tiny and the cost of decision-making are high. From this cost of decision-making, the cost of repricing are way higher than the cost of getting the timing right. So like I said, they estimate a time series for the degree of nominal price rigidity. And an intriguing thing is that the model can generate more rigidity than even a Calvo model. Okay, so I find this a very fascinating line of research and paper. How best to model nominal rigidity? Is it menu costs or is it some costly decision-making by firms? The result that Calvo is not the upper bound for nominal rigidity is particularly interesting. And I think that this new index of nominal price rigidity is potentially very interesting, has interesting implications for monetary policy like we saw in the presentation. So this is this index. And so now let me ask some questions and make some comments and suggestions. So one is that pricing here is quite suboptimal, like Lumia acknowledged. So except at very low cost, prices are stay close to the reference distribution. And this reference distribution, also known as predisposition, is like long-term memory. And so in their work, it's the average price distribution across costs. But that imparts a strong bias towards the unconditional mean, even though firms really should care and want to care about variation in costs. And so think of Winnipeg, Canada, where in winter it's -4 degrees Fahrenheit, and in the summer it's 104 degrees Fahrenheit, or sometimes it's 104. And so you need a lot of air conditioning in the summer and a lot of heating in the winter. But if one only remembers the average temperature, then one is going to do very badly in both in summer and winter. So here is this average distribution. And you see that With average predisposition, the steady-state pricing strategy is such that you essentially set an average price across the range of marginal costs, with an only exception for very, very low marginal cost, okay, very high productivity. And so I have two questions. One is, how does the distribution of price changes look like in your data set? I haven't been able to find a figure showing it. And from what I can infer from this figure is that there is like a big mass of very tiny price changes and a relatively small mass of very large price changes, but probably not a lot of medium-sized price changes. So I haven't seen the distribution. I think it would be important and interesting to show it. And then are nearly all price changes mistakes? Because, you know, except for this conditioning at the very low marginal cost state, you're essentially setting an average price. Okay, so I'd like to advertise a little bit my own work. So in a paper from 2015, we called precautionary price stickiness. We introduced this novel reason for stickiness, the risk of mistakes in pricing. And in fact, there where we imposed an exogenous distribution, a uniform one, so agnostic prior, does not pull firms towards the unconditional average price. And so firms actually end up conditioning on costs a lot more and tend to get the price right. And you can see this by the fact that prices now are along the diagonal, so that, you know, as cost increases, you tend to set a higher price. And as a result of that, and the SS pricing nature of the model, we find that actually the behavior in the aggregate is very similar to the one in Golosov and Lucas, so there is very little rigidity. Thank you. In our work, Calvo is the upper bound on nominal price rigidity because errors in pricing wash out in the aggregate. And this does not seem to be the case here. Now, also compared to our work with Jim, here decision-making costs are 3 times higher than in our logit price dynamics paper. And I'm curious to find out why. We are also estimating the model, even though on steady state, but this very big difference in costs is interesting. So in particular, why are the decision-making costs on the pricing margin so high? Which feature of the data calls for that? And relatedly, why are the menu costs so small, and which feature of the data calls for that? And also, where does the underreaction to aggregate shocks come from? I understand the underreaction to idiosyncratic shocks comes from the predisposition that you assume, but the underreaction to aggregate shocks, I'm not so sure. Okay, because pricing is so suboptimal here, there is large inefficiency beyond the costs firms pay for decision making. And the inefficiency stems from the fact that firms sell at too high a price when costs are low, and too low a price when costs are high. And so this suggests that misallocation is quite large, and like you pointed out, consumption loss is 7%, and extra labor is 5%. So an economy which is way below potential only because of firms mispricing. Okay, so some other points. Why are the timing and pricing decision-making costs different? Because in rational attention, they should be in principle the same. So you could think of imposing the same thinking cost on both margins. And why are they time varying? And how can one distinguish that from time varying shock volatility? Okay, and finally, the model is intrinsically nonlinear and interestingly so, but the solution, I think, is linearized with respect to the aggregate shocks. So any variation in the frequency of repricing comes from fluctuations in menu or information costs and not from shock size dependence like we saw yesterday in the keynote lecture. With that, let me conclude. That's a very interesting paper, has lots of potential and enjoyable reading. I have 4 suggestions. Discuss which aspect of the data deliver the key results. Show a model implied distribution of price changes next to the targeted empirical distribution. Show the reference distribution as well. And explore robustness to alternative predispositions, a uniform or diagonal center on the current price. And that's about it. Yeah, thank you very much for the opportunity to discuss.
Then let's collect some questions.
Thank you very much for a very nice paper. So I have 2 questions. So one is the aspect, so you model everything at that firm level and using this, the micro data, and then you go to kind of look some of the macro implications, and especially this aspect of how monetary policy is very, effective or not, depending on which period. But when you go in that other step, I'm guessing you're kind of assuming in the background wages are completely flexible all through this or not, or how you're doing that, and kind of trying to figure out whether what we're assuming on the wage matters a lot for kind of, it could be the pricing gets more, but if the wages aren't doing it, anyways, that aspect. And then in the time variation, what's your narrative about like some of the kind of shocks, or how do you think about it, and giving a bit of a story there for us to understand.
You have the same question about wages. You have a sense of how wage rigidity evolved over this period, and on the asymmetry in the effects of monetary policy. What we found in our work was that it had to do with the direction of fiscal policy in response to monetary policy intervention. So it might be that digging deeper on what's going on in these different swings, you might find that there is a fiscal aspect to it.
First of all, very impressive paper. And I want to follow up on the question the discussant had about what's the source of variation in nominal rigidity over time. For example, in the menu cost, it's pretty clear. It's the size of the shocks. You have more neutrality or closer to neutrality, the bigger the shocks. You see it in an increase in the frequency of price adjustment. Over here now, it seems like variation in the repricing costs are critical. And what's the narrative you would tell about what causes this variation? Is it something that a policymaker could figure out?
I had one question regarding one aspect of the model. So if I understand correctly, the more prices adjust, the less output response. So it's kind of like Kolosov-Lucas. So you talked about monetary policy effectiveness, and you showed the effect on, I think, on output, but or on prices actually. So I wonder whether there's a sense in which in the model, the more prices respond, the less output does. Mostly because there is this feeling that either monetary policy works or it doesn't. But if it doesn't, it's not that you are trading off more employment with less prices. It's just that somehow the transmission is broken in many other ways in which agents just don't respond. So you don't see like a large price response and then output doesn't, and the other way around.
All right, thank you very much. First of all, thank you for the great discussion, Anton, and thank you all for the questions. So let me try to address a couple of comments. So first, regarding the severity of the pricing friction. So to be clear, what we get is the outcome of the model trying to match the data. So we don't impose large pricing frictions to begin with, I guess the model itself is capable of matching however strong the state dependence might be in either dimension. One aspect of the data that pushes the model towards significant repricing is the fact that you have high kurtosis of price changes and high standard deviation of price changes. And in fact, we've seen that the standard deviation, the dispersion of price changes has grown over time. So in the model, the way to get high dispersion, even if the timing of price changes is quite accurate, is with mistakes in repricing. If we were to impose, so we did the uniform prior. So if we were to impose a uniform prior, first note that in this model, the uniform prior would be even more costly to deviate, right? It would require, to get the same level of accuracy, it would require firms spend even more resources because now the uniform is a much flatter prior than the endogenous steady state distribution of prices. So we would estimate higher costs of repricing. The degree to which there's state dependence in repricing depends on the shocks and also on the unit cost of information. So when we were using the uniform prior, we were getting much higher costs of information. I think we have to compare the models, so I'll look into that. The errors do not wash out in repricing, so I think that's a really important point, and it goes to the point of dampening of responsiveness of prices to shocks, right? So firms are very willing to price accurately when marginal costs are low, to capture demand from competitors and to, to take advantage of the times when marginal cost is low, because that will not always be the case. But as prices become less and less responsive, that's where you get the fact that the mistakes do not wash out to aggregation because of this dampening effect. In terms of the wage rigidity. So we do have wage rigidity, and actually it's very important to have wage rigidity in the model. And the way we model it is very Mickey Mouse. So we impose wage rigidity, setting that the wage in real time is a linear combination of the steady state wage and the currently flexible optimal flex price wage, and then we have a parameter. We have not looked at how much that varies over time. I think we would need to bring in some wage data to get a better sense of wage versus price rigidity. Interesting point about fiscal policy, we have not touched that at all. And in terms of the narrative, so this has been this is kind of the billion-dollar questions. We see that menu costs are not doing anything. I could show you a figure. Menu costs are not doing anything. The cost of the timing of adjustments is not doing anything. The repricing are really driving the volatility. And in terms of the narrative, I think what we have in mind is the following story, that on the one hand, it is easier to know when you are wrong than to know what to do about it. So we would expect, on average, the repricing decision to be less accurate than the timing decision. Second, as inflation has come down in the US and as monetary policy has become much more disciplined, we think it's reasonable to think that prices have stopped worrying so much about responsiveness to shocks, and they've started actually worrying much more about price discrimination across customers and making their pricing strategy much more sophisticated. The dispersion that we see in the data might be a reflection of these much more sophisticated pricing strategies that don't have much to do with aggregate shocks, right? It's not that firms are responding in a more sophisticated way to the aggregate state. It's that they're responding in a more sophisticated way to their customer base, right? And we don't have any customer motives, customer building model or anything like that in the model. In terms of the recent increase, so the post-Great Recession increase in nominal rigidities, so this is a puzzle, what happened in 2016, right? So you had kind of post-Great Recession, you had pretty significant nominal rigidities, and in 2016, rigidities just kind of started coming down well before any shocks. Brexit uncertainty, the Fed, it was the Fed's fault. The Fed started tightening, and firms started paying attention, like, oh, wait, we've been in this period of the zero lower bound for like years and years and years, so we've been kind of dozing off. Now the Fed has been doing liftoff, so maybe we now need to pay attention to our pricing much more aggressively. The key takeaway is that, any inflationary shock should have caused a big surge in inflation. Starting around 2018, 2019, whatever its source. Let me stop there.
So then, thank you very much. And we will have a coffee break. We reconvene at 10:15. So let's continue. So the next presenter is Florian Bilby from University of Cambridge, and the discussant is going to be Paul Baudry from Vancouver School of Economics.
Hi, thank you so much for having me here and the paper. It's really a great pleasure and honor to tell you about this. It's joint work with the former star student Diego Kenzig, who was supposed to be here too, but unfortunately couldn't make it. And it's one of these papers where kind of the title tells you already kind of what the paper is about. So it's about this greed hypothesis. We talked a lot about inflation yesterday. So here is going to be like a much narrower thing. So we're going to try to explore the merits of this greed hypothesis in the surge of inflation, particularly through the lens of new Keynesian models, so like largely speaking, new Keynesian models. And we're very grateful to President Biden for providing us with a quote a few months after we started circulating the paper, with kind of a perfect quote that makes a pretty much of a casual statement that profits were the thing that actually drove inflation. Okay, so this is on the anniversary of the Inflation Reduction Act, so that 2/3 corporate profits are coming back down to earth, etc. So it's pretty clear. And it had been in the press, so this is more like the UK view, and the Guardian says profits are causing inflation. The Economist is more like doubtful, and then you have like some artworks ranging from the sort of more cynical to the more poetic. But the key points of it's like it's a big debate in policy circles and in the press. And if you look at policy speeches, Isabel is not here yet. But she had some speeches that talk to this in a kind of, using kind of serious economics, and President Lagarde. And we think there are like some key elements to this narrative. So we're going to try to narrow down what we mean by this narrative, by the greed narrative. So one is this, view that it's greed and corporate profits that drove inflation. The other one is that this is intimately related to distributional considerations, because this means, there are some profits, and this benefits kind of the rich, and the inequality is going up, and there is some notion that distributions and inequality are of the essence here. And this is bad for the poor also because, inflation is bad for them, but also because it erodes their wages. And there is a key demand component to this, which is that it's not just that the cost increase and then inflation increase. That's not greed. That's economics. There is this notion that it's like more inflation than it was warranted by the increasing cost. So there is a notion that firms exploited this increasing cost because demand was still high to kind of keep the prices high. So prices are too high. So profits are too high. Somehow. So what we mean, so the narrowing down, so the one interpretation of this definition that we're going for is that the first necessary ingredient that you need to get to tell this story is a co-movement of these three things, aggregate activity, inflation, and profits, or aggregate demand, inflation, and profits. But that's not the only thing, so we're going to add this layer, which is that the point one is essentially business cycles, right? Point two would be, but you get more inflation than you would get in a kind of normal times business cycle, and this would be coming about because of this kind of profits moving around and their distributional consideration. So there is some notion that there is some link between the distribution of profits, aggregate demand, and this kind of higher than usual inflation. So this is where I think we have a more specific. So this is one view of what greed means. There could be others that are more, and we can talk about that a little bit at the end. So we're going to try to explore the merits of kind of a large class of new Keynesian models for looking at that speak to these sort of profits and their distribution and heterogeneity, etc. So how easy it is to interpret this greed hypothesis through the lens of the model. So is it easy? Like, can we get this? Is this a natural implication of these models? And I listed here the ones that focus on, for reasons that I think are clear to most of you, is that you need a model that has both sticky wages and sticky prices. So I listed here especially the models that do sticky wages, so the kind of Cristiano Eichenbaum-Evans, and then the tank models, and then some Hank models that have sticky wages too. So I'm going to talk more precisely about some of this. So let me just start from the starting point. So something that really puzzled us to start with is that people were talking as if this was like a natural story and you would get this out of the model. And of course, if profits go up, inflation goes up. And no, actually in the textbook new Keynesian model that has only sticky prices, and this has been known, right? You get the opposite. When profits go up, you get deflation in response to a demand shock. And that's because, the standard, there is a demand expansion, labor demand goes up, marginal cost goes up, and unless you have some crazy parameter space where sales go up by so much that this kind of dominates the increase in marginal cost, profits actually go down. So in response to a demand shock, inflation goes up, demand goes up, profits go down, so there is negative co-movement. And so we're going to do, the first contribution here will be that we're going to give, so this is, there is a fix for this, and that fix is sticky wages, and we've known this since at least Cristiano Eichenbaum-Evans 2005, where they introduced a Herzeg, Henderson, Levin way of doing sticky wages in a DSG model. And what we're going to give as a first step is an analytical condition under which you get pro-cyclical profits, so a condition on wage stickiness. But then there is a way so that's kind of the minimal thing you need. You need a model that gives you this co-movement of these three things, inflation, demand, and profits to demand shocks. And I'm going to go to supply shocks in a second. But then, you want more inflation than usual. So that's, Cristiano Eichenbaum-Evans. We have, there's nothing really new there. So, but how do you get this greed narrative that you get more inflation than usual because profits are high? And I think to think about that, you need to just look at the model in a little bit of a different way, which is to rewrite the Phillips curve. So I'm going to use throughout, when we do the analytics, this way of doing the Phillips curve without the expectation term in there, which I've kind of been using this for 10 years to some outrage initially, but I think now more and more people are kind of adopting it. It buys you a lot analytically, and you don't lose that much in the way of substance, and then it's usually robust. So indulge me in taking this kind of static view of the Phillips curve, where you have inflation, and then is a log linearized one, and then on the right-hand side you have this psi p, which is kind of the slope, the usual slope of the Phillips curve, and then that's just marginal cost. But I wrote marginal cost by using the profit definition, and I just replaced marginal cost with we have sales. There are decreasing returns to scale. So the alpha is the degree of decreasing returns to scale. So when that's zero, we go back to the equation we just had, which is kind of the standard kind of textbook, simplest new Keynesian model. But now we have, you may get some kind of inflationary effect of profits through, if they happen to have some expansionary effect on aggregate demand through something that's not on this slide. The rest of the model may be something that gives you some kind of distributional equation that relates the aggregate demand with inequality that depends on profits, etc. Something that you get out of like a Hank model or a tank model. And the point here is the following. So the direct effect of profits will always be there insofar as you have, this co-movement is always there insofar as you have sticky prices, right? It's naturally there whenever you have some kind of price Phillips curve. When profits are going up, in response to a demand shock, that's kind of deflationary. Now suppose that you have sticky wages and you have this positive co-movement of aggregate demand, inflation, and profits, but this deflationary direct effect of profits from Phillips curve will always be there because of the second term, right? So here the point of this whole paper will be how can you get an expansion in aggregate demand that's big enough to kind of overturn this, to get like more inflation. Is there any kind of distributional way so that's what we would call kind of the greed story. Is there any story that you can tell based on a heterogeneous agent model that tells you that when profits are going up, there's going to be a big expansion in demand that will give you higher inflation than usual, so over and above the kind of business as usual business cycles. So the first kind of step is to do this. So we are just updated the estimates of Cristiano, Eichenbaum, Evans. So these are the impulse, on the left-hand side, are the impulse responses of the CEE JPE paper it's a usual story with, you have a monetary expansion, and then that's expansionary, and profits are pro-cyclical, and there is inflation. On the right-hand side, we simply updated this. This is just a revisitation of it and kind of a confirmation of the result, but we use kind of the state-of-the-art Gertler-Karady plus Bauer-Swanson. We do this all the Miranda, Agrippino, Rico, and the Yarochinsky-Karady, and so it's kind of robust to everything. And you see that we kind of get the same co-movements. Of course, it's business as usual. They're a bit more front-loaded, etc. So there's no contribution here. It's just kind of we confirm that you still want to get procyclical profits in response to demand shocks. Why not supply shocks? So there is a theory reason for that, and there is an evidence reason for that. So if you want to tell the greed story as profits go up, inflation goes up, you can say, but I know that in response to supply shocks, profits are procyclical. Yes, but supply shocks mean that a negative co-movement between aggregate activity and inflation. So in fact, if profits are procyclical, they are also deflationary. So in fact, if you want a greed story, you want a greed story that if inflation was driven by supply shocks, you want the greed story to be so big that it actually dominates that. Okay, so it makes profits go up and aggregate demand too. So it's one thing you haven't seen in the recent experience is a recession. We have not seen a recession that would naturally occur in response to a bad supply shock. So that's why we focus on demand, in fact. There may be other things you could focus on, but that's kind of a reason, in our view, to focus on demand. And we have some evidence here which uses two kind of standard supply shocks. One is the TFP, the Kierman-Sims way of like redoing Fernald, and then a Kenzig, I guess, oil price shock. And in response to both of them, you see this kind of negative co-movement between inflation and GDP, and then you see profits actually going down. Okay, so that's why we focus on demand shock. So let me dive. I'm probably going to run out of time, but I want to show you some analytics because it's just so simple. It's just so easy to do this. So let's just take the simplest rank model to understand this kind of co-movement between profits and inflation and aggregate demand. So let's take a decreasing returns to scale production function where 1 minus alpha is the exponent on n. And then let's take the demand side as being completely controlled by the central bank, and it can do that by fixing the real interest rate, and then through the Euler equation, it just sets, when it sets the real interest rate, it's going to set demand, and you can think of that also as a money rule or whatever, like nominal spending. The key equations are the following. There is a definition of profit, the log linearized definition of profits, that's the usual. So now this calligraphic M is in like Jordi's textbook is the gross markup or net of any subsidy, and that's larger than 1. So then you have this, that profits are a function of sales and then the marginal cost or the wage. And then the marginal cost curve is the inverse of the markup, and that's driven by, there is some slope in it because of decreasing returns. So you have some slope, and that slope is given by alpha, right? So there is this alpha that's kind of key. And then I'm going to use, again, these Phillips curves both for prices and wages that are static. And their being static allows you to do everything with pencil and paper on like 3 lines. So the first is a price Phillips curve that we've seen before, where you have the inflation is driven by the marginal cost, and the marginal cost, I just replaced the definition of the marginal cost, the labor demand, essentially. And then there is the kind of labor supply or the wage Phillips curve, and then we have inflation in nominal wages, and that's going to be determined by the deviation of the MRS from the real wage, and the slope of that is this psi w, so that would be the index of wage stickiness. So this is just essentially Arceg, Henderson, Levin without the expected inflation term. Okay? And you can microfound that. So in these papers where I used it earlier, you can microfound it either by saying the optimizing firms are myopic. I was very happy when Mark said that yesterday, that there is evidence for this. Or that you have Rothenberg and the reference price is actually the aggregate price, not the firm's own individual price. When you take the derivative, it goes away. I mean, there's some just tricks of backward engineering. So the cool thing with this is that you combine those three equations and you get kind of a reduced form equation for the dynamics of profits. And you can read the elasticity of profits to aggregate demand. Given that aggregate demand is completely controlled by the central bank, essentially, you can read the elasticity, the cyclicality of it just by taking the coefficient in front of C there. And there you have the markup, and you have this big omega parameter. And this big omega parameter is the essential kind of determinant of cyclicality, and it's going to be a function of, guess what, the relative stickiness of prices and wages. So we're going to come to that in a second. So the proposition here is that when do you get demand pro-cyclical profits? Well, they're going to be pro-cyclical when that coefficient is larger than 0. That coefficient is larger than 0 whenever sort of the stickiness of wages is large enough compared to the stickiness of prices. And there is an intuition for that. So take the extreme cases. So in one extreme, we just saw it when prices are sticky, wages are flexible, you're going to have demand counter-cyclical profits because of the usual story. Labor demand expands, marginal cost goes up, sales don't go up by as much, etc., and profits go down. If you have, so that's just saying you are along the upward sloping labor supply curve. If you are in the opposite case where wages are sticky but prices are flexible, then the markup is fixed, and then you're going to be along the labor demand curve. And if it's downward sloping, that means that like automatically your profits are going to be pro-cyclical, right? So now if you're somewhere in between those two extremes, it depends on which of these two forces dominates, right? So this is what this condition is saying. And there is, so that I'm going to kind of skip this. This was just the intuition for that. So color choice more or less innocuous. This is kind of the parameter region for the two slopes of the Phillips curves in prices and wages. And kind of refreshingly, most of the estimates of the Phillips curve slopes are kind of here. So in the yellow region, when wages are sticky enough relative to prices, then you have pro-cyclical profits. So that's kind of the condition that you need. This is just an analytical version of the Cristiano Eichenbaum and Evans. There is a sentence in the abstract that says profits are pro-cyclical, you need sticky wages to do, sticky enough wages to do. So there is nothing like fundamentally revolutionary here. It's just kind of an analytical. And if you want to discipline, you have a quantitative model, it tells you a little bit which parameters to look at. But now, so here is a layer that we bring on top of this. So indulge me in using this kind of optimal subsidy, m is equal to 1 case. You're not losing that much. So then this big omega, which depends on the relative stickiness, is just the cyclicality of profits. So now if you go back to this modified Phillips curve where I replace the marginal cost, so we have inflation as a function of aggregate demand and profits, you see that different models of aggregate demand, so for now we had just the Euler equation, but now we know that a way to think of Hank and tank models, etc., is to think of something that does something to that Euler equation, so that aggregate demand is not just this one Euler equation of one agent, but is kind of something more complicated, and you can get kind of distributional things going on. So now the story will be, is there some way, so now we have a condition that tells us profits will be pro-cyclical and inflationary, but is there a way to get now an extra layer that says that the demand expansion, so the C term there, the first term in this rewritten Phillips curve will be so large as to give you this higher inflation variations through these redistributional channels. So I'm going to give you kind of the simplest way to think about this, which is the analytical tank model from my thesis like 20 years ago, and where you have lambda agents who are hand to mouth, and then the rest are savers. And now we're going to use this. So Ascari et al. Had a very nice paper extending my model with kind of the Herzeg, Henderson, Levine a way of doing sticky wages, and that's what we're going to use here. So you have that all agents work for a union, and everybody kind of makes the same wage and works the same hours, so they have the same earnings, and this can be relaxed, but it's for now, and we do that in the paper, but this is kind of an important benchmark. But notably, naturally, you would not think of the hand-to-mouth agents as getting profits, although some papers in the Hang literature do some version of this. But suppose that the natural thing is to say, well, the profits go to the asset holders, and the asset holders are sort of the savers. But let's suppose that through some mechanism, part of these profits may go to the hand-to-mouth. Maybe it's through fiscal redistribution. Maybe they're kind of wealthy, hand-to-mouth, whatever, some way. And then we're going to assume that this eta parameter is something that tells you how much of that profit per capita is going to the hand-to-mouth. So if you want, the whole model is here, which is, there is the hand-to-mouth consumption is driven by first earnings that are going to be the same as for the savers, and then this extra profit term that maybe they get with this eta parameter. Then there is the standard Euler equation, but now it applies only to the 1 minus alpha saver agents, right? So it only applies to the CS. Okay, I'm running out of time. And then there is the aggregation equation. The key point of this is to understand that now if I want to think of the dynamics of aggregate demand, there is one thing that I can use as a kind of sufficient statistic, which is a difference between the consumption inequality, the difference in consumption between the rich and the poor, so of the savers and the hand-to-mouth. So if I combine those two equations and I rewrite the consumption of the savers as aggregate consumption plus some term that has to do with inequality, replace that in their Euler equation, you're going to see that when do you get amplification of aggregate demand? Well, so that is to say a higher effect on aggregate demand in response to interest rates through this kind of inequality dynamics. You get that if and only if consumption inequality is counter-cyclical. So if the part of the model that's kind of distributional gives you inequality of consumption and income, because here income is equal to consumption, that is counter-cyclical. So that is to say, in a boom, it's going to redistribute income to the high MPC, to the poor. So then why? Because this engenders this kind of, I like to call it, they gave the title of a paper, a new Keynesian cross. So the fact that then that income goes to the hand-to-mouth, they increase their demand even further, and the demand goes up even further. So it's essentially a Samuelson-like multiplier. So that's kind of a sufficient condition for getting amplification, that consumption inequality needs to be counter-cyclical. But now, with this simple model, consumption inequality is driven by two things. One is the cyclicality of profits, because the earnings are made so that they are equal, they're uniform. So this is going to be driven by, so when you take the difference of the two consumptions, you're going to have profits, but then also the distribution of profits, this eta parameter, who do they go to? Do they go more to the savers or more to the hand-to-mouth? So when do you get amplification? So when do you get this Keynesian cross business? You either get it when profits are counter-cyclical and go to the savers, and this was the case in my thesis and in a bunch of other papers after, or if profits are pro-cyclical, as they are in the data, but then they need to go to the hand-to-mouth, which is kind of not really what you want. So if you want to discipline the model in both of these dimensions, that profits are pro-cyclical and they go to the savers, because the savers are the low MPC agents, that's going to kill this amplification. It's going to actually give you dampening. So the conundrum that we're pointing out here is that through these distributional channels, you actually get the opposite of greed. Okay, so you would like to take the profits away, and that would give you high inflation. So that's not enough. So what do we do then? And there is a way to think of this to understand the literature. The two modifications we do to get, so we're kind of trying to, how can we get through these distributional mechanisms something that looks like this amplification, this greed and amplification. So one way to think of it is, but profits here are just a transfer. So let's think of profits as being like the payoff, like the motivating sort of investment, so something like that's inherently related to investment. So we extend this model to have kind of investment in physical capital. You need to redefine the profits, and we do the same as Cristiano et al. We work now with like accounting profits, so profits will incorporate also R times K. And then but consumption inequality is still the sufficient statistic for driving the amplification of consumption because of the little equation I showed just earlier. That's still there, right? It's still through the aggregate Euler equation, except that now consumption inequality is driven not only by the profits, but also by investment, which is kind of on the left-hand side of the budget constraint. And we know that this by itself can also generate amplification. And we have a previous paper with Diego and Paolo Surico that shows that. And when you put the two together, you get something that's called the multiplier of the multiplier. But the kind of the key point here is that you can get counter-cyclical consumption inequality with pro-cyclical profits and profits going to the savers. So if investment is pro-cyclical enough, and investment is pro-cyclical. So fine, you say, let's look at the model. So now we take a calibrated version of the model and we look at how much can you get in terms of amplification relative to rank. Rank is blue, tank is red, tank with capital. So you get amplification of consumption, but not of inflation. Why don't you get amplification of inflation? Because that Phillips curve I showed you to start with is still there. So this is a model in which, yes, you get more C and more Y. You can rewrite it to have Y instead of C. So you get more of that, but you also get more of profit, because if profits are pro-cyclical, we want profits to be pro-cyclical, but that's kind of killing the effect on inflation because these two forces are offsetting. So the last thing we say, well, what else can there be there in this class of models? So we're going to add counter-cyclical income risk. So the notion that, and something that's of the essence in Hank models, is that now you may have an extra amplifying effect, and there's a bunch of papers doing this. You may have an extra amplifying effect if income risk goes up in recessions, if it's counter-cyclical, or down in expansions. So then you can get an amplification of the expansion if risk is going down because people demand less stuff for precautionary saving, and that can have this demand effect that it gives you an even higher. So we have a formalization of that is based on my recent review of economic studies paper, or recent, it's 7-year-old, but recently accepted. And then we have a calibrated version of it that calibrates the counter-cyclicality of income risk based on an estimation, a tractable Hank DSG estimation we do with Giorgio Primiceri and Andrea Tambalotti. And this is what you get. So you get this amplification of consumption, and you also get an amplification. So you can tell this story, but there is a cap. So there is more inflation through distributional, Hankish kind of stuff. But it's not really driven by profits. In fact, if anything, it's kind of despite profits being pro-cyclical. Profits are always there, kind of working the other way around. So let me just try to conclude in like 20 seconds. So if you kind of take this view of greed, that is excess inflation through these indirect aggregate demand effects that are coming around because of these profits and their distributional effect, the paper did a few things. The first is this analytical condition for getting pro-cyclical inflationary profits that is kind of the necessary and minimal condition that you need to tell that story. But that poses a conundrum for the whole class of Hank models, in fact, where profits are actually going to asset owners, and if they go to asset owners, they're going to redistribute income to low MPC, and that's going to give you like the opposite of greed. You want to take away profits and to get higher inflation. And the way out would be to have a cyclical enough investment, which can give you this amplification without, so with pro-cyclical profits, but that doesn't give you inflation amplification because of that Phillips curve. It's always there. Profits are always active insofar as you have sticky prices. So the kind of solution is to have counter-cyclical risk, but that's kind of more like despite profits. It's not because of profits or driven by profits. So the bottom line is a bit of a constructive one, I guess, which is we need more research. So if you do like proper estimations that identify some kind of corporate profits causal effect on inflation, if that turns out to be the case, then the class of models we need to use is not this. So it's like, or this plus something that tells a story of markups and kind of IO-ish, perhaps. I don't know. Thank you. Sorry.
So first, I want to thank the organizers for a great conference. It's really well organized, and then it was a pleasure yesterday having the views out on the city and kind of such a nice day. So it's been really great, and really liked reading this paper. It's a very, very clear paper. So the motivation, I think, is really kind of very helpful in lots of countries, and I spent the last 5 years at the Bank of Canada, and this aspect of greed narrative was very kind of prevalent. It's prevalent in lots of countries, so that was kind of looked at a lot. This idea that somehow in this whole episode, inflation was much higher, that's the narrative, because firms managed to take advantage of the situation to increase their markups, increase profits, and that kind of pushed up, more inflation, and that was especially costly for low households, and that's the general narrative. Then what the paper does, and this is where you could do different passes there, is from that narrative you want to change that into a question you can address with your models, and there's nothing wrong with the way they kind of do it, but they take that and ask, okay, can we think of that narrative within the framework of a new Keynesian model and explaining it as a response to our kind of standard shock? So we'd like to see this kind of joint co-movement of seeing, an expansion of the economy, inflation and profits going up, and then ask to what extent maybe heterogeneity could even amplify that aspect and really kind of contribute. And so that's the way they kind of pose the question. And they have, a set of results there. So first, for thinking about it, they really then move, as Florian was saying, they move to kind of saying the contender here is really thinking about it within the context of these demand shocks, because when they identify other shocks, they don't seem to kind of create the right co-movement. So demand shocks potentially have the right co-movements. We'll ask it within that framework. And then they get this aspect that, well, if you want to think about demand shocks within at least a new Keynesian model of even creating the positive profits, you really need this these sticky wages, and they really give a nice condition about how much sticky wages you need relative to sticky prices to get that. Now, what they find in general then is it's really hard to then, so you can get that co-movement, then it's hard to get this kind of amplification through the heterogeneity, because you think a lot of the profits don't go to the high marginal propensity to consume. They might be going to the low marginal propensity. That's harder. Then they add capital in at different parts, and again, gets part of it help, but not others. So the bottom line is they find that workhorse model really has trouble kind of capturing that narrative of that was brought up at the beginning. So here the analysis is very clean, and a lot of the results here are theoretical in the sense that you can derive analytically, and Florian's an expert on this. So it's not like I'm going to go and kind of point out like, oh, there's a better trick here. He's the expert and kind of knows how to do these things. So in some sense, if I just stayed very narrow within the question he poses, I should just stop my comments, because the paper from there on is basically right as long as I can see it and kind of does the right things. So I'm going to address two issues that are kind of a little bit outside of the paper, kind of bringing different parts. The first, I'm going to come back to some of the motivating VAR and impulse response patterns that kind of is used in the paper. And I bring this up as much kind of bringing up some questions that might be relevant for people in this audience that have used these methods, and some of the questions I might have behind them, and they might have answers, or Florian might have answers. And then I want to discuss more this aspect that from the narrative, you could ask the question a bit differently, and there's kind of different takes that you'd want to take. And they've taken one, that's fine, and I'm going to suggest maybe different mechanisms that could help us understand where that greed narrative was maybe coming from. So here, as they say, they kind of use this kind of high frequency identification, which is popular to identify these effects of kind of demand shocks, or a monetary shock here, on getting this kind of co-movement. And for sure, this kind of identification is giving us a surprise. Whether it's giving us only the surprise we want of kind of thinking about it as a demand shock or a monetary shock is always a bit of a question. So just remembering, here's the impulse responses they have, and it's really these impact effects that kind of worry me when I look at these. It's not that, kind of look, even within the quarter this is happening, profits are going up by quite a bit. This is a 0.25% decrease in interest rates, and profits are going up like 1.5% within the same quarter. That causal part. Inflation is high right at that beginning part. Output is already high, all that within the same quarter, and the kind of inflation's coming down. It's not doing these kind of hump shapes. Now, maybe this is the right thing, but an alternative interpretation is, and this is where kind of, thinking about it, is, well, maybe what we're identifying here is a surprise, but it's a surprise of kind of reevaluating the central bank's feedback rule or decision rule. And so when you're kind of thinking about these high frequency type things, and so suppose if you thought the Taylor rule might have time varying coefficients, so I'm just writing out, some Taylor rule that would depend, let's say, on inflation relative to target and some GDP relative to kind of a natural level. And then you can think, well, what's the surprise? So what's the kind of the way we're kind of identifying the shock here? well, it's really the difference between the interest rate just before and kind of, epsilon after a decision or kind of something like this. And you can think, well, if that's your Taylor rule, what it's really identifying, you're not getting news about inflation at that point, but you are getting possibly a news about the coefficient in that Taylor rule that all of a sudden you kind of thought, well, the central bank's going to raise its rate, and it didn't, then you're kind of maybe revising that part of the rule. So if you define the error like that, and you think, what are impulse responses? Well, they're just kind of projections of inflation and GDP on these kind of errors there, but these errors are kind of interacting with inflation and GDP. It's in some sense, you're not going to get a surprise part. So think about what if I tell you the market's just been surprised that something didn't happen, and often this could be the case where there was kind of prediction of, the market was thinking interest rates would rise and they didn't rise. Well, what did the market learn? Well, maybe it's learning that, the central bank's kind of changing its rule and kind of, reacting to that. So you start getting this aspect that if you see that, maybe you think, okay, well, there's the real causal effect that might be doing, but there's also, it's kind of the interpretation. When do you think that would happen? Well, when would I be surprised? Well, it's when, output is high, inflation's high, we're already in a kind of boom, but at the same time, the central bank thinks it's not much of a problem, inflation's going to back down, and that's kind of what we're seeing here. So again, here I just bring out the idea of this is not a criticism of the paper, this is more kind of throwing out that question of, is this identification, it's kind of giving us the surprise, is it giving us the surprise we want, and should we be careful about how we're interpreting that type of thing. So in the second part, let me kind of think about different ways of addressing this question. Like I say, they took the question and kind of modified it here and looked at only demand shocks. Well, you could think through this period, part of what happened also was we had a whole bunch of supply shocks, and at least for a while, central banks were kind of looking through that, not increasing rates. And so we had some aspects of there where it's both supply and not necessarily kind of creating a contraction at that point. But could that kind of create a greed type of part or kind of high markups and different things? And then you think, well, when we get lots of shocks like we had, it starts creating, variability in prices, and kind of the whole information content of prices become a little bit more puzzling. And therefore, people might search a bit less, and if they're searching less, that allows you to increase up markups again. So you'd have a very different type of mechanism of thinking about things, where you could get it from that part of, if we think, everything's kind of going up and it's kind of moving all over the place, you might not move between firms, and that's exactly when they can increase things. Now, I'm not sure that played a big role in this part, but in terms of thinking about some of the costs of inflation and higher and more variable inflation, I think it's a potentially important role that you can get this aspect that you have less efficient parts. So that would have a greed narrative kind of possibly kind of going through the process. A second kind of try on thinking about why you might have this kind of greed narrative happening in the background is this aspect that usually, and this again kind of relates a little bit to Mark's presentation from yesterday, but when in normal times, a lot of firms, if they have cost shocks, they're going to absorb a bit in their markups, that part, and kind of absorb things. So they're kind of sharing. So you think about it as people think when firms kind of get cost shocks, there's some that are passed through and some are not, and so they're kind of sharing. When there's these big shocks, there's kind of like no sharing. It's like it all goes through and everything. Well, that would for everyone, would look like greed inflation. It's kind of like they didn't do their part. Usually they do this part, and now they didn't. And that, again, would kind of get into this kind of greed type of narrative that just the complete. Now, from the economist's point of view, you kind of go, no, they didn't do it. The markups are kind of the same on average. They just did quickly. But maybe we're not capturing that interpretation that people would have that's saying, yeah, but firms didn't participate in the difficulty of having cost shocks, and usually they would absorb some, and some of their kind of profits would have kind of reduced. So again, here that's the other kind of narrative that I wanted to give. And again, there's nothing wrong with the way they've interpreted it. They kind of decided to take the greed narrative and kind of bring in a particular type of question. But I do think there's other ways of thinking about it. And that was where kind of I would, leave my end part. When I read the paper, it's very clear. So kind of, if you want to kind of see things, and Floren's kind of the expert of this, is kind of making things as simple as possible, really giving you the insights of how you get all the pieces within the new Keynesian model and all this, and that's all fine. But at the end, you kind of think, okay, is it that we want to change the model,
or we have to put another element in the model, or really think that this is a particular case and we should think about the different ways that might have worked. Obviously, we have to work it off the data first of all and kind of figuring out in the data how much we think that is. But like I say, very clear paper, very nicely presented there. And yeah, my bottom line is I do think there's things to understand why people were feeling that there's some of that was going on. It was certainly in a lot of countries, it was a very big narrative in the background. Thanks.
Questions on the floor?
Okay, a suggestion. My interpretation of the greedflation hypothesis was there were certain markets where supply shortages suddenly came about. And then you had these customers who had this relatively inelastic demand. So what did the suppliers do? They charged higher markups because they face these inelastic demand firms. So then the question is, can you identify these markets in the data and then kind of try to do a back of the envelope calculation as to how important they would be in contributing to this overall profit cyclicality? I mean, my interpretation is you've shown a standard model can give you the cyclicality in profits. But I think that's not really what the greedflation people are talking about. So if you kind of take a look at what they're talking about, can you judge how important that is relative to the aggregate?
Very nice paper. I mean, I thought, and yeah, great discussion as well. I thought maybe you can explore also, bigger deviations from the new Keynesian setting. And Julio Rothenberg, for example, had that model on customer anger, and it's very hard to change prices. But if everybody's doing it, you can go ahead. And he has other testable predictions that he looks at.
Another way to kind of look a little bit differently at the data. So you're taking an impulse response to a shock and assuming that either greedflation is there or is not. Now, presumably the way the narrative works is that there are times in which there is more greedflation than others, and that's conditional on the same inflationary shock, or something that drove inflation. Now, it could be that the shocks are different, or it could be that somehow the response is different. And if you look back in history, greedflation has always been there. Now they call it greedflation. Back in the days, it was profiteering, and there were like laws that actually were going after people, and they were actually checking. It was profiteering from from a war, from any sort of thing that will lead them to change prices in a too optimal way from their point of view. So I think what would be nice to see is the extent to which the correlation between profits and inflation, or the response of profits to inflation or demand shock, has been changing over time. And I think if you look back in time, not just in the last 20 years or 30 years where we had one big shock and everybody rushed to call it greedflation. If you look back at history, there are plenty of episodes in which this narrative was there. And I think that there would be a lot of useful information for your analysis.
Thank you. Jim Bullard, Purdue. So when I've heard this narrative, it's often about capital share. So time-varying capital share seems like the way to address this or talk about this. So I don't know if that fits into the analysis that you have here, but firms are greedier, so capital share is rising, and that certainly seemed to have happened through this episode, and that was part of the narrative that was, or part of the data that was cited, but I didn't see it in the presentation here.
I think I may be repeating things that have been asked, but in a slightly different way. But the modeling that you did would suggest that this sort of greedflation in some sense is always there, right? In boom times, output goes up, inflation goes up, profits go up. And so the recent period isn't different in that sense. But it felt kind of different to me, and I wondered first just the facts. Was profitability more pro-cyclical this time than it has been in the past? And if so, how do we explain that? And there, I guess I think I agree with what Mark said, that this feels like a story about supply disruptions and colliding with relatively strong rebounds in demand. So I think of autos, where demand for autos was really strong, but automobile production was really difficult because you couldn't get chips. So there's just a constraint on supply. What's General Motors going to do? They're going to raise prices of cars a lot, and we saw huge auto inflation. So I guess the question is, was this time very different than in past booms? And if so, what was it that made it different?
Thank you. So, Florian, the floor is yours.
Yeah, so first of all, thank you, Paul, for a great discussion. It's not often you have one of your personal heroes discuss your papers, so it's like very particularly humbling. And I agree. I mean, there are two main points. The first one, that's about surprises. We kind of take that off the shelf. We kind of try to take what the literature identified as demand and interpret it as demand shocks. And I understand that's a very active area of research where, and I think there's something deep in what you pointed out about what could these surprises mean. And I think, but maybe I defer to Mark and Peter for more. I would like to learn more about the response from them. About the second part, that's our bottom line. And a lot of the questions that have been asked are actually in the same line, that it's true. In a sense, the bottom line of the paper is it needs to be something else. So if you want to tell a story that is a story that is a greed kind of taken literally, it's not going to be there in these models, even in the models in which profits are inherently related to distribution and to aggregate demand, and they have these distributional effects, and that sound like the natural tool to kind of take out when you get after this problem. But just the co-movements are not there. And the co-movements, and in fact the amplification of this effect. So what could be there, and I think in a sense, I'm kind of very happy because I would like this to be the takeaway from the paper, people to think about what are kind of stories, what papers can we write, what do we need to do to this model to get to tell this story, to explain this. Now, I agree that the points that have been made by Matteo and by the gentleman at the back, I don't think we know, like I have not seen a proper quantification. Has this been really any different? Is this really so much larger, the correlation between profits and inflation than in the past? Because to me, profits up, inflation up, demand up, sounds like business cycles in response to demand shocks. So it's not, so I guess the point of the paper was, can you tell that story with a model that you get this higher effect? And I agree that, so it needs to be something that so if that is true, then I think it needs to be something that's IO-ish. Silvana, I thought about the same thing, this kind of customer anger, something, the search, something that's like, or what Mark has suggested, I think is a more direct way of going after this. So these are all great suggestions, and in a sense, I mean, to me, they're like ideas for papers. So I don't know if we will write them or maybe some graduate students sitting here. But that's kind of, I guess it's also what we wanted to do with this paper, to kind of organize a little bit the debate in theoretical terms. So, thank you.
Thank you. So the next paper is by Tommaso Monacelli from Bocconi University, and the discussant is going to be Raul Minetti from Michigan State.
Okay, very good. Thank you very much for being here, and thanks a lot for having the paper in the program. Let me mention that this is joint work with Marco Bellifemine, who's a graduate student at LSE, and Rostam Yamilov, who's at Oxford. So the relatively recent macro banking literature typically focuses on the role of a representative intermediary with perfect insurance and scale invariance. That is what I would define as the cornerstone of our bank models, so representative bank models, like in the work of Mark with Nobu and the work of Mark with Peter. So this paper, in contrast, emphasizes the role of heterogeneity in intermediaries, and in particular the role of endogenous insolvency risk in the bank lending channel of monetary transmission. So in H-Bank, what we'll define as H-Bank, a heterogeneous banking occasion model, there will be a key role for the size distribution of banks. So let me, in the interest of time, summarize the main takeaways of the paper. So H-Bank delivers a significant amplification of monetary policy shocks relative to a representative bank environment. I'm emphasizing the amplification aspect because typically what you get out of the recent stream of Hank models is that monetary policy shock, the effects of monetary policy shocks are dampened. Okay, so here we get amplification, and the key element that leads to amplification is the high concentration of insolvency risk in the left tail of the size distribution of banks. So where you have small banks which have low net worth are close to the leverage constraint, and for which the insolvency probability is higher. In H-Bank, we break the so-called as-if result. So a key sufficient statistic in our environment will be the lending elasticity. So how much for a given bank capital changes as one additional unit of net worth is given to the bank. So the lending elasticity of the average bank in H-Bank is higher, significantly higher, than the lending elasticity of the representative bank in our bank. So heterogeneity matters, okay? And this is essentially, again, due to this non-linearity, the high concentration of small banks with the high insolvency risk on the left tail. In our environment, there is a trade-off between macroeconomic stabilization and financial stability. That is a key element of the model. So higher real interest rates can lower demand for stabilization purposes, but this is going to raise the ex-ante and the ex-post cost of bank default. And so this is going to generate this dilemma between macro stabilization and financial stability. In H-Bank, we have this feature whereby large banks are too big to fail. Okay, this is going to be obtained in the model by having that default costs are increasing in the size of the bank, in particular in the net worth of the bank. So H-Bank is an environment where specifically, inherently, microprudential policies can be studied in opposition to macroprudential policies. And what we show in this environment is that microprudential policy targeting large banks, precisely because large banks are too big to fail, is welfare increasing relative to an environment where policies are macroprudential, so they target all banks. I will mostly show results in a perfectly competitive environment, but we also in the paper have an extension to monopolistic competition on the deposit side of banks. So with the extension on deposit market power, we're going to deliver endogenously an imperfect pass-through of interest rate changes, policy changes on deposit interest rates, and this imperfect pass-through is going to dampen the transmission of monetary policy shocks. Finally, we're going to look at banking microdata, and so we will emphasize that in response to monetary policy shocks, heterogeneity by size will be very important in the response of bank assets, okay, and in the response of default risk. So justifying why in the model we take the approach of heterogeneous banks in size. So the model, there are capital producers in the model. So there is a one-to-one bank loan-to-capital conversion technology. So capital producers are perfectly competitive. Let me mention QJT is the loan rate, so the interest rate on a particular loan coming from a unit mass of banks. The rate of return on capital, aggregate rate of return on capital, is arcane. Households are relatively simple. They inelastically supply labor. There is perfect deposit market competition and deposit insurance. And the key takeaway from the households problem is that households can save in two different assets: a riskless and homogeneous riskless fund, and deposits. But at this stage, at least in this presentation, deposits and mutual funds are perfect substitutes. So the interest rates on deposit coincides with the homogeneous interest rates on the return on riskless funds, which is also going to be the policy rate. So the heart of the matter is banks' heterogeneity. So we have a unit mass continuum of banks where the return on loans, return on assets, RTJ for Bank J has two components. So one component is the aggregate return on capital, and another component is an idiosyncratic term, kappa J, which evolves in response to, which evolves according to an AR1 process. The balance sheet of Bank J is standard, so we don't have in the simple version we don't have bank reserves. So deposits plus net worth is equal to the value of assets, and the law of motion of net worth, right, is given by the return on asset minus the cost of deposits minus a non-interest cost of adjusting the balance sheet, which is is going to be a sort of a pseudo financial friction in the model, and this cost is going to play an important role when it comes to aggregation or lack of thereof. Insolvency risk at the bank level J, bank deposits are fully insured. On the one hand, there is an ex ante probability of default phi J, which is the probability that net worth may fall into negative territory. There is a bank-level convex default cost, so this is important to generate the too big to fail characteristic of the model. So gamma J is a convex and increasing function of net worth, and this gamma J is also a function of the default probability, endogenous default probability phi J. So big gamma is the integral of this bank level default cost, and gamma is gonna affect net output. So default is costly at the individual bank level, increasingly so in net worth, and this has aggregate implications in the resource constraint. Following the work of Gertler and Karadin and Gertler and Kiyotaki, we also model a financial friction which is a moral hazard friction. So in this environment, as it's standard in other models, there is so the possibility for the banker to run away with the assets, right? And so in order to act against that temptation, you can show that an incentive constraint must hold, whereby the value of the bank's asset cannot exceed the bank franchise value. Notice two things. First of all, that this leverage constraint is endogenously binding at the level level of bank J, and that this lambda t leverage parameter is going to be time varying because it's going to respond to the definition of prudential rules by the central bank. So in a nutshell, this is a bank J maximization problem. So this is the value function for an individual bank J, and the constraints are the net worth accumulation constraint, the balance sheet constraint, the occasionally binding leverage constraint, and then the definition of the return on assets with the idiosyncratic uninsurable kappa J shock, and then the equivalence between deposit and policy rates. The key takeaway that I want you to have from this slide is that we break scale invariance. Okay, so relative to the R bank model, a la Gertler and Karadian, Gertler and Kiyotaki, right? We cannot aggregate, and so we have to keep track of the entire distribution of banks, and this is due to two key elements: the fact that we have an insurable idiosyncratic risk at the level of each bank, and second, that we have convex adjustment costs in the balance sheet. So methodologically, we solved the model in sequence space following a very recent literature in Hank models. So in a nutshell, what this implies is that all equilibrium sequences in the model can be expressed as a function of two primitive input sequences, capital and the monetary policy rate. So starting from a stationary distribution of bank net worth, you can show that there is a lending function, which is a function of the primitives R and K, and then write a market clearing condition whereby lending is equal to capital. So if you then take a first order perturbation around this market clearing condition in credit markets, you can actually show that that this is the expression, and that the effect of monetary policy changes on capital are mediated by two matrices of Jacobians. One is this FR matrix, which is going to capture the partial equilibrium direct effects of monetary policy changes. So holding partial equilibrium because we are keeping constant the level of capital, whereas the matrix F of Jacobians is going to capture the indirect effect of policy changes when we allow, in general equilibrium, aggregate capital to change. So in the remaining of the talk, I will distinguish between direct and indirect effect of policy changes and do a decomposition of the two elements towards generating or not generating amplification of policy shocks. Let me skip the calibration in now turning to the results. Okay, let me first show you a key snapshot of the stationary distribution in the model. So in red here, you see the bank asset distribution, which clearly show a high mass of small banks on the left tail and a significant long tail of large banks. That is represented in red. In black, then it's plotted the lending elasticity, which is decreasing in size. So this is saying that there is quite a degree of heterogeneity in lending elasticity, which is the partial of derivative of capital with respect to a unit of net worth, right? And so this is high, very high for small banks and decreasing in size, relatively lower for large banks. So think of the lending elasticity, if you want, as the analog in this H-bank model to the marginal propensity to consume in heterogeneous agent New Keynesian models. So this lending elasticity is particularly high for small banks, which are close to the constraint, right? They have low net worth and they're close to the leverage constraint being binding. Finally, the picture shows you the average lending elasticity in blue in a corresponding R-bank model with a representative bank, and the average lending elasticity in our H-bank environment. So you see that the average lending elasticity in H-bank is higher, importantly, than the average lending elasticity in the corresponding representative bank model. And the intuition right here is that we have this high concentration on the left tail of high lending elasticity for small banks. So this strong nonlinearity makes the representative bank in a heterogeneous bank environment different from a representative bank in a representative bank environment. As I said, insolvency risk is endogenous in the model. So again, this graph shows you the log bank asset distribution in red, right, with a similar flavor than before. And in blue, it shows you the distribution of bank insolvency risk, right? So, and again, here we see that a bank insolvency risk is significant and high in the left tail of the distribution, where banks are small, right? And then decreases significantly as we look at larger size for banks. So insolvency risk is concentrated in the left tail of the distribution and evolves endogenously. As I said, each bank in this specification has a too big to fail feature, right? This graph shows you in blue the insolvency probability once again, right? So particularly high at low levels of assets and decreasing in assets. But in red, it shows you the behavior of the default cost, okay? As in accordance to the formalization that I showed before, right, we see that default cost is relatively low for small banks, even though insolvency risk is high, okay? And then the default cost rises, especially for banks in the top 10% percentile. So the default cost is increasing in net worth. Okay, let me now study the effects of monetary policy changes. So this graph shows you Jacobians of the direct monetary policy effect. So on the left side, you have the corresponding R-bank model. In the right panel, you have our H-bank model. So each line here represents a column of the FR matrix that I showed before, so the matrix containing the Jacobians of direct monetary policy effects, holding constant the level of capital, and this is done for each period at each horizon. Okay, so as you can see, right, the Jacobians of direct monetary policy effects are negative. Okay. Pointing to the fact that policy tightenings are contractionary for bank lending, okay? But in comparing H-bank with R-bank, you see significant amplification. So policy Jacobians in general at different horizons are more strongly negative in the heterogeneous bank environment. So this points to the fact that the amplification of monetary policy shocks on bank lending in H-bank may especially come from the direct effect of monetary policy. So the direct and partial equilibrium effects. In fact, as this picture shows, if you compare in R-bank and H-bank, the general equilibrium responsive of bank lending to aggregate capital, so think of each column here as the intertemporal marginal propensity to lend. So the Jacobians, so each entry is a Jacobian describing the derivative of bank lending with respect to capital. So remember, now we are looking at indirect general equilibrium effect, so we allow capital to change. And so in this, Jacobians are negative, and why? Because if a policy tightening induces a fall in capital, this leads to, for decreasing returns, to an increase in the return on capital and an increase in lending. So there is a negative Jacobian in the response of lending with respect to the change in capital. The bottom line here is that these Jacobians are negative. This general equilibrium indirect effect Jacobians are negative, which means that the general equilibrium response is a dampener of shocks. So to summarize, right, here are impulse responses now, standard impulse responses to a monetary policy shock for bank lending and inflation. Oh, by the way, I didn't describe the new Keynesian block of the model because it's totally standard in the interest of time. And you do see in the comparison between R bank and H bank, right? You see the amplification in the response. You see the amplification in the response of bank lending in H bank, and this graph shows you for R bank and H bank the composition between the direct in red, the direct effect of policy changes, which are negative, and the indirect general equilibrium effect, when we allow also for capital to change and the effects on capital on bank lending. So the direct effect is negative, whereas the indirect general equilibrium effect is positive, but the direct effect of monetary policy changes are significantly larger in size. So this leads to a contraction in lending, both for R bank and H bank, but as you see, the red area is larger in H bank, and so the direct effect of monetary policy is the one that contributes to the amplification of monetary policy shocks in our environment relative to a representative bank environment. So this figure shows you that heterogeneity is relevant. Okay, this shows you across size the impact response of to a monetary policy shock of bank lending. So being particularly large for small banks, so across the initial size percentile, and relatively smaller for large banks. And we're going to test this prediction in the data. So whereby small banks lending actually reacts more strongly to monetary policy shock. And we're also going to test the implication for default risk. So default risk here is the impact response of default risk is particularly strong for small banks, and it tapers out as the initial size percentile progresses. And again, this is another testable prediction of the model whereby default risk for small banks reacts more strongly to monetary policy shocks. As I said, H bank is an ideal environment to compare micro versus macro prudential policy. So in a nutshell here, I'm showing you the effect on welfare of changing a parameter in the prudential rule, which is basically a systematic rule that whereby the leverage parameter in the leverage constraint responds to the level of capital, right? And here you show that the effect on welfare for two types of shocks and for three types of policies. In black, you have a microprudential policy only affecting large banks. In green, you have a macroprudential policy affecting all banks. And in red, you have a microprudential policy affecting only small banks. And for both types of shocks, here the takeaway is that a prudential policy that responds, that targets only small banks brings very little welfare improvement, whereas a prudential policy that targets only large banks goes a long way in replicating the same effects, the same welfare effect of a macro prudential policy targeting all banks. Okay, so microprudential policy that targets large banks as significant welfare improvements. Let me jump at the expansion of deposit market power and conclude with with empirical evidence. So we look at call reports data, so micro banking data, and measure monetary policy shocks with the high frequency identification procedure. So this first shows a linear projection of the monetary policy shock on real total assets on the growth on the left side, and the key term to look at is this size interaction term between the monetary policy shock and a dummy that indicates banks in the top 20% bank size distribution. So this coefficient beta H is the coefficient that is of interest for us. This coefficient, as you see, is significant and positive, and so this means that larger top 20% banks contract assets by less than small banks in the bottom 80% of the distribution. So this is consistent with the feature of the model whereby we have heterogeneous lending elasticities in the same model. Small banks assets react more strongly to monetary policy contractions. Then we look finally at default risk. So we construct a measure of a proxy of default risk as the inverse of the z-score. So that's the return on assets plus inverse leverage over the standard deviation of the return on assets. So the ZIT at the bank level is going to be our left-hand side variable. So the raw data show that insolvency risk is particularly high for small banks, okay, in the data, and this is exactly as in the model, okay. And then we run a panel linear projection estimating the effect of a monetary policy shock on the change in the z-score. And then we estimate the heterogeneous response, again interacting the monetary policy shock with the dummy indicating the top 20% bank size distribution. So we are interested then in the psi h and in the beta h coefficients, and this is what the results say. So on the left side you see the estimates of psi h, basically indicating that on average default risk increases significantly to a contractionally monetary policy shock, and then we see the beta h coefficient being negative, which basically means that that default risk rises significantly more for small banks. Again, evidence in the data that is consistent with our model, and that justifies why looking at the heterogeneity across banks is of significant importance. So here we look at markdowns, but let me skip this part. So let me conclude. So we provide with HBank a tractable analysis of the general equilibrium effects of monetary policy with heterogeneous intermediaries, decomposing the effects between direct partial equilibrium and indirect general equilibrium. Sort of, if you want, the analog in our environment of the Keynesian cross in Hank models. So we point out that heterogeneity in insolvency risk by bank size is a pervasive feature of the monetary transmission mechanism, and provide empirical evidence that supports this mechanism. Thank you.
Okay, thanks a lot. Thanks a lot to the organizers for asking me to discuss this very interesting paper, also in general for the conference, very nice conference. So Tommaso did a great job in describing the paper, so I'm going to be pretty short in summarizing the framework and the main results. Sorry, yes. The framework and the main results. So as Tommaso described, the paper proposes an Hank model with nominal rigidities and heterogeneous banks, which comprises 4 blocks: households that hold the deposits and supply labor and consume, capital producers that borrow from banks, firms comprise retailers producing intermediate goods with capital and labor, and final producer that aggregates intermediates, and finally banks. So banks are obviously the core sector of interest of the economy. So banks fund capital investments holding firm securities, and following Gertler and Carradi pioneering work, they face bank capital constraints due to limited commitment. And there is also a zero net worth constraint in the sense that negative net worth leads to costly bank default, with the default risk, as I'm going to discuss in a couple of minutes, eroding banks' ex-ante returns. Depositors are insured here. So the key feature of the model, as Tommaso said, is that there are capital return shocks that are bank-specific, and this generates a rich distribution of banks' net worth size, which matters in the sense that due to this nonlinearity in the net worth accumulation, as Tommaso said, you can interpret this as operating costs or monitoring costs that are present in the bank net worth accumulation law. This distribution matters at the level of aggregation. Entry is akin to Gertler and Carradi in the sense that defaulting bankers are replaced immediately by new bankers. I'm going to discuss this in a couple of minutes. So the paper is very interesting. The model yields tractable expressions for effects of monetary policy shocks and regulatory shocks. And the key result, as Tommaso said, is that there is a larger shock amplification in this heterogeneous bank model relative to a representative bank model, which is generated by this heterogeneous elasticity of lending across the distribution of bank size. As I said, the paper is very interesting, highlights in a very neat way the importance of bank heterogeneity. It does so in a very tractable, transparent framework. So I think it is going to be very impactful in a sense it can be used in many contexts. Bank heterogeneity matters a lot. In fact, the amplification effects, especially for monetary policy shocks, are very relevant, less so for capital regulation shocks. And this matters especially through this bank default channel, which is the key transmission mechanism. It's something that is quite overlooked in general in the literature, perhaps because we are generally tend to think that bank defaults are concentrated around big spikes, right, around big crises. So, for example, here, if you look at the number of bank failures in the great financial crisis was about 150 in both 2009, 2010 in the United States, versus only 3.5 on average bank defaults per year in the decade between 2014 and 2024. So policy implication, monetary authorities should account for default channel. So I'm going to concentrate on four main comments. As I said, the paper is very well done. So as in the previous discussion, I'm not going to really pick on single aspects because the paper is very well executed. So I'm going to ask actually to Tommaso whether the model can accommodate additional mechanisms that have been emphasized in the literature, and this might be also useful for applications of the model. So here I reproduce the key equation of the model. Actually, Tommaso presented a stripped-down version of this, which incorporates these Jacobian matrices with the derivatives of the lending and the supply, and the default. The L stands for lending and S stands for default, to, in this case, to a shock to the interest rate, policy interest rate. So the first comment I have is about the whole paper focuses on this distribution of size, which obviously is very important. But of course, we also know that there is a second type of distribution that is also very relevant, which is leverage distribution. So banks, and these banks differ quite relevantly for the leverage. And here I sort of drew data from Orbis Bank Focus for four major countries, United States, France, Italy, and Germany. What we can observe here is that not only there is a large heterogeneity in terms of size, but a larger heterogeneity in terms of leverage ratios, in particular reporting on the y-axis, the tier 1 ratio of banks. And we can see that there is a quite relevant heterogeneity across banks in terms of the capital buffers they hold. And in particular, these two distributions of tier 1 capital and assets are not independent of each other. So in particular, smaller banks in general tend to hold larger capital buffers. This is particularly evident in the case of Germany, in the case of Italy. So in all cases, we see some a negative relationship between Tier 1 ratio and assets, and it's particularly evident that, especially in Germany and Italy, it's interesting, different from countries, small banks tend to hold large capital buffers. So the first question I have for Tommaso, whether in the future, not necessarily in this paper, obviously, this aspect of incorporating capital buffers can be introduced in this type of model. It's an open question because, of course, the model is in the tractable way. So we have, again, large evidence that business models of small, large banks are different. Why small banks tend to hold the larger capital buffers? Well, because they face different types of funding shocks relative to large banks, or because they have different types of risk, and that's typical. So this is going to be also important for implications for policy in terms of the effect of countercyclical capital buffers, once we take this into account. Second type of comment I have is about, actually I expect this to be more difficult, I would say. If we observe the concentration in banking systems, in some countries, we observe really banking systems characterized by a bimodal distribution, with the top 3 banks accounting in some, for example, Euro area countries for 70 or 80% of loans, and then a large number of very small banks. So my question is whether in the future this type of framework can incorporate some sort of more strategic behavior on the size of the large banks. In other words, for example, Corbet and Erasmus have this interesting paper in which there is the large banks play a sort of Stackelberg game, so they have sort of like a first move advantage over the small banks, and they incorporated the reaction function of the small banks when deciding. So this is important because the large banks, in their paper, they expand lending when the small banks approach most small bank fail in order to capture the market share of the small banks. And in some sense, this sort of like offsets partially, right, for the response of the small banks. So my question is, in a sense, are a bit slightly overestimating, at least for some countries. This depends a lot on the distribution of banks. In these countries in which we have this large bimodal distribution, are we overestimating the effect of the default channel? Let me go to the last 2 comments because I'm almost off of time. The third comment I have is about the stencing margin. It's about a bank entry. So in the model, in order to keep things tractable, the bank entry is model similar to Gertel and Karadi or Gertel and Kiyotaki, which in that case, it's very makes a lot of sense. In this context, I'm wondering whether in the future we can account a bit more for the effect of bank entry, because here banks are immediately replaced by new bankers that have the average size distribution of the existing banks, or the defaulting banks. But we know that a lot of the effects of this type of defaults can be sluggish response of credit creation. So credit creation, we observe, is much more sluggish than credit destruction. So when these defaulting banks, and here there's a quote from the ECB Financial Stability Review, so this idea that when firms are heavily rely on banks in the proximity of default, then existing source of financing with alternative ones, establish new credit relations is very difficult. So this limited substitutability is very important. So I guess, endogenizing entry might be perhaps feasible in the future, might be not so difficult, and might sort of give this extra kick. Actually, this would be probably reinforce your mechanism, I expect, because it probably makes it even more difficult in a sense, more larger the default channel. And the last thing I want to ask Tommaso, more in general for future research, in fact, is about the way this default risk impact on banks' decisions. Because here, essentially what happens is that this default risk directly erodes the ex-ante returns for banks to lending, the lending appetite of banks. And I have 2 sort of sub-questions here. One is, actually Tommaso presented even more recent version, in which there's this default cost that is convex in the size, which is actually a very nice new feature. The first thing is how much we tend to give importance to these parameters for the default cost. So I think in the calibration, you take the median of the default cost across banking crisis. But we observe the distribution of banking costs is there's a wild variation. So I'm wondering, but this is more like a question for the parameterization. But the more important question, actually, Tommaso was already hinting at that, is who bears this cost in the end, right? So because here, in a sense, the banks are incorporating and internalizing all the effects of this default, while we know that a large fraction of depending on the resolution systems, the large fraction of these costs are held by the tax system, the equity holders in general, and this, of course, leads to an important policy question. So can we analyze in this type of framework resolution policies besides the macroprudential policies? So I think it would be very interesting in the future if in other papers we can also include, this might also perhaps, in this paper, maybe not so difficult, to include the resolution policy, so bail-in versus bailouts. So I think this is probably feasible in this type of framework, although in a stylized way. And actually this could be, allow us to understand how this resolution policy can also magnify or moderate the impact of the default channel or the shocks. Anyway, it's a very, very, very interesting paper, very interesting framework, very tractable. So I really enjoyed using it, and I think in the future this can be usable in several applications for analysis of various policies.
Thank you. We are a bit behind time, so let's try to make it one or two questions, and please state your name and affiliation.
Hello, Gianluca Benigno, University of Lausanne. I think it's a very interesting paper, and I have a couple of questions. My understanding is that you're putting in these constraint in terms of the constraint of Gertler, Karadi, Kiyotaki, and then there is also the default condition. And I'm wondering if you could, maybe also in future work, spell out what happens if you have only one or the other one. I think it would be interesting to see how things work. And the other comment I have is in terms of what you measure as a bank, the lending elasticity. It seems to me, if I understand correctly, it's a bit mechanic what happens there in the following sense, because of the simplicity of the asset side of the balance sheet of the banks that you're modeling. Ideally, I think it would be interesting to have a meaningful choice from a bank perspective in terms of when to lend. And there you have just one asset, if I recall correctly. So I think it would be interesting to actually explore that. And the other aspect, for example, which is related to current issues, is probably to insert reserve there. Because one of the issues, for example, if I'm not mistaken, in the US is indeed the distribution of reserves across banks and try to determine when to stop the balance sheet reduction. So I think that would be interesting. But very good work, thank you.
Very interesting paper. Immo Schott from the board. I have a question about this idea of microprudential policy. So I didn't understand one part of your argument. I mean, it seems to be true that in the data I can see that there's heterogeneity in the lending elasticity and the default risk, but it seems to me like the fact that the default rate is, default cost is convex. This is what's driving the rationale for the microprudential. I didn't quite understand how you see this in the data. Like, what is there in the data that tells me that these are in fact convex?
Thank you. Tommaso, could you please take the floor?
Okay, thank you. Thanks all for the questions, and thanks Raul for the very insightful discussion. So you made 4 points. Let me address this quickly. So you first referred to the fact that in the data there is a significant heterogeneity in the leverage ratio. So we have a leverage distribution, and small banks actually hold larger capital buffers. So in a sense, we do have we do not in a sense. Actually, we do have implicitly a leverage distribution also in this context, and as far as capital buffers is concerned, in the absence of reserves, okay, I'll turn to this later. There is a precautionary accumulation of inside equity in the model, precisely because the leverage constraint is occasionally binding. So in the anticipation of this leverage constraint to be binding in the future, there is this precautionary motive. So in a sense, there are capital buffers that are endogenously built in the model, but these are buffers of inside equity, so of net worth. Again, in the absence of reserves, but I'll turn to this. You said that looking at features of the market, we could recognize most likely sort of my bimodal distribution. So that would make you think that a market structure more suitable for representing a bank heterogeneity is an oligopoly, as opposed to possibly a model with the monopolistic competition, which is one of the models that we study in the paper. And again, it is we don't go as far as modeling an oligopoly equilibrium. This is done in Corba and Erasmo. This is debatable in a sense. It's true that an oligopoly model may, a structure with an oligopoly model may end up affecting the size and the distribution of these lending elasticities, right? But what we have in the model is small and large banks. We have a high density of small banks and very few very large banks, in a sense. So we are not very far from sort of a bimodal distribution in a sense, but of course we are not internalizing strategic behavior, which make the studying of the equilibrium much more complicated. Then you have two very useful and interesting suggestions. One is endogenous entry. So this we can accommodate very easily, right? So going beyond also the sort of the Gertler and Carrari model by allowing a process of entry, which may be more, as you suggest, more in line with what we observe in the data, whereby new credit creation by new banks is sluggish, right? So banks are not immediately replaced in their lending relationships, right? So having sort of a smoother and more sluggish process of entry of banks can be easily accommodated in this environment. And also your other suggestion, which is also very interesting. So your question is who bears the default costs, right? So in our paper now, default costs have a macro implication. So we build on papers by Leuven et al. That actually show that the default is costly. In our characterization, bank defaults are costly and increasingly costly in net worth, and this affects, to first order, it affects the composition of output. But again, you suggest that more in line with the reality, one could analyze the resolution policies, okay? And again, each bank would be absolutely an ideal environment to study bail-in versus bailout policies and study also more in general resolution policies and the costs that are attached to those. So Gianluca, yes, we could study the implications of separating the default condition from the leverage constraint. Okay, so that we haven't done that, but this can be easily done. Thanks for this suggestion. And then you suggest that the balance sheet is relatively simple. It is relatively simple in the version of the model that I presented here in the interest of time, but we have a section of the model where we have reserves precisely, and so that makes the portfolio choice of banks more meaningful on the asset side. And then, yes, it's the question in the back. So yes, microprudential policies are targeted on large banks are welfare improving precisely because we incorporate, if you want, in a relatively ad hoc way, a too big to fail characteristic of the model, whereby default cost is larger for larger banks, and this has larger macro implications. So that is why we wanted to characterize microprudential policies as opposed to macroprudential policies, because in Basel III that this is what is done. Okay, so capital requirements are higher for larger banks relatively to smaller banks. So without the increasing and convex default costs, what would be the optimal policy in this prudential policy in this environment would be to target small banks, because the small banks are more risky. Okay, so they are closer to their leverage constraint, and they have a higher probability of default. But we invert that, right? We make default cost larger for larger banks, because in reality this is what we observe, right? And so that is why a microprudential policy that targets large banks gives you a welfare an effect of welfare enhancing. Okay. But other than that, I think I answered all questions.
Thanks.
Thank you.
Thanks. So thanks a lot. So I'm giving the floor to Oreste Tistani, who is going to introduce the keynote speaker.
Okay, it is a pleasure for me to introduce the ECB Executive Board member Isabel Schnabel, who is here with us today. Isabel Schnabel's early career is as an academic economist. She was a professor of financial economics since 2015 at the University of Bonn, and working mainly in the fields of banking, international finance, and economic history. Between 2014 and 2019, she was also a member of the German Council of Economic Experts, which is a prominent economic advisory body in Germany. Isabel Schnabel was appointed to the Executive Board in January 2020, and is by now widely regarded as, and I quote here from the financial press, an influential voice on the ECB's 26-member Governing Council. Her responsibilities at the ECB include specifically the field of market operations, and in this capacity, she oversaw the recently concluded review of our operational framework, which is a 15-month-long process to determine how to safeguard the smooth implementation of monetary policy as reserves become less ample. But perhaps more importantly, from our perspective today, here, she remains curious about and supportive of economic research. So please join me in welcoming Executive Board member Isabel Schnabel to the floor.
Good morning. Thank you so much for the kind introduction, Oreste. And thanks to the organizers for having me at this excellent conference, which actually is a great collaboration by the Federal Reserve Board and the ECB. So today I would like to talk to you about the future of inflation forecast targeting. And as you, of course, very well know, since the early 1990s, many central banks worldwide have adopted a framework for monetary policy known as inflation targeting. And in this framework, central banks announce a target rate or range for medium-term inflation, typically 2%, and adjust short-term interest rates to steer actual inflation towards the target. And the rise of inflation targeting was a response to the turbulent inflation episodes of the 1970s and 1980s, when most central banks were only loosely committed to price stability. Inflation targeting was an acknowledgement that monetary policy was most effective when it was given a clear mandate. Inflation targeting went hand in hand with the discernible increase in central bank independence and transparency. Central banks operating outside the influence of political election cycles played a critical role in making inflation targeting credible and feasible. Political independence, in turn, required central bank officials to publicly explain and justify their actions as a manifestation of democratic accountability. Greater transparency was also needed to operationalize inflation targeting. The reason is that, given the lags in monetary policy transmission, central banks can only affect future inflation. And as such, inflation targeting has typically been formulated in terms of inflation forecast targeting, where the central bank adjusts policy to offset deviations of its projection of medium-term inflation from the target. Inflation forecast targeting requires the central bank to provide a coherent narrative to the public that links its current decisions to the way it expects economic activity and inflation to evolve over the policy-relevant horizon, typically over the next 2 to 3 years. Inflation forecast targeting has been implemented in different ways across the central banking community. The Reserve Bank of New Zealand, Norges Bank, and Sveriges Riksbank, for example, publish inflation forecasts that are conditional on a policy rate path consistent with delivering inflation in line with the target over the policy-relevant horizon. Similarly, the US Federal Reserve System provides policy rate forecasts through its summary of economic projections. While these interest rate paths do not constitute a formal commitment on the part of policymakers, they do provide forward guidance, which potentially raises the ability of central banks to manage interest rate and inflation expectations. Other central banks, and this includes the ECB and the Bank of England, publish inflation projections based on financial market participants' expected path for short-term interest rates. And in this case, the public typically expects policy to deviate from the market-implied path if the medium-term inflation forecast is inconsistent with the target. At the ECB, the link between policy decisions and inflation projections was deliberately diluted, as projections are owned by staff and not by the Governing Council. In practice, however, inflation projections, whether they are owned by the committee or not, have over time become the main communication vehicle for most central banks worldwide, and this includes the ECB. Inflation targeting has generally been a success. Before the pandemic, inflation had been low and stable over 3 decades, as you can see on the slide. And by providing a clear yardstick for the public to measure the central bank's success in delivering on its mandate, inflation targeting has made monetary policy more transparent and more accountable. Yet, while changes to monetary policy frameworks had been important in bringing about benign inflation outcomes since the late 1980s, there is broad agreement that during that period, central banks benefited from a decline in macroeconomic volatility and globally subdued price pressures. In this environment, even systematic forecast errors by central banks had only limited impact on their credibility. In the euro area, for example, and you can see that on the left-hand side, HICP inflation, excluding energy and food, these are the dark blue bars, was persistently overprojected between 2013 and 2019. But since these forecast errors were small in absolute terms, and the public was not particularly concerned about a limited undershooting of inflation targets, the appropriateness of central banks' broader policy frameworks was not questioned, and neither was their ability to maintain price stability. However, the pandemic changed all of this. Inflation forecast errors rose measurably and remained persistent. This was not because central banks were particularly bad at projecting inflation. After all, and you can see this on the right-hand side, significant forecast errors were made by professional forecasters and international institutions alike. Rather, it was because the size of the shocks hitting our economies increased sharply, with some of them entailing fundamental structural changes to the economy, making inflation forecasting an extremely difficult undertaking. These forecast errors, in turn, arguably, contributed to central banks' delayed reaction to the surge in inflation. Central banks are currently trying to draw the right lessons from recent experience. Perhaps the most important one is that the post-pandemic surge in inflation has validated rather than refuted the inflation targeting framework. Despite inflation often reaching double-digit levels, long-term inflation expectations have remained broadly anchored around 2% across advanced economies, as you can see on the slide. This is a strong vote of confidence in the central bank's determination and ability to restore price stability. By keeping inflation expectations anchored, central banks managed to significantly reduce the persistence of inflation, thereby helping avoid the output losses that had been necessary in the 1980s to bring inflation down from elevated levels. A second area of reflection relates to the role central bank projections should play in calibrating and communicating monetary policy. In response to the outbreak of the pandemic in 2020 and the Russian invasion of Ukraine in 2022, the ECB adjusted the way it presented and used economic forecasts in its decision-making process. Alternative scenarios and extensive sensitivity analyses complemented the baseline and helped to convey the considerable increase in uncertainty regarding the future path of the economy. In addition, in early 2023, when interest rates had already been raised considerably, we clarified that the large prevailing uncertainty regarding the medium-term inflation outlook required a data-dependent approach to monetary policy, where the observed dynamics of underlying inflation and the strength of monetary policy transmission would serve to cross-check the inflation projections. These measures effectively marked a departure from textbook inflation forecast targeting. As projection errors, even over short horizons, rose to unprecedented levels in the wake of the recent energy crisis, the baseline scenario was no longer a sufficient summary indicator for calibrating and communicating monetary policy actions. Breaking this link was not entirely new. Already in 2019, following a long period of subdued price pressures, the ECB adopted rate-forward guidance that conditioned its future actions not only on the inflation outlook, but also on the actual progress in underlying inflation dynamics. And this was also intended to ease financing conditions further. But in the high inflation period, the stakes were arguably higher. Consider the June 2022 Eurosystem staff projections as an example. These projections were the first opportunity to fully reflect on the impact of the war in Ukraine on activity and prices in the euro area. They foresaw inflation to average 3.5% in 2023, almost 2 percentage points below the actual outcome of 5.4%. with interest rates being markedly higher than expected in 2022. The question we are facing today is whether, in view of the normalization of forecast errors, central banks should return to the strict inflation forecast targeting that prevailed most of the time before the pandemic. And let me make clear that this question is not about whether central banks should use model-based forecasts or not. Good policy making will always have to rely on models about how the economy works and how our policy decisions affect central macroeconomic variables. In other words, models are indispensable. It is not about whether central banks should be forward-looking either. Again, there is no question that the central bank must focus on medium-term inflation. It should not form its decisions by looking only in the rear-view mirror. Instead, the question is whether we should give the baseline projections a weight in policy calibration and communication so that deviations of projected medium-term inflation from the target would almost mechanically trigger expectations of policy adjustments. Clarity on how central banks intend to conduct policy over the medium term is certainly important for predictability and hence transmission. During the past few months, financial markets have repeatedly repriced the future expected path of short-term interest rates in different directions, as you can see on this slide, thereby affecting actual financing conditions. These swings do not necessarily imply a lack of understanding of central banks' reaction functions, as there was often a wedge between the medium-term inflation outlook expected by investors and central banks. But they do suggest that investors expect policymakers, at least for now, to continue to pay more attention to actual inflation outcomes or to the tails of the forecast distribution than what a typical inflation forecast targeting central bank would do. Putting less weight on the baseline forecast in the decision-making process has two drawbacks. First, it may lead to excessive volatility if financial markets overreact to individual data prints. The sensitivity of short-term interest rates to surprises, to macroeconomic surprises, is currently at elevated levels, as you can see on this slide. Second, it could increase the risk that, should the central scenario materialize, monetary policymakers may have waited too long to adjust the stance in their search for sufficient confidence. In the current context, being behind the curve can be costly in terms of lost output. At the same time, despite the reduction in forecasting errors, there are a number of reasons suggesting that it could be prudent to continue to consider the baseline forecast as just one input to policy decisions, or to consider other changes to the framework, including in communication, even as inflation continues to fall. First, while central forecasts are easy to communicate, they convey a false sense of precision. At the ECB, significant resources are constantly devoted to improving the set of models used for forecasting. After the global financial crisis, for example, credit and banking gained prominence in our workhorse models. More recently, we made important changes to the assumptions about the pass-through of energy prices to consumer prices in the presence of large cost-push shocks. But no matter how much we improve our models, projections will always be surrounded by a significant degree of uncertainty. Take energy inflation as an example. During the recent inflation surge, errors in the conditioning assumptions for energy prices based on markets' futures prices explained on average about 3/4 of the Eurosystem and ECB staff projection errors for inflation 4 quarters ahead. While other forecasting techniques, such as using random walk assumptions, may sometimes yield superior outcomes, there is no one method that consistently outperforms the others. Uncertainty is even greater when estimating and forecasting unobservable variables, such as the output gap or the natural rate of interest. While being of first-order importance for assessing inflationary pressures or the restrictiveness of monetary policy, neither concept can be pinned down in real time with any reasonable degree of precision. In addition, forecasts of models estimated on historical time series tend to revert to the mean towards the end of the projection horizon. This mean reversion is an integral part of inflation targeting, based on the assumption that long-term inflation expectations are firmly anchored at target. This approach is reasonable for as long as this assumption is confirmed by surveys and market prices. But when shocks are large and persistent, and inflation expectations are at risk of de-anchoring, mean reversion can make monetary policy pro-cyclical. Consequently, there is a risk that policymakers react too late when the economy is hit by a more persistent inflation shock, and that policies loosen too early when inflation falls again. In other words, mean reversion introduces an easing bias during inflation shocks and a tightening bias during disinflation shocks. Biases may also occur due to the incremental approach typically used in forecasting, when new projections start from the most recent vintage. This may lead to an excessive degree of inertia, especially at turning points, which models typically have a very hard time anticipating, given the lack of tools to identify changes in the trajectory of key economic variables in real time. The use of judgment can partly compensate for such shortcomings. However, the line between technical and policy judgment is often blurred. And in a large monetary policy committee, such as the Eurosystem, where the projection process has deliberately been delegated to staff, policy judgment should ideally be the outcome of deliberations rather than an input to the baseline scenario. Second, inflation forecast targeting typically relies on the assumption that supply-side shocks are transitory, meaning changes in economic activity result predominantly from changes in aggregate demand along a balanced, steady-state growth path. As monetary policy works mainly on the demand side, it can be optimally adjusted to offset the impact of expected changes in activity on prices and wages, taking into account the lags in policy transmission. This is the divine coincidence at work. However, these might not be the kind of conditions facing central banks in the foreseeable future. Last year, in her speech at the Jackson Hole Symposium, ECB President Christine Lagarde laid out the significant potential for pervasive and persistent shocks to affect the supply side and hence wages, inflation, and interest rates. Examples are climate change, the rapid aging of our population, and the rise of generative artificial intelligence. In addition, the nature of globalization is changing fundamentally. Not only are firms reconsidering the robustness of their value chains in the light of significant geopolitical uncertainties, they are also facing fiercer global competition in many areas. China, in particular, is transitioning away from being the world's manufacturing base towards becoming a major player in high-tech industries, such as electric vehicles. Over the past few years, as you can see on the left-hand side, Chinese firms have rapidly gained global market shares. These developments are unfolding alongside the persistent effects of the recent shocks to our economies. It is becoming increasingly clear that the COVID-19 pandemic and Russia's war in Ukraine are having long-lasting, if not permanent, effects on the euro area economy. For example, despite the significant drop in energy prices, the output of energy-intensive industries, such as chemicals and basic metals, has dropped considerably more than that of other sectors over the past 2 years, as you can see on the right-hand side of this slide. The pandemic, meanwhile, has exacerbated the secular decline in hours worked per person employed. Today, people are working on average 2% fewer hours compared with the 5-year average before the pandemic, contributing to labor shortages. At the same time, we are seeing a strong rebound in the labor force, owing largely to the contribution from foreign workers. However, over time, this increase in the labor force may be countered and possibly more than offset by the projected decline in the domestic working age population. Overall, these supply-side shocks are difficult to anticipate and can have very different effects on wages and inflation than shocks triggered by changes in aggregate demand, making inflation forecast targeting considerably more challenging. Finally, inflation forecast targeting relies on a stable and effective transmission of monetary policy so that changes in the monetary policy stance have the desired and predicted effects on projected inflation. The experience over the past 10 years, however, has challenged our understanding of the way changes in short and long-term interest rates affect output and inflation. Before the pandemic, record low and even negative interest rates failed to provide sufficient stimulus to lift the economy out of a low growth, low inflation environment. Evidence is pointing increasingly towards monetary policy transmission to activity and prices being highly nonlinear, with diminishing returns when financing conditions are very loose. Today, researchers are trying to reconcile the surprising resilience shown by parts of the economy with the sharpest tightening cycle in decades. This resilience is most evident in the United States, where growth remains surprisingly buoyant. But questions about the strength and lags of policy transmission have emerged across a broad range of economies. Evidence from the euro area, for example, is increasingly consistent with the view that monetary policy transmission is highly state-dependent. During the current tightening cycle, large cash positions held by firms, a rotation of spending from goods to services, a high share of fixed-rate mortgages, comparatively healthy borrower balance sheets, and resilient employment amid persistently tight labor markets may all have dampened policy transmission. Even though a considerable amount of effort is made to understand all these channels, anticipating them in real time is inherently difficult. They typically only become visible once transmission is at a more advanced stage, making policy calibration based narrowly on projections a difficult exercise. This is even more the case if structural shocks also affect the natural rate of interest, creating uncertainty about the degree of restrictiveness of current monetary policy. The question then is how policy frameworks can be adjusted to deal with these challenges for calibrating policy and communicating decisions to the public. Last week, Ben Bernanke presented possible solutions in his review of the Bank of England's forecasting framework. Some of the points he raised could also be of relevance to the ECB. One area of reflection relates to whether policymakers' views on their expected future path of short-term interest rates should be made more transparent, akin to the dot plot used by the Federal Reserve System. The distribution of these paths could help signal the risks members of the committee attach to the baseline scenario built by staff. The narrower this distribution, the stronger the implied endorsement by policymakers and vice versa. A dot plot can therefore help convey the uncertainty about the future path of the economy and simultaneously provide greater clarity about where policymakers see interest rates moving in the future, potentially working against excessive market volatility. A downside to the publication of interest rate path is that they may overly condition market pricing, thereby de facto reducing its informational content. Recent research shows that the dot plots may have lowered US real long-term bond yields by around 130 basis points over the last decade. A second and complementary option is to systematically include alternative scenarios to communicate the uncertainty around central bank projections more directly. By looking at different and potentially equally realistic paths for growth and inflation, there may no longer be a central scenario. The ECB conducts scenario analyses frequently. The most recent projection report looked at how an escalation of disruptions in the Red Sea could affect output and inflation in the euro area. Our technical assumptions are also subject to regular sensitivity analysis. At present, for example, the option implied gas price distribution indicates pronounced upside risks to the March 2024 baseline scenario. These alternative scenarios and sensitivity analyses, however, are currently not receiving the weight and attention they deserve among central bank watchers, with most focusing narrowly on the point forecast of inflation 2 to 3 years ahead. One reason for this might be that the scenarios we consider are in most cases partial rather than general equilibrium, or restricted to tail events, meaning that they do not seriously challenge the main narrative underlying the baseline scenario. To signal more clearly the significant uncertainty surrounding the baseline, realistic alternative scenarios, possibly presenting the range of views within the committee, could test some of the main assumptions feeding the baseline. The challenges currently facing the euro area demonstrate how this could be done. In one scenario, monetary policy is expected to succeed in creating conditions such that firms will absorb large parts of current high unit labor cost growth in their profit margins alongside a recovery in labor productivity growth. In this case, underlying price pressures would gradually abate and inflation would return to or even undershoot the target over the projection horizon. This is broadly the narrative underlying the current ECB and Eurosystem staff projections. Such a scenario could be augmented with additional sensitivity analysis examining, for instance, by how much inflation could undershoot the target if the effects of monetary policy were stronger than usually. In an alternative scenario, productivity growth would remain depressed over the projection horizon, and demand for less interest rate sensitive services could remain sufficiently strong to allow firms to pass a larger share of the increase in labor costs on to consumers. This scenario would take into account that the capacity of firms in the services sector to absorb rising input costs is more limited than in other sectors, such as industry or agriculture, where profits have been rising much more forcefully over the past years, and where falling input prices have created space to absorb other cost increases. Overall, in this scenario, underlying price pressures could be stickier and the return of inflation to the 2% target delayed. The regular and consistent use of such scenarios could better convey the uncertainty facing central banks and contribute to making policy decisions more robust by considering a range of plausible outcomes. All this suggests, and with this I would like to conclude, that returning to the pre-pandemic policy framework, which relied heavily on central banks adjusting and communicating policy around a central inflation forecast, may come with risks. This framework may thus require a deeper rethink, even if inflation is getting closer to levels consistent with price stability. As part of this rethink, central banks will need to carefully evaluate the role the central forecast should play in an environment characterized by higher macroeconomic volatility and persistent supply-side shocks, and how projections could be made more robust in order to place policymaking on a firmer footing while allowing for clear and transparent communication about the inherent uncertainty. Thank you very much.
Okay, we don't have much time, but Ms. Schnabel agreed to take a couple of questions, so maybe we can just collect one or two if there are any.
No questions, all is clear.
Okay, very compelling presentation. You see someone at the back.
This is Andrea De Michelis from the board. I have a question. You actually mentioned the positive influence that the recent immigration has had on the labor force in Europe. This has also been a theme here in the United States. And I'm wondering, as a central banker, how you actually see that immigration has affected wage and price growth, and any, that's also.
Can you repeat the question? Sorry, I missed the last
Basically,
part.
how immigration has affected wage and price growth. Thank you.
So well, I mean, it should have dampened it, right? I mean, so we have had these positive effects on that side. No, sorry. So what we've seen is that we had in the euro area, similar actually to the US, we had a pretty strong increase in immigration. And this has taken a bit off the tightness in the labor market that we have. But still, if you look at the numbers, of course, the labor market has been incredibly tight. This tightness has come down a bit, but it remains relatively high. And immigration is actually quite unlikely to stay at the levels that we've had it over the past years. There were a couple of special factors also related to the war in Ukraine. Of course, there is a bit more political pushback against immigration. And this basically means that this, if you want, relieving factor on the supply side is probably likely to be reduced going forward, while at the same time the demographic change is hitting the euro area quite strongly over the next couple of years, where in many of the countries the so-called baby boomer generation is retiring. But even in a very optimistic scenario, it's almost impossible to replace the people leaving the labor market by immigration. At the same time, what you had is, what I showed, is that on average, people work less, and this has been a longer-term trend. But it seems to have been reinforced by the pandemic. It partly also seems to be related to a change in preferences on how much to work and how much leisure to have.
Okay, perhaps we'll just collect around. So I have Gianluca Benigno, then Silvana Tenreiro, and Mark Gertler, and we will close it there.
Yes, very, very interesting speech. Thank you. I have a question in terms of, I don't know if you can comment, the latest release of inflation. And there seems to be a common pattern in terms of the divergence between headline and service. And I'm wondering to what extent you think this is a challenge in terms of the traditional way of the transmission mechanism of monetary policy. And maybe there is something monetary policy is doing actually that is fueling service inflation rather than dampening it. And this is my question. Thank you.
Thank you for the speech. So you discussed the pros and cons of using dot plots, and I was wondering, on balance, where do you stand? Would you favor using dot plots for the ECB?
There's some reason to believe that the natural rate of interest may have gone up, like due to the, for example, in the U.S., the significant fiscal expansion, other demand forces that may be leading to very strong employment growth. So I was just wondering where possible shifts in the neutral rate might enter this framework.
Yes, so maybe on the first question, I think that's actually a very interesting one. So it seems to be that that the transmission of monetary policy to services is much weaker than to other parts of the economy. And given that, that services, of course, constitute a large share of the consumption basket, this actually matters. And I think we need to better understand what is actually happening there. I mean, one thing is that it's quite natural, given that, that services are less capital intensive, you would probably expect it to be less interest rate sensitive. But in this specific situation, what we have seen is that there was also this, rotation kind of back from the goods to the services. And I mean, if you think about this whole narrative about firms now having to absorb the higher wage costs in their profit margins, this may not be as obvious in the services sectors as in other parts of the economy, because these companies are facing relatively strong demand, and they may actually be able to pass through the higher costs to their consumers. And I think that is, I mean, it's really, if you look at, as you said, if you look at the inflation releases, you see these very different developments, even within core inflation. If you look at goods and if you look at services, it's strikingly different. I mean, the case of the euro area, you had a peak in services inflation of 5.7%. It then came down to 4% and then got stuck there. I mean, they could still be, I mean, people always argue there are special effects here and there and so on. But even in our projections, this is going to remain relatively sticky for quite some time. So that's something that we need to better understand. On the dot plots, I mean, this is, I think this is something we should at least seriously consider. I do not yet have kind of a preset view on that, and I know that there are also, I mean, there's also academic research, of course, on this, that there are downsides to using dot plots. But my main point would be that we've had our experiences with the forecast, and this is, I mean, just to be very clear, this is not a criticism towards our staff, who are always doing the best they can. But it was just exceptionally difficult to deal with the situation. And then we've had this concept of data dependence, which, however, at the same time has introduced this kind of volatility. We see this really sometimes seemingly excessive market reaction to individual data prints and so on. And somehow, I think we also need to manage that part. And the question, and that's maybe also a question to all of you, is whether something like a dot plot could help to kind of then again reduce the downsides coming from this data dependence. So your question, of course, is a difficult one. I mean, as everybody here in this room knows very well, I mean, any estimate of R star is subject to huge confidence bands, which means that for the day-to-day policy making, it's not particularly useful. There are, of course, arguments why R star could have moved in one or the other direction. And I personally do think that there are reasons to believe that R star, global R star actually, has gone up and is going to move up possibly even further, but we will know only much later. And so if I understand your question correctly, you would say, okay, this could be part of the different scenarios. So given that we don't know, we say, okay, in this one scenario, and I think that's a very good idea, you could say, well, it could well be that R star has gone up a lot, that monetary policy is much less restrictive than we thought, and what would this imply? In the other scenario, R star remains as low as it was before, which of course then could have quite different policy implications. But then, of course, the question remains on those objects that we can really not estimate with any degree of certainty. Then, I mean, then in the end, the policy committee needs to take a stand, and we're of course a bit back to the question we had before. And so then, but then it's judgment. But at least then it's, I mean, at least then we kind of have a clear separation of what is the more technical part of the analysis and what is the judgment. And I think this distinction is quite important.
Very good. Thank you very much.
Thank you.
And with this, we break for lunch and we resume at 2 p.m. like yesterday.
I think we can start. All right, perfect. So thank you all for joining the fourth session of this conference on central bank independence and communication. The first paper will be presented by Amy at Brown University, and Claudiana will be the discussant. So please.
All right, excellent. First of all, thank you so much to the organizers for putting the paper on the program, and thank you all for attending and listening to the presentation towards the end of the conference. So I'll try and be energetic and exciting to keep the energy high for this last leg of the conference. My name is Amy Handlin. I'm an assistant professor at Brown University. This is joint work with Laura Gatti, who is at the ECB. So the normal disclaimer applies that this project represents our own views and not that of the institution. This project is called Monetary Communication Rules. And actually, the presentation and the keynote speech by Vice Chair Jefferson really connected kind of this long history of monetary policy, focusing on policy rules and thinking about, in the data, can we measure or see some sort of systematic policy making where we have some correlation or systematic mapping between macroeconomic variables or expectations over those macroeconomic variables and the policy decision. And this goes back to Taylor 93, where we think of a policy rule also as being some sort of systematic policy. You're trying to think of policy as methodological or methodical, something that's courting a plan that's not totally random. And in that paper, Taylor looks at seeing the correlation between macroeconomic observables and that policy rate or that target policy rate. In this paper, Laura and I are proposing thinking about communication similarly as having some sort of systematic rule. And in particular, we think of communication itself as being a policy object. And so we should think about what types of systematic rules or systematic patterns can we link between the central bank's language and their forecasts over macroeconomic variables. For the presentation today, we're going to focus on the FOMC post-meeting announcements, partly because these are also decided by the FOMC in a vote in a similar way to how the target federal funds rate is decided. So we think this is a really nice parallel for thinking about systematic communication being determined jointly by the committee. This text is going to cover the Fed's policy decision for the interest rate target, but it's also going to include information about the central bank's expectations over the economy, as well as for future policy decisions. What we do in this paper in order to think about measuring this systematic communication is we estimate time-varying ridge regressions that connect the text with a variety of Fed policy variables and macroeconomic forecasts that we're going to take from the Green Book and Teal Book forecasts. For tractability, we're going to focus on having separate text regressions for each of the policy and forecast variables of interest. So we'll have one regression where we're going to look at how the language in the FOMC statement is going to be correlated with the contemporaneous target federal funds rate decision. Then we'll have a separate regression that's going to look at how the language or word use in the FOMC statement is correlated with the same meetings forecast for next quarter or next year inflation forecasts. Okay? We call each of these estimated mappings monetary communication rules. Okay, so this is something that, for now, for this paper, for tractability, we have these separate regressions we're estimating, but we think that if there is some higher conceptual monetary communication rule that is systematic and joint, we should be able to pick up and measure these separate systematic or these separate communication rules. What we find is we find strong evidence for systematic Fed communication, meaning that there's a lot of information coming from central bank announcements about not only policy decisions, but Fed forecasts for almost all variables except for short-run headline inflation. Okay? We also investigate allowing for these communication rules or these systematic mappings to vary over time. And we think that when we have a shift in the communication strategy or this communication rule, what effect is that going to have on private sector beliefs? And what we find is that when there's a change in the communication rule, so there's some shift in how macro forecasts are correlated with the language of the FOMC statements, that this is going to be associated with increased uncertainty from financial markets. And so in particular, we find that there's a larger high-frequency monetary policy surprises on meetings where we have shifts in the communication rule. And we also find that this is associated with greater professional forecaster dispersion on a variety of macroeconomic variables. And we'll talk about how we think about what's going on here later in the presentation. So more broadly, we want to really push this paper as an idea of communication is something that is a policy object, and for people in central banking, this is no surprise. We've had this multiple speeches from central bankers talking about the importance of communication, the value of communication. And what we're saying in this paper is we should treat it just as rigorously and seriously as we do other Fed policy decisions. And so here, we're saying first we can show that there is systematic mappings between information that the Fed has through their announcements. And then we're hoping to have this be a starting off point for a broader research agenda, trying to really take this measure of communication seriously and for future policy analysis. This paper contributes to two broad literatures. First, thinking about the literature on text analysis of monetary communication. I have some other projects in this space, and people in the audience I know have work in this space as well. Our contribution to this literature is focusing on the systematic aspects of communication, which is going to be a little bit different from the literature that mostly focuses on shocks or unanticipated communication. So that's going to be one thing that's a little bit different about this project. The other literature that we're contributing to is thinking about the theory of public communication. So there's a long literature that's looking at what kind of signaling effects central banks can have. And what we're doing is we're trying to really bring together, or at least have a starting point to bring together the data and how we can measure communication and eventually connect it back into this theory of the value of communication. Today, the project is going to be very reduced form. It's a very early part of this research agenda, but this is something this is where we want to go eventually, is to bring this into these two kind of fields together. So for the remainder of the presentation, we're going to just jump right in. So if we're thinking about a reduced form analysis to compare the language of monetary policy announcements with a variety of policy and macro forecasts, we're going to be very precise about what each of those dimensions are going to look like. So the FOMC statements after the FOMC policy meetings will be the text that we're going to focus on. These have been released after FOMC meetings since May 1999, and the end of our sample is going to be at the end of 2022 for our baseline specification that we're working with. We're going to look at a variety of realized policy variables, as well as a variety of internal forecasts from the Green Book and Teal Books. These are released to the public on a 5-year lag, so that's going to be a slightly shorter sample period. For our later analysis, we're going to be looking at private sector expectations. Dispersion is going to be pulled from the survey of professional forecasters. And then we're going to look at a small sample of monetary surprises, and in particular thinking about how large surprises are. So we're going to think of the absolute value of monetary surprises rather than doing something directionally. Okay? Given the short presentation, we're going to focus primarily on looking at how the target federal funds rate varies over our sample period, and how that correlates with the language used in monetary policy announcements in the FOMC statements. We think of the target interest rate as being kind of a summary of a lot of different expectations and beliefs from the FOMC, so we see it as a good kind of baseline specification. But in the paper, we look at how the language in the FOMC announcements correlate with all of these variables that are on the slide. So for more detail, we can turn to there, but for the talk today, we're going to focus on how the target federal funds rate is discussed and justified, and how we can measure that language relationship. Now, in order to eventually do a regression between the language of the FOMC announcements and other numerical variables, we first need to take a stance on how we're going to represent text as numbers. So in the paper, we have a baseline specification, then we have a couple of other alternative representations that we'll highlight throughout the presentation. So for all of these specifications, I want you to think of the data frame or the data set that we're working with, that each FOMC statement is something that we can represent as a vector of numbers. How we generate that vector is going to differ depending on the method, but we can think about, we can represent text in some j dimensions, and so that's going to give us different columns in our data frame that we can work with, and then for each row, we're going to have a different FOMC announcement. Okay? For our baseline specification, we're going to say that each statement is a vector of weighted counts of sequences of 4 words in a row. So how often these sequences of 4 words in a row occur in one announcement versus another. in order to think about how do we get to that J-dimensional space, we're going to first look at all of the sequences of 4 words in a row, or 4grams, that are occurring in our sample period. Okay, so this will be something that will be rolling or a sliding counter, and we'll think about what are the possible sequences of 4 words in a row that can occur in FOMC statements. We then apply a variety of cleaning procedures and pre-processing procedures that are standard in the text analysis literature. So in particular, we do things like entity encoding. So instead of having the Federal Open Market Committee as 4 separate words, we condense that down into FOMC. Okay? Similarly, instead of having federal funds rate, we condense that down to funds rate. We also do things like doing some lemmatization, so taking words with varying tenses and condensing it down to 1 unit to increase the comparability across the different sequences of 4 words in a row. And then we also drop numbers and punctuation. Then, so here on the slide, we have an example of what this looks like. So we have a sentence that the Federal Open Market Committee decided today to keep its target for the federal funds rate at 5.25%. That's going to be translated into FOMC to decide today, keep target, today, keep target funds rate, and so on. Okay? Then we also do another standard step in text analysis where we are going to drop sequences of 4 words in a row that occur in fewer than 5% of announcements. Okay, there's 2 reasons for this. First is that we want to think about modeling systematic communication. So if there's one-off phrases, this is going to be something that's not occurring systematically or repeatedly over our sample period. The second is a more mechanical reason, is that if we have one phrase that occurs in only one observation and we plug that into a regression, it's going to act as if we had a fixed effect for an individual observation. So those are kind of 2 justifications for why we want to drop sequences of words that occur in fewer than 5% of statements. Now, I want to highlight here that we do a ton of robustness in the paper. We have a very long appendix where we vary all of these assumptions. So we look at what happens if we look at sequences of 2 words in a row, 3 words in a row, 5 words in a row. We also consider changing the cleaning procedure as well as the truncation threshold, so looking at 0% or 10%, and qualitatively it's not going to change our end results. There's going to be some slight numerical differences, but it's not going to be substantially large. Okay? The weighting for how we're going to count how often these sequences of 4 words in a row occur in FOMC statements is using a TF-IDF, or term frequency inverse document frequency weighting. And this is a common weighting scheme that's going to allow us to adjust for different FOMC statements having different lengths, as well as accounting for the fact that there's going to be certain language and certain terminology that's just going to be more common or uncommon across FOMC announcements. So the standard weighting is this TF-IDF. But for intuition, you can just think about counting how often these different sequences of words occur in a given announcement. And so then going back really quick, we can see that the first element of the first row and first column, that would represent how often does a sequence of 4 words 1 occur in the first statement. Okay, and then we go through this procedure for all of the FOMC announcements. Okay? Now, besides this baseline, there's 2 other representations that we have for language because we want to make sure that our results are not going to be just only manufactured by one measure of text. So the second representation that we have is looking at clustering similar 4grams or similar sequences of 4 words in a row into 100 clusters. So this is something where we use a large language model to tell us when there's one sequence of 4 words, how similar is that to another sequence of 4 words, and then we can group those together. This gives us the dimension of having 100 clusters of sequences of 4 words in a row, and we count how often those occur in each FOMC announcement. Second robustness check that we have, or alternative text representation, is just using a large language model from the beginning. So from this, we take the FOMC statement and we plug it into a pre-trained large language model from the computer science literature. And what this model can do is it takes the order of the words, which words are in the text, and it encodes it into a numerical vector. This is a very, very large numerical vector. It's over 700 dimensions, but this is meant to help encode anything in the English language. So what we can do is we can actually do a principal component, and we find that actually 40 dimensions is all we need in order to embed the information across the FOMC announcements. Okay, so we think of this large language model as encoding more of the joint occurrences of all the words and the orders in which they occur in a 40-dimensional dense vector over time. And again, even with all of these very different measures of text that we have, going from counting words all the way to something that's a machine learning approach, what we're going to find is very, very similar results at the end of the day, that the FOMC has very systematic communication, and it has importance for when that communication mapping is changing over time. Okay, so for our regression specification, this is going to be what we're working with. So again, we're going to be looking at separate regressions for each of the policy and forecast variables that we're working with. So for today, think of Y as representing the target federal funds rate that's announced at a meeting T. On the right-hand side, we're going to be thinking about our baseline specification. The W is going to represent that weighted count of sequences of forwards in a row, or the 4-gram. And then the beta is going to be a coefficient that will tell us what is the correlation between occurrences in the sequences of words to the output variable of interest, so the target federal funds rate. Okay? The way we're going to estimate this coefficient is using a ridge regression or a penalized regression that's going to help us deal with the concern of overfitting. The penalty parameter that we work with is chosen using a standard k-fold cross-validation in order to minimize out-of-sample error or maximize out-of-sample accuracy. Okay, so that's very standard. And so in this specification here, the h in the coefficients, the coefficient and also the alpha parameter is something that could be time varying, or we could be looking at different windows of estimation. For our first result, we're going to suppose that suppose for the entire sample period that the Monetary Policy Authority or the central bank has not changed their communication rule. There's a standard set of parameters that connect word use with the target federal funds rate and the other macro variables. Okay? Later, we'll relax that and look at how this varies over time. But for now, let's think about a fixed communication rule that the way the FOMC or the Fed talks about the target interest rate is stable over the entire sample period. And what we find is the following graph, or is summarized in the following graph. So in the solid black line, we see the target federal funds rate over our sample period, and the red dashed line is the fitted value from the regression that we estimate. So this is just saying from the text and variation in the text over time, we can get a very, very good fit, which we interpret as systematic communication because it's able to closely predict what the target federal funds rate, very closely to what the target federal funds rate was at that time. And again, this closeness of fit, where our fitted values are very close to the actual values, holds for almost all of the variables that we look at, all of the contemporaneous policy variables, as well as all of the forecasts from that we consider for the Green Book and Teal Book forecasts, except for headline inflation next quarter. So we interpret this that there's generally systematic communication coming from the Fed, except for really, really short-term headline inflation forecasts, which to us makes sense that if we think about monetary policy having, having variable lags or trying to target medium-run inflation, communicating about something that's very noisy in the short run is something that could lead to unintended consequences or unintended volatility. So this is something that we think is interesting, but is not too unexpected, I think, at the end of the day. Okay? So once we looked at this representation, we were also concerned that, well, maybe this is just a feature of how we represent the text, that we have a very large dimensional representation, so maybe this, even with the methodology we choose, there's still overfitting. However, when we look at these lower dimension text representations, we still find very, very good fit, meaning systematic communication between the, or a systematic relationship between the language and policy objects as well as macroeconomic variables. So here we have the clustered sequences of forwards in a row, and then on the right-hand side we have the large language model representation, and we can see that this is still following very closely the true target federal funds rate. So we still find this evidence of systematic communication. We push this a little bit further even, and we think, well, maybe any representation of text could mechanically create a good fit like this. So what we do is we shuffle the timing of our analysis. So we shuffle the FOMC announcement and how it's associated with the target, different target federal funds rates. So we've mismatched the timing of the target versus the statement. And then we re-estimate these ridge regressions with these mismatched observations. What we find is this. We find a fit that is just, it's not there. So this is not something that's mechanically generated by any language representation and variation in our left-hand side variable. This is something that it matters what the Fed says and when they say it. Okay? So this is, we think of as further evidence of systematic communication from the Fed. Okay? So at this point, I do also want to kind of revisit that the assumption to go into these specifications was that suppose that the Fed had systematic communication or a rule that did not change over the entire sample period. And so what we do next is we allow for time-varying communication rules, where we estimate a ridge regression, this ridge regression, to get a beta and an alpha parameter for our particular policy variable y, and for different horizons h. Okay, so we first start with a very small window of 8 years, and then we iteratively add FOMC meetings in an expanding window fashion. So we can think about estimating a communication rule for window h-1, and then we'll want to compare what do those parameters look like compared to what we estimate for window h when we add on one additional meeting. Okay? In order to do a comparison of how these communication rules, what we estimate how these parameters change from one meeting to the next, there's a lot of different ways that we could do some sort of change in parameters over time. What we've chosen to work with is to go with the following procedure, where we look at the rule estimated on window h-1, and then we feed in all of the FOMC announcements in our sample in to produce this y hat h-1. Okay. Then we take the rule that was estimated on window h, and we feed in all of the FOMC statements in to tell us what would be the fitted value as if they were communicating according to this window h rule. Okay? If there's no change in the communication, the systematic mapping of communication from what was estimated on window h versus window h-1, then this is going to say there's a correlation of 1. They're going to be identically the same, and we would end up saying that there would be no shift. The shift would be 0. Okay? So if there's a change in how the language is correlating with our variable of interest, that's going to show up with a correlation between y hat h-1 and y hat h that's going to be less than 1. And so we'll say that there's going to be a shift in communication at that time. This graph summarizes the shifts in the communication rule for the target federal funds rate. And what we can see on the is that there are spikes in this indicator over time, indicating that those are meetings or periods where we have a change in the communication rule from the past meeting to that new meeting. In the light shaded area here, we have bootstrap standard, 95% standard errors. And when we see a spike, this is, again, meaning that there's a change in communication and how it relates to the target federal funds rate. Where I think this is really exciting is if we look at the period of the zero lower bound, where we know the target federal funds rate is not changing, but we still see spikes, in particular, around 2011, late 2012, into 2014, which are dates that match up with changes in forward guidance strategy during that time period. And that's something that we're able to measure with our methodology. We also see changes in the communication rule when new chairs take over, so some slight differences in how language is going to relate to the policy decision. And then we also see big spikes associated with going to the zero lower bound for the first time, as well as COVID. Okay, so these are things that, there's a lot of things that can be factoring into these, how language is relating to other variables, but this is something that we see is really exciting, that as a smell test, there's times when we would expect there to be shifts here, and we do actually pick up on those changes. Okay? What we wanted to do after this is, well, if we think that there's changes in this communication, the systematic part of communication, or how communication relates to policy, we wanted to look into how do private sector beliefs respond, or how are they changing in the same time period. So we look at the absolute value of high frequency changes in asset prices, so high frequency monetary surprise measures. And we also look at forecast dispersion from the SPF for a variety of macroeconomic variables. In short, we find that shifts in the communication rule, so when that shift indicator becomes positive, that's associated with larger monetary surprises, and it's also associated with greater dispersion in professional forecasters. We can jump into the regression results in a second, but I want to talk through what do we think is going on here. So we think at this point there's two potential stories. First, we think that it could be that if private sector thinks that we're in the old rule, and then they see language that's inconsistent, or a language relationship to the target federal funds rate that's inconsistent with that old rule, that's something that can be attributed to being surprising. Okay? Similarly, if we think that there's a new rule, investors and private forecasters are going to have differing interpretations of that new rule, which would then permeate into more diverse forecasts, okay? Another story could be that, well, let's suppose that there's a lot of uncertainty in the economy, that the central bank has a lot of uncertainty, and then they change their communication rule to try and mitigate or address uncertainty that's also happening in the economy. So this would be another way you can have this relationship between dispersion and larger monetary surprises when there's change in the communication strategy. And so we think that both of these are happening at the same time, that the Fed is changing their communication strategy when there's great uncertainty, such as at the end of 2008 and in COVID. But we also see that there is this other motive that when there's new forward guidance language that's introduced, that that's also something that's surprising markets. So what we're working on in future work is to try and disentangle these two a little bit more seriously, which is going to require some more structure in our modeling approach. But we think that it's already very interesting to say that first, we have some systematic communication so I think I'm going to run out of time and I won't be able to go into the regression tables. But I just want to summarize here that we find systematic evidence, and we can measure something that people working in central banking have thought for a long time, but we can measure that there is systematic communication from the Federal Reserve. And we call these estimated mappings communication rules. Okay? We think it's the first step in this literature trying to take the communication policy object seriously in the data. And we hope that eventually we can bring this together with our theory of communication and our broader models of monetary policy and thinking how does communication interact with other policy instruments. But with that, I want to say thank you.
Thank you, Amy. One brief announcement. Someone left the phone behind, so in case, okay, we found. So we can move. That was fast. So let's move to Claudiana Istrefi from Banque de France will be the discussant.
Thank you very much. I would like also to thank the organizers for inviting me to discuss this very nice paper from Amy and Laura. And the topic is central bank communication. I would start just with a simple quote. Why this topic is important is well described in the observation by Bernanke that monetary policy is 90% talk and only 2% action. And really, the central bank words have a lot of information in them. We have used them in many ways. We have used central bank words to understand how central banks take decisions by looking at their tone, at their topic, disagreement, uncertainty, surprises. These are ways that come from text that we learn how central banks are taking decisions. But we also have learned how monetary policy affects expectations through communication, expectations of markets, households, and firms. And finally, another way that we have used central bank words and text is to understand actually how central banks draft communication. And this is where I see Amy's work falling in this category. And what we usually have looked in this category, looked at complexity of text, simplicity, similarity. We are all familiar with the trackings of words that financial markets do to either ECB statements or Fed statements when they are looking really for these changes of words in the text. And we kind of know that similar press releases, they reduce market volatility, and if there are changes, there is reaction. But what Amy and Laura is doing, they're going really back and deep to the basics. They are looking at how words relate with the world that the Fed sees. And this is really, I think, it has potential to this research to go to the top of the list and actually learn, give us lessons how central banks take decisions. But the first step is how they relate words with the world that they see. So what is the Fed's communication rule? Is an empirical regularity between Fed's variables and the words that the FOMC uses to describe them. The input that goes into the investigation is the Till book forecast, the Fed funds rate, and the FOMC statement, starting from 1999 to 2022. Just a note, for those that are not familiar with central bank communication, in 1994 was the first announcement of the Fed decision. So this is not something that has been done for centuries. So it's let's say, a recent thing that the Fed communicates monetary policy. And in 1999, they came up with a statement. Then the methodology is to use this text in a text analysis approach and combine this with ridge regressions. What is the output? A fixed rule for all the variables that are taken into consideration: Fed funds rate, GDP growth, inflation forecast, up to 4 quarters ahead. And also a time-varying rule for these measures, all individual rules. And what do they find? That these rules, they are almost perfect fit of let's say, Fed forecast or Fed funds rate. And let's say the conclusion from this is that Fed is transparent. So it speaks what it sees. So it sees the data and it describes the data, let's say, transparently. And there is also time varying in these rules that is informative when FOMC communication is shifting, and they can relate these shifts in communication with surprises and forecaster disagreement. For the continuation of the discussion, I have one question and three wishes. So we see that the fixed rule from 1999 to 2022 is almost a perfect fit for Fed funds rate. And one wonders, is it the magic of words or the 750 regressors? So this is what is happening here. Amy showed that when you reshuffle the FOMC statement with the Green Book forecast, when you don't have a match, actually you have a poor performance. So it's not all into these regressors. And what is important is the match of the words with their numbers. So this is really important to get this fit. But also you understand that it's really important when these words and this fit, these forecasts are happening. It's important that these go together, because when we see, Amy didn't show that, but when we see rules performance by Fed chair regime, if we can call, they have a poor fit for other chairs regimes. So what is happening here? So you have the Fed funds rate, so you have the Greenspan, Bernanke, Yellen, Powell regime. You can think about the FOMC statements that are happening in this chair regime. And then you see that what is the rule under Greenspan and how that can predict the Fed funds rate for other chair regimes. And the same for Bernanke, Yellen, and Powell. You can see that the Greenspan regime cannot tell much about the Fed funds rate, zero lower bound, and so on. But also Greenspan regime that has seen high rates and low rates cannot tell much about Greenspan FOMC talk or about Yellen. So if you think about, let's say, John Taylor will be very happy that the Bernanke's rule suggests that Fed funds rate should have been higher in 2000 when the rates were low around 2004. However, the Bernanke's rule also suggests that interest rates should have been risen much faster than they did under Yellen. So the question is here, what is happening? Is it that the Greenspan, Bernanke, and Yellen's FOMC are describing the data differently? Most of the members are the same. The stuff behind that is writing the FOMC statements is the same. So what is systematic in this communication? So this is a question that I think it will be nice to elaborate further. Now I go to my three wishes. Central bank communication is more than data description. So I would wish for Amy and Laura to go further and to see that what does this information that they have found, these rules, what can we learn about the real rule that we care, the Fed's policy rule. And we know that central bank communication, it describes its decision rule, how the central bank views the economy, the uncertainty around the data, the confidence around the data, and the attention to which objective they are paying. In a recent work with my colleagues at Banque de France, I have shown that when looking at the communication of the Fed, Bank of England, and ECB, that the confidence and uncertainty that they have around their narratives is very important to explain the stance. And I took here a very simple example from the latest FOMC statement that you see that there are words about the economy, but there is some important information about the narrative, how confident or uncertain they are about the narrative. And here, they are confident that on the trend that they see. Jobs remain strong, unemployment remains low, but inflation remains elevated. And we find that this type of communication actually lowers the probability that the Fed will ease policy soon. So my first wish, can we learn from the GDP and inflation rules? What can we learn about their weights in the policy rule? The second wish is, do we have alternative Fed communication rules? We know the process. There is the FOMC meeting, FOMC statement, and FOMC press conference. The FOMC statements is crafted during the FOMC meetings, given typically 3 alternatives. The staff prepares all the alternatives. The idea is that they have the same data, but different wording. Then the FOMC members are going to tweak the FOMC statement, the final one, to match their preferences and to achieve consensus. And the idea here is, would rules look different if we used these alternative FOMC statements, and what we would learn for monetary policy by using this alternative rule. But then there is the other step, is the press conference. Since 2011, there is a press conference, and in terms of market reaction, these are more newsworthy than the press release. And here again, one can measure these rules and see how different or informative is press conference from statements in terms of your rules. Can we relate these differences on the potential differences on the rules to market policy surprises, to monetary policy surprises, or the central bank information effect? So finally, to have a reason why we have surprises, why we have central bank information effects, where they are coming. And my final wish is a very simple, modest, but probably like $1 million question. What does your Fed funds rate suggest for the next Fed's turning point? When is the first cut rate coming? So overall, I think this paper is a great step towards understanding how Feds crafts communication, and it has a great potential towards understanding how Fed takes decisions, what we really care about. Thank you.
We can now collect a few questions.
Yes, thank you. Fascinating stuff and the discussion too. I was wondering 2 things more from boomer style question. Like if I were to map this into a Taylor rule, I think it's related to something that Claudiana said. No, like can I think of this as somehow mimicking a Taylor rule, or like how could I fit this into? Is there some 1, 2 macro variables that would summarize all the information you need to know? And the other one is related, I guess. Can you tell something about the distinction between Delphic and Odyssean kind of communication? So is there, is the Fed trying to say I'm committing to doing this, or are they trying to say, well, I think this is what the economy is going to be doing, so that's what? So I think that would be, you probably have all the tools you need to answer that. I think that would be really cool.
So I thought this was fascinating, having had some involvement in preparing statements. There was certainly a huge effort to try to use words and phrases consistently. So if you were going to say, output is growing solidly, well, what does solidly mean? What did it mean last time? These were the sorts of discussions that were there. That's consistent with what you're finding, I think. I was very interested in the changes in the rules and trying to figure out about changes in the rules. And I didn't quite follow what you said when you described that. Was that indicator, which was quite spiky, was that indicating a deviation from a rule that then came back? Or is it a change from one rule to another rule? And if it's the latter in particular, couldn't you just use, I don't know, f-tests or something to look at changes in you know, statistically significant changes in coefficients or something like
that? Jim Bullard, Purdue. So, yeah, the monetary policy debate is going on all day, every day, 365 days a year, all around the world. And you have speeches going on all the time. We had one here at this conference. So it seems like the communication's far more extensive than just the policy statement. It also seems like, because of the good work of Bill English and others, that the staff works very hard and knows pretty much what the decision is going to be at the meeting. So they're lining up the language with the decision at that meeting. And certainly the committee itself is coming in and probably making tweaks at the meeting to make sure that it's all very consistent. So it wasn't totally clear to me if that's what you're picking up or you think you're picking up more than that. But I think it'd be interesting to go to the much larger space of other speeches and other communications. There's a lot of TV these days and other types of communications. And at certain junctures, that does seem to change policy. So that, especially if the chair makes us be, I guess the chair talked just yesterday, just yesterday, but certain junctures that seems to be, shape things in a different direction. So I think that would be a good way. I'm sure you have your eye on this, but that would be a good way to go with future research. It's a lot more voluminous, but on the other hand, it would kind of track the debate more consistently across time than just looking at the particular meetings.
A very nice presentation, very interesting. So I'm going to suggest something that I don't know how to do, so it's not like, it's more for thinking. So one of the things that often comes up in kind of these communication rules is really trying to kind of give information beyond of where you think things are going. If you think about this relative to the dot plot, I'm kind of wondering, is there a way of using all this data and kind of like all the word part to figure out how much more information there is in what's being said versus the dot plot and how effective communication is about kind of that expected path? So again, I say I don't know exactly how to do it. I'm just throwing it out there because it's certainly one of the kind of big roles of the communication is try to get away from the current decision and kind of giving that whole process. Another small thing, and again, this is more just an anecdote. So at least my experience at the Bank of Canada, there was a little bit of playing around with words once in a while that we didn't want to have people getting caught up on one word all the time. So once in a while, we'd change certain things to kind of get away that people don't feel like, okay, if you change this word, it's like a drastic change. So there's a little bit of playing and putting in a bit of noise. I don't know if that makes any difference, but anyways, small detail, and I'm sure certain different central banks might do it differently. But yeah, there was a lot of knowing that changing words can kind of matter, and there was a bit of a feeling, don't want people to get too caught up on certain words.
Yes, please go ahead.
All right, thank you so much, Claudiana, and then also thank you for all of the questions. I'll do my best to try and answer them as quickly as possible, but if we run out of time, please let me know. So the first thing I wanted to actually address is from Claudiana's presentation about thinking about the chair-specific rules and thinking about what does that look like out of sample. Our interpretation from the work that we've done is that there's a shift in the communication rule when the chairs switch, and so this is something that mechanically, if there's a different systematic mapping between policy variables, macro forecasts, and the language, then it's not going to have a good out-of-sample fit from, after there's a change in that mapping. So that's kind of our baseline interpretation. When we look at a measure, the large language model version of text, rather than looking at the word count version, we do find some better accuracy out of sample. So thinking about having a measure that's not, overweighting just a change in the words, but rather trying to pick up the underlying context of what's being talked about. And in that specification, we find that Bernanke seems to have the most representative Fed communication style, thinking that kind of going afterwards and then going forward, it seems to be the most similar. But this really big shift in communication style that happened during Bernanke's tenure is why we see the Greenspan communication rule is just not fitting out of sample, and so that's something that partly that's I think maybe a little bit from the graphs that you showed, the representation that we have, but we also think that communication is changing over those times. A lot of the other things that you suggested for your wishes, some of them are already on our to-do list. So for example, looking at alternative statements, as well as looking at the other dimensions of policy, so thinking about press conferences, or thinking about other speeches as well. There's some challenges there with thinking about how do you compare a Q&A to the formal FOMC statement, and that's kind of what we're struggling with, to have that mapping be consistent. But it's on our to-do list, and we think that that's really exciting for future work. And then for doing kind of the prediction of when there's going to be things happening going forward, when is there going to be the next rate? I'm not going to, that's a little risky to try and predict. We can default to what Powell said, that waiting for good data and having more confidence. So we can stick to that line. The couple of things that I do want to, for jumping to questions, so also related to what Claudiano was saying, how can this connect to a Taylor rule? So that's on our to-do list, to think about jointly connecting these separate rules that we've estimated into a more structural framework of saying, how is the Fed communicating about output? How is the Fed communicating about inflation? And how does that connect how the Fed is communicating about the target interest rate? So it's going to require a more global type of estimation strategy that we haven't done so far, but that is something that we're striving for. Moving towards the Delphic versus Odyssean communication strategy, ultimately, I think that the value of communicating with words is that I think it's a way to communicate more information without having that commitment. So kind of going to Isabel Schnabel's speech, thinking about releasing a number has like almost a misleading precision that comes with releasing a number, whereas with words, you can have more context, communicate uncertainty more reliably, and I think that uncertainty provides a little bit of wiggle room, and so I think is more allowing for more discretionary or kind of Delphic forward guidance. So there's nothing concrete in the paper about that, but that's what I think that we can probably also, I agree we can push in that direction. And then going with an F-test, absolutely, that's something that we can look at for looking at changes in these rules. Just to explain the graph a little bit more clearly, when there is a spike, it is a shift to a new rule. If we were to have sequential shifts, like if we saw like a little plateau or something, then that could be a situation where we see a shift to a new rule and then a shift back. But that's something that for most of those were kind of one-off, so we interpret those as shifts to a new rule. So doing the F-test would be that's a great suggestion. And it's also great to hear, very, very insider information about, yes, there is intention for systematic communication, but that's what we can also measure from the outside as well. So that's something that we find as exciting. And then, to your question, so yes, we're also working on kind of this value added, so thinking about what is communication adding in addition to things like the SEP or things like other numbers that are released at the same time. What we've done so far is we've looked at how language in the statement relates to the SEP, and we find that usually, we also find similarly good fit there. We find that it's usually discussion of language or phrases about concerns about inflation, or when the SEP is indicating a potential hike by the end of the year, and then there's more discussion about what's happening on the real side of the economy when there's a relatively lower end of year forecast. So we are starting to pick up on kind of this more forward guidance language as well, but thinking about like what's the value added over and above what we see there, that's something that we can work on. Adding the little bit of noise, I think that's something that when we look at the large language model representation, it's not going to be as sensitive to like that slight variation, so long as the words are in a general English language sense similar to each other. But I think that that's mechanically something that we can test even from our baseline specification. So that's a great suggestion. But I think that was everything, and just want to say thank you again for all of the comments.
Thank you, Amy and Claudiano, for this great first part of the session. And let's welcome the next presenter and discussant. So Thomas Drexel from the University of Maryland will be the next presenter, and Evgenia Passer from Université Paris-Dauphine will be the discussant.
Test, 1, 2, 1, 2, okay. All right, thanks a lot to the organizers for including my paper in the program. The motivation for this project is a growing concern that the Fed gets politicized. Former President Trump openly criticized the Fed for keeping policy too tight. And recent research shows this had an actual impact, at least on market expectations of policy. Inflation has been high, so perhaps naturally there is a bit more political scrutiny on the Fed. Appointments are certainly very political. The next election is looming, and so forth. Now, empirically studying political pressure on central banks is challenging. We need to come up with good definitions. We need to come up with good measurement. Both are things that I'm going to do today. But let me first give you two starting points in the literature that motivate my work. There is one empirical branch of research on the benefits of and threats to central bank independence across countries. So Alesina and Summers is a key reference, and the idea here is that we assign different scores of central bank independence to different countries. We correlate that with inflation, and then a typical finding is that countries with more independent central banks enjoy lower inflation. So to the extent that there's pressure on the central bank, that would be reflected in that country score. There's another literature, which is the literature on monetary fiscal interactions. In that literature, there is also a notion of political pressure, which is that there's this concept of fiscal dominance. Somehow in the background, the fiscal authority entices the monetary authority to accommodate deficits, and that then can cause inflation. That literature has an empirical branch where models are estimated on macro data. So these are two approaches to thinking about political pressure. One is cross-country, and the other one relies on fully specified structural models. In this paper, I want to do something that, as far as I know, is new. I want to look at one country through time, the US. I want to look at the Fed, and I want to identify shocks to political pressure on the Fed through time. The same way we would identify monetary policy shocks or fiscal policy shocks, I want to define something that I call a political pressure shock, and then I want to say if political pressure goes up by 1 unit, inflation moves by X units. How do I do that? Let me preview the idea of what I do. I provide new data and a new identification approach to eliciting these political pressure shocks. Let me talk about both in turn. So the new data it's a bit out of the box. The idea is that I say, let me just look at how often politicians talk to Fed officials. To do that, I look at the daily calendars of past US presidents, which are available through the presidential libraries, and I simply collect all the meetings that presidents had with Fed officials, from Franklin D. Roosevelt until Barack Obama. I can see how often they met, how long the meetings were, whether they had lunch, dinner, where they met, and so forth. And I construct a data set from that and build some time series of these personal interactions between presidents and Fed officials. That data is pretty fascinating. I'll show you some graphs. It's pretty entertaining. But that by itself is not necessarily political pressure. They might just meet and talk about something else, or they might meet actually in response to changes in the economy that they want to discuss. So this is an endogenous time series. Therefore, in the second part of the paper, I develop a narrative identification strategy. What I do here is that I take the time series of President-Fed personal interactions, I plug that into a VAR with standard macro data. Then I impose some sign restrictions with which I define what a political pressure shock is. It's something that increases meetings and eases policy. And then in addition, while those sign restrictions might pick up still other shocks, I impose what is called a narrative sign restriction, where I basically say, here's the meeting time series. I can point you to some instances in which the meeting time series moved because of political pressure. And then I provide corroborating evidence that that was the case. And the two presidents that I exploit variation from were President Nixon and Lyndon B. Johnson, who are known to have exerted pressure on the Fed chair. I'll talk much more about that. So I use that variation to identify this shock. What I find is that political pressure shocks, again, those are shocks that through the meetings, through personal meetings, the president convinces the Fed to ease policy. They persistently and strongly increase inflation while not affecting other macro variables much. Okay, I'm going to talk more about the interpretation of that result as I show it. I will also show that the effects of a political pressure shock are different from the effects of a standard monetary policy easing shock. And I have some formal derivations where I show why that shock is actually different. If you think about it, if the president goes to the Fed chair and convinces the Fed chair to ease policy and no one ever knows about it, that would be, narrowly speaking, a monetary policy shock. So there's something about agents observing those interactions and changing their behavior. I'll show this formally, and I show that the transmission from monetary policy shocks is indeed different, in particular in that the political pressure shock has a much stronger effect on inflation expectations, which is consistent with this idea that the public observes this. Now, I exploit this, these narrative episodes. One nice thing about doing this in a VAR is that I can construct a full historical variance decomposition, and I can ask the VAR whether it detects those shocks elsewhere in the sample. There is some tentative evidence that they happened elsewhere, but they are largely centered in the late 60s and 1970s. Now, the other nice thing is that I can quantify these effects. As I said before, while in cross-country studies we have a sort of qualitative idea that central bank independence is a good thing, what I can do here is for a given amount of political pressure-driven meetings, I can quantify the response on other macroeconomic variables. And then I can normalize that relative to the behavior of different presidents. And I show here, this is the headline quantitative result. If a president exerts half as much pressure as Richard Nixon did for 6 months, this raises the price level over the subsequent 10 years by 8%, which is a meaningful economic effect. Okay, that was the summary. Let me now talk about the data, how I construct the data, show you some descriptive figures, then go to the identification and the results. The data source are the daily calendars of US presidents that are available through the presidential libraries. Every president, after they are president, gets a presidential library where all the documents from the presidency are archived, and as the public, as researchers, we have access to these documents. The daily calendars are very detailed, almost minute-by-minute logs of what the president did. They are really fascinating accounts. For some presidents, they are available very easily, even as a searchable database. For some other presidents, they were pretty hard to access. And so as a shout out to some great Maryland grad students, I had support from research assistants who went to libraries and went through those calendars. For some Fed chairs, for some time periods, we also have calendars. They have less detail, but I cross-checked those calendars as well. Let me show you an example. I will zoom in a minute. You might not see this well. This is an example for President Carter, July 19th, 1980. It's just a random day that I picked. For that day, the daily calendar has 4 pages. These are the first 2 pages of the calendar. So in the bottom corner, you see page 1 of 4, page 2 of 4. You can see the level of detail that is provided here. If I zoom into the second page, there is a meeting that President Carter had with Fed Chair Paul Volcker that lasted for 20 minutes. And what's also interesting, right after the president talked to the First Lady for 1 minute. So what I did is I went through all of those calendars and simply found, so there's no NLP techniques or anything like that involved. It's just manual finding of information. I went through all of those calendars, found meetings with Fed personnel, and recorded them in a database. What I found is over 800 of such meetings in the sample period. I can construct some interesting summary statistics. The average length is 53 minutes. Most meetings are with the chair. Some are with the vice chair or Reserve Bank presidents. I can see whether other people were in the room, so I can break out one-on-one meetings, meetings that were on weekends, meetings that happened in social settings such as meals and so on. The key thing here is that the variation through time is enormous. So this is the one main chart. There's no identification here yet, but this is nevertheless a pretty interesting graph, I think. This is the annual number of meetings that each president had with Fed officials. So in principle, I can construct this at the daily frequency with many zeros. Here I aggregated it to annual frequency. And you see enormous variation. So President Clinton met with Fed officials only 8 times over 2 terms. And these were mostly appointment ceremonies and so forth. While other presidents had much more frequent meetings, in particular Nixon, in the second half of 1971, the year before the election, which I'm going to talk much more about, he met with Fed Chair Arthur Burns every 5 days on average. So they had very, very frequent interactions. So this data is, fun and interesting, at least I think so. But there's no causal statements here. This is not necessarily political pressure. Indeed, you see where inflation was relatively high, there were more meetings. That could be entirely reverse causality because inflation is high and the president calls up the Fed chair and says, what's going on? So I go a step further and develop this identification strategy. My idea is that I say, let me find certain periods in which I can argue that the meetings in those periods did indeed reflect pressure that the president exerted on the Fed, and the Fed chair actually gave into the pressure. I have 2 such episodes. They are under President Nixon and under LBJ. I'm going to talk mostly about the Nixon episode. I used that one by itself. That's already enough to uncover significant results, so I'm going to leave the LBJ Martin episode a bit aside. We're in the Martin building, so I didn't want to put him on the spot. So let's talk about Nixon and Burns. There is overwhelming, really strong evidence that Nixon exerted enormous pressure on Arthur Burns. It's well known. I'm going to show you a little bit of that. In the paper, I have a much more detailed discussion. Nixon taped conversations himself that he had with Burns, and we have the transcript so we can see what they talk about. Arthur Burns also wrote a diary at the time that reports on this. So there's overwhelming evidence of this pressure. Whether Burns gave in to the pressure is a little bit more contested. I actually have it later on in the VAR, I have a specification where I impose slightly less restrictive sign restrictions, where I don't allow or I don't impose that policy actually reacted, but my reading is that Burns did give in, and I have some evidence of that in the paper as well. I'm going to show you a bit of that in a minute. So here is just for fun some quotes from the diary of Arthur Burns in which he describes the relationship with Nixon. I'm going to sort of leave them there for a moment for you to read. This diary by Burns is fascinating. You can buy that on Amazon for $16 or something like that, and you can read it in 2 days. It's a really, really fun read. So what he reports in the diary and what also comes out in the Nixon tapes, which I discuss in more detail in the paper, is that Nixon wanted to be reelected, and he was of the view that the Fed should ease policy to stimulate the economy to increase his election chances. And he said this very, very explicitly to the Fed chair. He said, I want to be reelected. You better ease monetary conditions, otherwise there'll be a disaster, et cetera, et cetera. And he did this repeatedly in 1971. So did Burns give in? To me, the strongest piece of evidence is this one. Here I'm looking at changes in monetary policy before and after the Nixon re-election in fall 1972 in the tenure of Arthur Burns. And I have in dark blue the implied change in the Fed funds rate, and in light blue what Roma and Roma estimate as monetary policy shocks. So you see that prior to the re-election, there was a 400 basis point monetary policy easing, which Roma and Roma estimate to be entirely exogenous, entirely not explainable by economic conditions. While after the re-election, there was a drastic 800 basis point tightening, which is mostly systematic, because then inflation was pretty high and the Fed tried to curb inflation. Okay, so how do I now do that in the VAR? What I do is I set up a VAR. I have the time series of President Fed personal interactions as a variable in the VAR, and I otherwise have other standard macro data. I first impose some traditional sign restrictions that allow me to define what I mean by a political pressure shock. And I define a political pressure shock as a shock that increases these personal interactions, it decreases interest rates, and it increases inflation. So this is not a shock. This is not political pressure, for example, where the president would ask the Fed chair to tighten policy. This is a shock that is defined as something that through meetings entices the Fed to ease and tolerate higher inflation than it otherwise would. This might be either to stimulate the economy, or it might be to finance deficits, and so on. That's why I leave fiscal and activity variables unrestricted. These are the sign restrictions. Now, those restrictions are actually not enough, I will show this, to clearly uncover some impulse response functions. So I want to sharpen those restrictions using my narrative account. So what I do is that I impose on the VAR that in the last 2 quarters of 1971, that was the height of the Nixon pressure, I impose that the historical variance decomposition of the interaction variable, of the meeting variable, is mainly explained by this political pressure shock, by the shock that is described by these sign restrictions. So this is based on a great methodology by Antolin Diaz and Rubio Ramirez. They do that for standard monetary policy shocks, where they use the Volcker episode, and they do it for oil shocks with the Iranian Revolution. I use this technique here to exploit this narrative account for the Nixon episode. And again, this is still done in a VAR, so the shock can operate anywhere. Okay, the shock can occur at any point in the sample. I just impose that it occurred in a certain period to sharpen the identification. This shock is different from a monetary policy shock. These are the only equations I'm going to show today. This is just to fix ideas. Suppose we are in a static world and I set up a static VAR. It's just a simultaneous equation system. And suppose I just have one macro variable, inflation, that's pi. I have interest rates I, and I have x, which are meetings. And then each equation has a structural shock. What I can show in this system is 2 things. First of all, depending on your methodology, you might pick up political pressure as monetary policy shocks. But in my VAR system, they are allowed to transmit differently. The way to see this is as follows. If you just take the first 2 equations, so suppose you don't have this meeting data, then you can rewrite the equations as this second equation in the second bullet point. If you're Roma and Roma, you would basically run that equation as a regression. You would regress interest rates on macro variables or forecasts of macro variables and uncover a shock. That shock, as I show here, is actually a combination of the narrow monetary policy shock in my full system, the shock to the interest rate equation, and the political pressure shock. Okay, so if you're Romer and Romer, you're going to pick up political pressure as a subset of monetary policy shocks. However, if I have that data and estimate the full system, then the shock to the meeting variable, the political pressure shock, is allowed to transmit differently because, for example, the phi pi x coefficient in the first equation is non-zero. What this means is the shock that increases meetings can affect other variables, not through it can affect them through monetary policy changing or otherwise. And this could be because agents observe the meetings and they change their behavior. Okay, so this shock, depending on your methodology, you might pick it up as a monetary policy shock. In my methodology, I can estimate them separately, and their effects can be different. Okay, let me go to the results. These are the impulse response functions to a political pressure shock over the full sample. I'm showing here the 6 variables in the system, which are the President-Fed interactions, the price level, interest rates, government expenditures, real GDP, and the deficit to GDP ratio. In each panel, there are 2 sets of impulse response functions. In the background, there are these gray bands. These are the posterior bands for impulse response functions for which I do not impose the narrative restriction. I only use the sign restrictions. What I estimate here is basically very wide bands. It's very inconclusive. So I need this narrative variation to sharpen inference in this setting. This is a finding that Antolin Diaz, Rubio Ramirez also show for other shocks. Okay, so let's look at the red impulse response functions. I normalize this shock to increase meetings by 10 meetings in a given quarter. This is quite a lot for the average president. It's not that much in light of what Nixon did. So what we see is that this shock increases the meetings, and actually there's some persistence in the meetings going forward. It lowers interest rates by about 100 basis points, and it very gradually but strongly increases the price level. Okay, I'm showing here fairly long impulse response functions over 10 years. What you also see is there's not much going on with other variables in the system, not much going on with fiscal variables and with real activity. If anything, when I do some sample splits, you saw in the figure that after the 1990s, there was just not much going on. There weren't meetings, pressure probably just didn't occur since the 1990s. If I do the sample split, I get somewhat sharper responses. These are now only the red ones. And if anything, I estimate a reduction in overall real activity from political pressure. So how do we interpret that? One interpretation is, well, political pressure is just not successful. Agents in the economy understand that that's going on. The credibility of the central bank suffers. And what we have in equilibrium is just higher inflation. That's what happens in a typical Barrow-Gordon simple setup, where with rational expectations, if we understand the reaction function of the policymaker kind of wants persistently positive output gaps, for example, we just have higher inflation. That's consistent with that. Another interpretation could be that maybe Nixon understood, and for that matter other presidents understand very well, that lower interest rates please certain people, and those are important voters. That could be even while overall activity doesn't respond much. It could be that it is beneficial in helping re-election. Indeed, we know Nixon was re-elected in a landslide. I mean, he did all sorts of other things to be re-elected, but that's what we know. Okay, this is a historical variance decomposition. The black line is inflation, and the blue bars are the contribution of political pressure shocks. They can be positive or negative, so interpret that as sort of, the shock itself can be positive or negative. You can interpret that as deviations from a mean. What we see here is that in general, political pressure is not an important driver of inflation over the sample. We wouldn't expect that. It's not something that happens very frequently in the US. It's something that is indeed quite hard to detect. But what we do see is that it clusters in the late 1960s under LBJ, under Nixon, and there's a little bit also under Ford that, according to the VAR, can be attributed to these shocks. I have more results in the paper that, in the interest of time, I'm going to briefly summarize, although they are quite important. So what I do show is that a monetary policy easing shock transmits very differently from this political pressure shock. I showed formally why that can be the case. That shock, the easing stimulates output, so output goes up. That's not the case with a political pressure shock. And the inflation reaction is much more short-lived. It doesn't have this persistent increase in inflation. Then one thing that is basically my biggest concern with this paper is that in that period, 1971, there were important other macroeconomic events. In particular, the end of Bretton Woods coincides with that political pressure. That is a big concern. There's a test I do in the paper, which is the following. I say, let me take the same VAR, let me remove the personal interaction variable, and let me do a narrative identification where I impose that I isolate a shock that's the main driver of inflation in 1971. That can be a combination of all sorts of structural shocks, but that is something that, without looking at those meetings, that I identify as the key inflationary impulse in that period. And what I show is that the impulse response functions to that shock have a much more short-lived inflation impulse response function. okay? So it is in the meetings, something in the meetings is informative about a different kind of shock that has a very different effect on the economy, and that I interpret as political pressure. And then finally, again, I add the Lyndon B. Johnson, William McChesney Martin episode, and that actually sharpens the results a lot. So here the evidence is also very clear that LBJ pressured Martin. There is an account where LBJ was from Texas and had a ranch there. He invited Martin to the ranch and took him on his shirt and shoved him against the wall and said, I want you to ease monetary policy. That's apparently the anecdote. But here it is the account of whether he reacted. So historians say Martin actually withstood the pressure much better than Burns. So I only have this as an additional episode. So a little bit more on how it's different from monetary policy. Okay. Here are the impulse response functions of inflation expectations. In the top row, mean inflation expectations. In the bottom row, the dispersion of inflation expectations. 2, in the left row, the political pressure shock. In the middle, the monetary policy shock. And on the right, this generic 1971 inflationary shock. And what I show is, and this is normalized to induce the same interest rate change. So what I show is that the political pressure shock has a much stronger effect on inflation expectations and on inflation disagreement. And this comes with a time lag, which is also interesting. My interpretation of that is it happened at the time that Nixon pressured Burns. This was reported on, and people began to understand what was going on. I mean, in this conference, we're still talking about what drove inflation in 2021, 2022. So it's sort of backward looking, understanding that. And that's what agents did at the time. They saw what was going on, and over time there was much more discussion around this political pressure. I'm not going to talk much more about that, but in the paper I have a big discussion around the fact that the public did see that pressure in real time, and the discussion around the pressure continued much after those policy changes. Okay, so people were well aware what Nixon was doing, and they sort of grappled with the reality that, you know, the Fed was impacted by politicians at the time. And this increased inflation expectations. Okay, let me wrap up. This is a difficult question to study because it's a fluffy concept, political pressure. We need to be clear what we mean. I have a specific definition. I have some data that reflects, I argue, political pressure in certain periods, and then I can quantify the effects of political pressure. This is not cross-country, this is for the US through time, and I think it's something important to think about. I also want to say I make these meeting time series available for other researchers. Thank you.
Thank you, Thomas. Evgenia, please.
So good afternoon, everyone. Yes, I need slides. Good afternoon, everyone. A big thank you to the organizers for including me in the program. It has been a really fantastic conference. I have been very excited to go through the work of Thomas, in particular because of my own research interests and agenda, and I really enjoyed the paper. So the background for this work is go back to the politics of monetary policy, and we can trace it back to the early works of Alesina and Summers, and Dinser and Heijengreen. And essentially, those papers looked at the extent at which monetary policy independence can have a measurable effect on a bunch of economic variables. So there is another literature that goes back to Sargent and Wallace that looks at these monetary fiscal interactions, and as Thomas very well explained, we can think about fiscal dominance as a form of political pressure for the central bank to finance essentially deficits through inflation. So the first part of the literature deals with cross-country comparison, while in the second part we have these fully well-specified structural models. But given the recent interest and the tweets by President Trump, which have been picked by essentially Bianchi and co-authors, besides this paper, we have very little causal evidence about how political pressure can have an impact on monetary policy or central bank independence. So this is exactly the gap that the work of Thomas is trying to fill. So he proposes an identification strategy that is going to try to discern exogenous shifts in political pressure and then quantify these effects in macro variables. So a few words about the paper. So part of the contribution, as I'm going to say in a moment, is this very beautiful data set that Thomas built. He digs in archival records between 1933 to 2016. So the last two presidencies are excluded because the data are not available yet, but should be available. And essentially, he uses a narrative approach in a SVAR framework to try to identify shocks of political pressure on the Fed. So he's using essentially the technology of Antolin Diaz and Rubio Ramirez, and I'm going to say a few words about that. So he takes this narrative restriction in a SVAR, and what he finds is that there are essentially significant and persistent positive effects on inflation, while the effects on activity are weak and negative in the few cases that they show up. So Thomas finds effects outside Nixon's presidency, and it's one of the merits of the methodology, which is not an event study, so we can make these predictions. We can look at what is happening through the full sample. And he comes up with a different propagation mechanisms that standard monetary shocks, right, as he explained. So the paper makes different contributions. So as I said before, a big contribution is just building this beautiful data set. But more importantly, what this paper does is it really advances our understanding regarding the benefits of central bank independence. So right, we have a framework to think about those issues. So one can use those estimates to discipline really macro models, so the models that look at these fiscal monetary interactions. And there are also some normative implications when we think about the future and whether presidents should exert pressure on the Fed and what those implications are going to be. So I'm going to structure my comments in three parts, and in the interest of time, I'm going to skip the fourth, which has to do about the structure of the paper, which I think is only going to be of interest to Thomas. So I'm going to proceed from more important to less important. And the first thing I would really like to discuss is the general idea of identification in this paper. Given that Thomas is really going for the kill, right? So he is making a causal statement here about the effects of political pressure on the US macroeconomy, and he tries to really quantify these effects. So 30 seconds about the Antolin Diaz and Rubio Ramirez paper, the AR of 2018. So the nice feature of this paper is that they can use a really small number of key events that are very unambiguous in a sense, to pin down, essentially, sign restrictions. So the strength of the identification relies on two key assumptions. Number one, there is no ambiguity about these restrictions. Crucially, number two, the importance of the shock, of the event of interest, should be way bigger, if you want, than any other shock that is happening at the same time to explain the unexpected movement of the variables in question. So it's very crucial to get this assumption right, because in the paper, really Thomas relies on one single event, right? So the bulk of the paper is built around essentially Nixon's pressure of Burns, and there's the second event that he looks in robustness, which is notably less strong. So if we think about the measure, so Thomas discussed the measure pretty nicely. So we have this proxy for political pressure shocks, and this is a noisy proxy because there is heterogeneity as those interactions happen, also in response to economic conditions. There are, in my opinion, a bit of further issues, especially when you think about the normative implications, because you can see this clustering of events around the 70s period. That is a very special period. And also I found that in terms of annual counts, even Ford meetings tops that of Nixon, which caught me a little bit by surprise. So the event we're really studying is Nixon pressure of Burns as this indisputable evidence. And there are two legs in this argument, right? The first leg is pretty clear, is very well established, right? So we know that Nixon put a lot of pressure on Burns in order to be reelected. So Thomas discusses a lot about it. I think it's even too much, right? We know that. There's consensus about that. There is less clear evidence that actually Burns bent into the pressure, right? So he gave in. And I would claim it's kind of important to establish that this second beat happened, right? So Thomas presents some arguments to support this argument that Burns gave into the pressure. The most important one is the fact that Romer and Romer are estimating these easing shocks ahead of the election. And I'm going to come back, I'm going to cycle back to this point. A second bit that he did not understand, that I think is something you can even strengthen more, is that he's looking at votes of the dissenting members of the Fed. So before the policy change, before the election, where the policy was thought by the dissenting members to be more accommodating, and then he shows the same votes of the dissenting members after the election, where Burns is much more tight on the policy and people are more dovish, right? So I would say for this point, what I would see, what I would establish, is whether those guys are the same guys that vote both times. Have they been replaced? Do you have newly appointed board members between the two periods? I think is sort of important to know. There's also some, ambiguous quotes from Burns that Thomas also showed that to me these are not particularly clear in the indication of what he did. And there are a few more issues, right? So if you really think about the number of interactions, to me, they could also indicate a pushback, right? So when you have to meet again and again, clearly things are not very smooth. Number two, I think you should really consider a little bit the power of the Fed chair. So there is evidence, essentially there is work that estimates the weight on policy decisions of Burns being between 40 and 50%. Also, Claudiana, in one of her papers, is citing this source. So Burns, by some of the economists, is thought to be quite tough when it comes to battling inflation. And if you think more generally about the policy of that area, it's pretty particular, right? So there's high priority when it comes to full employment, a lot of focus on activity, and there's a lot of mismeasurements around economic variables and notably output gap. So we kind of know that policy around the 70s failed to keep inflation expectations anchored for a number of reasons, exogenous to political pressure, and that led to high and volatile inflation. Now, things you could do to help your argument, I think you can reconcile ex post the peaks of the political pressure to the Fed with other measures of central bank independence. So there is a paper by Unsal and co-authors that does sort of a literature review a little bit. So it's not a literature review, but it gives you a lot of references. And then you can combine your index of personal interactions with some narrative that you can get from the FOMC meetings, right? So you have a lot of richness in information, and combining the two, I think, can give you something much, much stronger. So very quickly, number two on inflation expectations, I think that given that the agents are picking up this information from the news, right? I think there are two different treatments there. So you're reading that they're meeting a lot and they're clashing. Are they taking in political pressure, or are they taking in there's trouble in the economy, and can they really separate the two? And if you're looking essentially at this time series of the news in the press, that looks not very much informative. Alternative, what you could do is you can look at the composition, right, of the news that have to do with monetary policy to see if there's a change in the way that these news are reported, right? So maybe there is a pattern that you could pick differently there. Now, number three, given that I really, believe in these normative implications, and we're missing the current data under Trump and Biden, this data will be made available, but we're looking at a period of COVID, restrictions, pandemic, so personal interactions mechanically are going to go down. So potentially now this measure, the ways of political pressure are going to be different. Again, looking at the news could be valuable. You have a high frequency component there that you can exploit a little bit in the spirit of Bianchi and co-authors. I'm going to skip the paper structure. I think it's a very cool paper. I think really Thomas is dealing with an important topic. I really like it. Very detailed work, methodological contribution. I think you should really strengthen a little bit your IV, and I really hope that this paper does very well. Thanks.
Thank you, Eugenia. Let's collect a few questions, and since we're already over time, if you could please keep questions and answers concise, that would be great. Thank you.
Hi, Thomas. Great paper, great discussion. One question I had was about the interpretation and the external validity, let's say, of your analysis, meaning we focused a lot on the Nixon era, which is, we have many meetings, high inflation. Now, if you do a constant parameter var, I'm wondering what will be, or like it will be interesting to look at what are the implications for other periods in history, for instance, in terms of meetings. So what are you extrapolating for, say, what happened subsequently when the number of meetings went down dramatically? However, you have identified the shocks based on this very high meeting period. So is the implication of the model that you have a lot of pressure also in later years, maybe even shocks that are with a standard deviation that is larger than the realized meetings, just again given for the... And then going back to the point that was made about news, whether you could validate your results by actually looking at maybe media coverage of political pressures, but just even outside your VAR and saying, well, maybe it doesn't happen through meetings, but just president speaking about the Fed, I don't know, puts downward pressure, I don't know, or puts pressures on inflation expectations or some other, or, for the Fed funds futures or stuff like that, so that it kind of nicely shows more robust evidence for your hypothesis.
I thought it was a really interesting paper. I had a question about a particular event, so the Accord in March 1951. Truman hated it. He pushed back, called the whole board over to a meeting at the White House. He issued a press release. There was a huge fight. In the end, though, he was unsuccessful, I think. And so I wouldn't have expected any particular inflationary effect as a result of that, or maybe even the sign should be reversed. So all meetings aren't the same, and sometimes you kind of know what the sign is, and maybe that also could be a useful way of getting at this effect.
So I have a question about the, motivated by the variance decomposition. So all of your narrative discussion is about these periods when there was this sort of pressure to ease policy. And then in the variance decomposition, you see other periods where, there was a shock in the opposite direction. So coming from the VAR. So that sort of makes me think we should think that President Clinton managed to keep inflation low by avoiding Alan Greenspan. If we don't think that shocks operate in that direction, how do we sort of interpret the VAR evidence?
I also had a question on the interpretation, and I also think very interesting paper. So I was struck by the persistence of the effects of the shocks, because it may well be that some Fed chair was threatened into easing rates, but Fed chairs don't stay there forever, and 10 years, even if there is an excessive easing at some point, that could be reversed after a while, either because the president or because the Fed chair changes. And well,
I have a couple of questions. One is about, so the frequency is informative about there could be some political pressures, and here I'm echoing some of the other questions. Can you have some validation maybe through newspapers to see whether they, the news they comment and they say, well, there were some pressure? And the second point is that communication might have changed through time. So now, for instance, in the latest data, we see that the meetings are not so frequent as they used to be in the 70s. So is then that measure of frequency of meeting really representing pressures, or pressures can be also delivered in other ways, phone calls or other ways? Thank you, but fascinating.
Yeah, really impressive paper and very nice discussion. Just a quick one on, perhaps you can exploit a little bit more the timing of elections and do some interaction there to, to strengthen the IB.
Okay, first of all, thanks a lot for the very thoughtful and very helpful discussion and all the questions. Let me select a few things and organize them a little bit, and I'm happy to chat more after. News, yeah, that's a good idea. That came up a few times. I'm already doing that to some degree. I didn't show that. I can certainly do more there, and I'm planning to do more there. What I found is, one thing I did is I looked at major US newspapers. I counted the articles that were about the Federal Reserve in general, and then I counted articles that were talking about central bank independence, political pressure, and then I divided one by the other. That was the chart that was in the discussion briefly as well. And what I found there is that it seems that after the 1970s, there was a permanently more intensive discussion about central bank independence. It's almost like this pressure led to a permanently higher discussion. I didn't in any way formally use that data in the VAR, but I think I could, and that could be nice. So thanks for those suggestions. Things are different through time. Yes, that's certainly true. It's impossible to have a measure over that time period that's definitely always works in the same way. But I think at least this is something. At least this is a good start. And my argument is that pressure can certainly be exerted in a different way through different channels. But this is a measure that I can construct consistently through time, and that arguably in some periods can pick up that pressure. Okay, so but it doesn't mean every way of pressure is reflected by that measure. I tried a little bit to also look at Treasury Secretary calendars. That's much more difficult to get, because that could be another channel. The president just asked the Treasury Secretary to talk to the Fed, but I have that for some sub-periods. It's not in the paper. I might get more there. The Ford episode that came up, Ford had the biggest spike in meetings, but my understanding of that period and also what comes out of the VAR is that this was just largely an endogenous increase in meetings because of the oil shocks that took place in the 70s, and that just led to a big discussion between the President Ford and the Fed. That comes out in the VAR as well. The VAR does pick that up a little bit as pressure, but it's mainly endogenous. The Treasury Fed Accord, that's pretty interesting. When I exclude the period prior to the Treasury Fed Accord, the results essentially go away. that I interpret that as the Treasury Fed Accord was basically de facto. There was explicit coordination between the Fed and the Treasury. So in some sense, in that early sample period, there is, in some sense, there's pressure systematically baked in, and that variation seems to be important for my estimates. That's how I think about the Treasury Fed Accord. The identification relies on crucial assumptions. I agree with that. That's, I think, always how it's going to be. There were very nice suggestions about more that I can do on burns. Those were great suggestions. I'll certainly look into them. And the persistence in the effects, yeah, I mean, I think this is through an expectations channel that inflation just becomes very entrenched when there's an understanding that this has happened, this might happen again, even if it doesn't happen again. And this, sends the economy on a path with higher inflation expectations and more persistent inflation. That's my interpretation. And timing of elections, yes, I haven't done that explicitly. I've thought about it. I'm not sure if I will find much because I just think this doesn't happen systematically enough in the United States. I think in other countries, this is a very systematic pattern. In the Nixon era, I argue the proximity to the election was crucial. In general, I don't think there is much. Indeed, I mean, some presidents like George H.W. Bush famously said he lost the election because the Fed ran policy too tight. There were presidents complaining that it went the other way. I think this is interesting. I think this works in other countries. I'm more skeptical in the US, though I can look into it more. I'll stop here. Happy to chat more. Thanks a lot, everyone.
Thank you, Thomas. Thank you, Eugenia. We will reconvene at 4 with a great panel coming up. Thank you.
take their seats. Let me welcome everybody to this final session. And like everybody else, thank the organizers for inviting me to participate today. In terms of logistics, what we're going to do, the panel lasts an hour and a quarter. I'm going to start us off briefly, then get out of the way of our panelists. And each of the panelists will speak for 10 minutes or something like that. Then I'll encourage them to comment on each other's remarks and perhaps add a few questions of my own, and then we'll open up to questions from all of you. So as you're listening, think of hard questions to ask our panelists. The title today is The Conquest of Inflation, Challenges in a Post-Pandemic World. And I thought maybe I could set up the conversation by making a few observations about the post-pandemic inflation. First, as this audience knows very well, the inflation was a surprise. If you look at global inflation forecasts, say from the IMF's WEO, they were marked up steadily for almost 2 years, from early 2021 to late 2022. Second, that inflation was a global phenomenon. Almost all major economies experienced high inflation. The correlations of inflation across economies were strikingly high, unusually high. This was a global story related to pandemic disruptions and policy. Third, that being said, there were significant differences across countries. Inflation rose, but by less in Japan, say, or Switzerland than in the United States. Inflation experiences and inflation expectations seemed to matter, as did government responses. Fourth, many central banks, particularly in advanced economies, responded to the inflation slowly at first, but then moved rates up very quickly. There are a number of reasons for the lagged response: the poor forecasts and poor understanding of the inflation at the outset. I think also partly risk management. People were looking back at the experience post-financial crisis, and partly communications problems that we may talk about in a bit. Fifth, inflation's come down rapidly as the pandemic-related disruptions have resolved, and real economies have performed surprisingly well. But inflation generally remains above target in advanced economies, and we'll see if inflation really has been conquered. That word in the conference title made me slightly nervous, and whether central banks have more to do. So to think about that question and to tease out lessons from this experience, the organizers have put together an outstanding panel of 3 economists who don't really need an introduction, but I'll give one anyway, but I will be very brief. First, we have Olivier Blanchard, the Robert Solow Professor of Economics Emeritus at MIT and a senior fellow at the Peterson Institute. Olivier got his PhD from MIT. He taught at Harvard, went back to MIT, where he later served as chair of the economics department. He left MIT to serve as the economic counselor and director of the research department at the IMF from 2008, I think September 2008, bad timing, until 2015. Our second panelist, Jim Bullard, or as I have to think of him, President Bullard, after 15 years of working with him. He's the Dr. Samuel Allen Dean of the Mitch Daniels Jr. School of Business at Purdue University. He received his PhD from Indiana University and moved to the Federal Reserve Bank of St. Louis straight out of school, where he moved up and was research director, and then from 2008, there's that year again, until 2023, was president and chief executive officer of the bank. And finally, Silvana Tenreiro, professor of economics at the London School of Economics, and currently a member of the external advisory group at the IMF. She received her PhD from Harvard University, then worked at the Federal Reserve Bank of Boston before moving to LSE, and she served as an external member of the Bank of England's Monetary Policy Committee from 2017 to 2023. So welcome to you all. Thanks very much for participating today. And Olivier, you can start us off. Thanks.
Good. So as probably many of you know, I wrote last year a paper with Ben Bernanke on the US inflation. And our idea was to write down a very simple model, simple enough that policymakers could fully understand it, and use it to look at the data. And we did it, and it played decently, I would say. I mean, it seemed to resonate with the way people were thinking about it. And so as a result, I was approached by 10 central banks saying, well, it would be fun to do the same thing. And so we decided that rather than have each one just go at it alone, we would actually make this a joint project. And so I have the honor to have directed 10 central banks, which is better than 10. And this is the result of the exercise. It has been fun. We basically looked at data until the middle of 2023. Clearly, it would be fun to extend it to later, but we haven't done that. What I'm going to do is give you a sense of the main result. The paper is being edited, and the replication team is at work. It should be out in, I would guess, less than a month. You have a list of countries on the screen. So you basically have Canada, the US, you have Japan, you have UK, and then most of the other countries are Euro members. So one of the interesting aspects of the project, which I will not talk about, is one project was done by the ECB itself, and there was a number of national projects, and the question is, how do the two fit together? And I will not give you the answer, but it raises issues, again, about monetary policy and very heterogeneous, across very heterogeneous regions. In the US, there's a lot of similarities, so we don't think too hard about the differences. But clearly, for example, the labor markets are extremely different in different countries, so you find different dynamics. But that's not what I'm going to talk about. So this is the model. It's probably written a little small. I mean, it is, I would say, an undergraduate model. It's very traditional. Let me just go through the basic logic of the equations. 4 equations. A wage equation in which we allowed the wages to depend on the state of the labor market. And the one choice we made was to use V over U rather than U, which is an issue which may have been discussed at this conference, but it actually makes a difference. We thought that V over U was better. So it depends on the state of the labor market. It depends on short-run expected inflation, quite logically, if you're going to set wages next year. And it depends on what we call catch-up, or it's called real wage gap, which is that if there has been unexpected inflation and your nominal wages have not adjusted, that no matter what your expectations of the future are, you basically want to get it back. So we allowed for this effect. But beyond this, it looks fairly typically a typical wage Phillips curve. Then the next step was the price inflation, and we just assumed that prices were a markup on wage cost, both wages and productivity, and the price of a number of, relative price of a number of inputs relative to wages. We chose, not surprisingly, energy as one of the relative prices, food as another one, and then shortages, which is not a price measure, but which we think is associated with price spikes. And there are no series for price spikes. There are series for shortages, so we use that. Then the last 2 equations are equations about expectations. So we assume that long-run expectations depended on themselves. There are always lags in all these equations, and actual inflation. So the degree to which people revise the long-run target in a way as a result of inflation. And then short-run inflation expectations, which we assumed depended on long-term expectations, the anchoring at the end, and actual inflation. And we just wrote down them all. Analytically, you can do it in your head, nearly, and empirically, we just went at it. We were very generous. So, in these games, there's always the issue of if you do traditional econometrics, of a lag structure and so on. And there we did something which both Ben and I have played with over the years, which is VAR-like, which is allowing for 4 lags, basically, on everything. But in effect, there are zeros in various places because some variables don't belong to all the equations. I think that's a way of letting the data talk, but clearly it is not as tight as something in which you've taken out everything which is insignificant. Anyway, so that's the background. And I think all the teams basically use the same structure. The variables were a bit different across countries. There is an issue which you may have discussed about the wage equation. Very often, the models that we use don't have wages and prices. They just have prices. When you decide to have wages and prices, then you have to decide what you use for wages. Is it compensation per person? Is it compensation per hour? Is it newly negotiated wages? And it makes a difference, but not to the points that I want to make now. So I'm going to basically show you the characteristics of the estimated model and then the historical decomposition, how we interpret inflation. So the first conclusion is that what dominated month to month or quarter to quarter action were price shocks, relative price shocks, without any question. Most of the action came from. And this price shock kept coming. I think Team Transitory was right about the fact that price shocks should not have long-run effects, but what they had not seen is that there would be a very long series of price shocks, including Ukraine for Europe. And so what we found in the econometrics is that, yes, there were price shocks. They had an enormous effect month by month. We use quarterly data. But they had no persistence. Each one basically came and died. Now, this is the result in the econometrics of finding basically very anchored short-run expectations, no catch-up effect, and little pass-through of wages to prices in the short run. So you can see for the US, I mean, the blue line, I think, is energy. It's a shock to energy. It's an IRF, impulse response function to energy. The red line is food, and the yellow line is shortages. You see that there is an effect at time 0, but after this, basically, there's not much. Same thing for the other countries. I put the euro as an alternative, and then I have a graph that you cannot make any sense of because it's much too small, but it's basically the result for each of the 10 countries plus the estimation for the US that we have with Ben. And you can see that basically uniformly we find that there is no country in which there is much persistence of price shocks. Again, I'm going to be in commonalities, not differences. You can see Germany is a bit different, but fundamentally, I think the story is there is a shock, big action, next quarter, not much. Now, that's only half of the story, which is that during the time, initially there was more unemployment, but then unemployment decreased, or the vacancy unemployment ratio increased, and the labor markets became fairly tight over time. In most countries, the ratio of vacancies to unemployment is higher now than it was in just before COVID at the end of 2019. And this had an effect, which was putting some wage pressure, not in 20, but in 21, 22, 23. Oh, not in 2021, 22, 23. But the tension was, so the effect of this was pressure on wages, but what we found is basically a slow and small effect on wage inflation. Yes, the labor market was tight. This was putting some pressure. This is the impulse response of inflation to a one-time permanent increase in V over U. So in a model which has the natural rate property, which our model does by construction, you would expect that you're above the natural rate, and therefore you're going to keep inflation increasing forever. We find this, but you can see that the effect is very moderate. Basically, there's not much labor market pressure. And I give you the US, I give you the euro, in which it even doesn't look like it's going up at the end, but if you saw a longer sample, it would. But let me again give you kind of a general impression from the 11 countries. You can see that it has the right slope in the sense that there is pressure on wage inflation, and the longer the other U is too high, the more pressure builds up and we get inflation. But it's very moderate. And so this is the second part of the story, which means that for most of the inflation period, that channel didn't play much role. it was entirely dominated by the price shocks. When the price shocks started turning around, then what was left was basically what was behind, which was wage inflation, which is now, I think, in many countries, the issue. So we use them all to basically do a historical decomposition for each country. Very simple. We had a number of shocks. We had shocks to prices. We took V over U as exogenous, which clearly in a more ambitious model, you don't want to endogenize and find out how much was due to fiscal, how much was due to monetary. So in our model, this is a shock, and we look at the effect of shocks to VU. And this is the picture which comes out. And let me spend 1 or 2 minutes on this. So this is basically what we do, is we do a shock, close all the other shocks, do the dynamic effects for them all. That's a contribution of a shock. Then we do it for the next shock, and then we do it for the residuals, which don't appear here, but clearly also determines the dynamics. The model fits well, so the residuals don't play a major role. What you see is, and if you look at blue, light blue, dark blue, and yellow, these are the price shocks. And you can see that they move all over the place. Basically, there are quarters. This is quarterly data in which there is a big energy price shock. These are annualized rates for quarterly changes, so these are big numbers. But you see that the action really comes entirely from big shocks becoming smaller over time. The interesting part is the red part. This is the contribution of the labor market. This is the contribution of V over U. And as you can see, it's very small. At the beginning, it's small throughout. At the beginning, it's negative. There's some pressure down during the acute phase of COVID. Then it becomes positive. And by the end, it contributes about 1% to the total inflation, the rest being the price shock. The gray is what would have happened if there had been no shocks. So this is the baseline, and the shocks come in addition to this. So the conclusion from the US is, well, the shocks came and largely went, but there is a bit of wage pressure which comes from the accumulation of wage pressure from V over U, and then the effects on expectations. The interesting counterpart is, or counterexample, is the euro. You'd have to have very good eyes to see much effect of the labor market. Basically, one way of describing what has happened in the Eurozone, according to the estimated model, is that it has been entirely imported shocks. Energy shocks, food shocks, shortages, price disruptions, and basically no effect of the labor market. Even today, it's very, very small. So there's a difference. I think in the US, most of us believe that there was strong fiscal, and that played a role. In the euro area, there was no such thing as strong fiscal, and not much effect of a labor market, of a traditional channel for the Phillips curve, which is the labor market is tight, and this leads to inflation. That has played very, very little role. Now, the discussion today, this is again a paper based on data up to mid-23, the discussion is in the US and in Europe, is the last mile, which is, well, we're nearly there, but not quite. And the discussion, and it basically goes into aspects that we didn't have in the model. Clearly, wage growth is a bit high, still. The labor market is still a bit tight by historical standards. But productivity growth is higher, and if it continues, it allows wage growth to be consistent with price growth at target. Maybe the natural rate of unemployment, or the natural vacancy unemployment ratio, has changed, and we're fine. But clearly, this is what this building is dealing with. The point is, it didn't play much role throughout, but now that's the issue. For the euro area, the question is, again, there's not much market pressure. What should they do? I don't want to get into that discussion, but private demand is much weaker in the euro area. Fiscal policy is much tighter. So the ECB probably can decrease. But this is not what I want to focus about. I just want to give you this notion. I will finish with, given that this is a conference on monetary policy, on this question, which is a question I find fascinating at this point, which is what role did monetary policy actually play? As we've seen, most of the movements had nothing to do with monetary policy. I mean, maybe monetary policy affected energy prices, and it does in some contexts. I think fiscal policy did more than monetary policy. But fundamentally, monetary policy affects the labor market activity. It doesn't affect the relative prices very much. That's true both when inflation was going up and the Fed was being blamed, and when it went down, when the Fed was congratulated. It really had not much to do with what central banks did. And the reason we didn't have the 1970s, according to them all, is basically mainly the role of credibility and the anchoring of expectations. No indexation is another thing, but you saw how the price shocks just disappeared in terms of their effects, where in the 70s, they basically built up. And this was due to the fact, I think, that expectations were not well anchored then. But the question is, suppose you're a country in which you get these shocks, these price shocks, which you can't do much about. You can't do much about Ukraine. And the labor market remains, say, normal, just for the sake of argument. Why should you increase interest rates? I mean, the logic, we think, is, well, no, you should. I mean, typically, the labor market is too tight, and you want to. But in this case, I've given you a case, which is exactly the case of Japan, where, there's no action there. Why do you do it? Well, it seems to me that it's not because of the mechanical effects. It's because of the signaling effects, which is you've established credibility, you've succeeded in getting ongoing expectations anchored very well, and you want to keep it. And you have to send a signal, and you don't have many tools. But the question is, what size signal do you send? So Japan, for example, sent zero signal. Didn't increase interest rates at all, right? The ECB, where there was no labor market problem, increased rates. By how much should you do it? It seems to me that's a slightly different discussion from, the optimal Taylor rule, something like this. And the reason I mention this is I think we're going to see more of that. We're going to see, the geopolitics being what it is, we're going to see price shocks of various sorts. Whether it's the Strait of Hormuz, which is closed, or whatever, you can think of any scenarios. And so central banks are going to be faced with that. What do they do in this case? Could they do nothing because their credibility is so strong that basically it's fine? Or do they have to do something to make sure that credibility remains? And if so, how much? And I hope you give me the answer. And I stop here. Thank you.
Thank you.
I think you have to do something. Yes.
I have to do something here. Okay, thanks for having me, and thanks to the organizers for putting this together. So I'm going to tell a story that's my view of the world, and you're going to tell me whether this is diametrically opposed to what Olivier just said, or whether we're actually in agreement. So I think at the beginning you might think we're diametrically opposed, but at the end you might think we're in agreement. So we'll see if that's how it goes. So this is about where the inflation came from in the last several years, US focused, and why it went away. If you want to see a written version of these kind of comments, you can look at this Getting Monetary Policy Back on Track, edited by Bordeaux, Cochrane, and Taylor. I won't spend any time on this. So here's what I'm going to say. There was a fiscal monetary impulse, and it created too much inflation. And then to eliminate that inflation, the fiscal monetary impulse had to be credibly countered. And I think that countering happened. The fiscal impulse has receded in the US, and monetary policy made dramatic adjustments, especially in 2022, with the 475 basis point increases in the policy rate in succession, and the Jackson Hole speech of that year. And that better aligns central bank strategy with the 2% inflation target. So in response to this realignment, which was understood by markets in 2022, inflation expectations and inflation fell sharply. So now we see inflation expectations better realigned with the inflation target. So that's the whole story. So if you don't want to listen anymore, you can stop. You can check your email. But let's take a look at some graphs that tell this story. This is almost all pictures here. But again, there is a write-up of this basic story. So here's the fiscal monetary pandemic response in the US. This goes from 2016 up to last year. The blue line is the personal saving in the US with a trend line. The dotted blue line there is the trend line, and that's on the left-hand scale. And on the right-hand scale is the monetary policy measure, the gold line. Before the pandemic, it was rising a little bit. It went way down during the pandemic, effectively to zero, and then rose up dramatically in 2022 and 2023. So a couple things about this picture. The personal saving part of the blue line here, the scale on that is about 100 on the left if you look at it. And the peak at parts of the pandemic were up around 500. So five-fold increase, threefold increase. The one bill there is the March-April 2020 bill, and the other two peaks are the December 2020 bill that was passed through Congress, and then the March 2021 bill that was passed through Congress. Those are the three peaks. And this captures the part of the spending, the deficit spending, that went directly to household bank accounts. So it's kind of the monetary part. And so you could interpret this as almost pure money printing. You're putting money right into the accounts of individuals in the society. And then at the same time, of course, the pandemic is the gray area here, and the policy rate goes right down to zero. So I just want to focus on this period from 2020 and 2021 here in this picture. To me, this looks like wartime finance. This looks like the kind of thing that happens when there's social upheaval for the society, and you get a lot of deficit spending, and you ask the monetary authority to help you with the deficit spending by keeping interest rates extremely low. And what do we know about wartime finance across all kinds of different times and places and different institutions? We know it's a good recipe for inflation. And that's exactly what happened here. So I'm going to interpret this picture in the period right after the pandemic as the wartime finance impetus. So this is the genesis of inflation during this era. So how are you going to get rid of this? So I'm inspired by Sargent's paper, The End of Four Big Inflations. What you have to do is convince people that you're not going to do this kind of deficit spending indefinitely, and you also have to convince the private sector that you're going to return to orthodoxy as far as monetary policy. And I think both those things have happened, and that's why inflation has come back down. So this picture is from the San Francisco Fed, who's done a good job of tracking this personal savings picture, and this is from this year, 2024. And the blue line is the cumulative, or I'm sorry, the blue shaded region is the cumulative amount. 2.1 trillion, so it wasn't a small matter. And then that's all been, drifting away, the red area here, and it actually adds up to 2.1 trillion. So this has all gone, this part of the impetus has all gone away. Part of this you could attribute to just the fading of the pandemic fears, but part of it you could attribute to return to fiscal orthodoxy, perhaps by accident in the US with divided government between the House and the Senate. And then has monetary policy returned to orthodoxy? And I think it has, and we're going to use this Taylor rule specification here, which you'll all be very familiar with. And I'm going to do this in two ways. I'm going to give a very dovish Taylor rule, and then I'm going to give a somewhat more hawkish Taylor rule, and then a more hawkish Taylor rule than that. So the dovish version sets R star equal to minus 50, a value that I like because it helps you fit the pre-pandemic data. And then we'll measure the inflation gap in a dovish way by using the Dallas Fed trim mean. And we'll set this phi pi equal to 1.25, which is a relatively low reaction. Meets the Taylor principle, but is a relatively low reaction to inflation deviations from target. The less generous version is going to increase the R star by 100 basis points, so to plus 50 basis points, use a core PCE inflation for the inflation gap, and set phi pi to 1.5. So this is going to kind of set an upper and a lower bound, a zone. If you're in this zone, you can argue about whether policy is right, but if you're out of this zone, you'd have a much tougher time arguing that, that the policy setting was right. And then finally, we'll also look at the Holston-Lobick-Williams estimate, which I have as 1.3 or 137 basis points off the New York Fed webpage. So you get this picture. So this, the actual policy rate, this goes back to 2019 and comes to the present. The actual policy rate is the green line in this picture. The shaded region is the distance between this more dovish policy and the more hawkish policy that I just outlined. A couple of things about this picture. I like it that it fits the data pretty well pre-pandemic. So sometimes people want to change these parameter values around, but then you wouldn't fit very well with what was going on pre-pandemic. And I'm interpreting 2018, 2019 as being relatively good monetary policy. Then the pandemic comes along. Of course, the policy rate goes down to 0. And then this picture says that you should have taken off, according to both rules, you should have taken off somewhere in 2021. The committee did not move until March of 2022. And so this gives a sense of the behind the curve notion that a lot of people have in mind about too late, you're too late to take off, you should have been at higher levels of the policy rate. So by moving very quickly during 2022 and into 2023, you did get into this restrictive zone. And I gave this, I used this kind of chart in, I don't know if I can point here. I used this kind of chart in 2022, late 2022, and I said, well, the policy rate's going to have to get to 5 to 7%. And people said, well, that's really way too hawkish. But that's actually what turned out. The policy rate did get over 5% here, about to 5.38, which is where it is today. So you got to this sufficiently restrictive zone. Now, what has happened since then is that the inflation has come down by basically all measures, and so this zone has come down, and now it looks like policy is overly restrictive. So I think I would interpret the committee as looking for an opportunity to reduce the policy rate and get back to a policy rate that would make sense according to one or both of these Taylor rules. Now, many of you are saying that you have your own ideas about what R star should be. You're probably thinking of a higher value for R star, so let's use Holston-Lobick-Williams. That just in 2023 and 2024 here, that would give you this upper line here, but policy would still be overly restrictive even with that number in the policy rule. So that's why I've been arguing it's a little bit high right now for the policy rate, and it's probably going to have to come down. That's why I think the next move will be down. So what happened? You returned to orthodoxy on fiscal policy, returned to orthodoxy on central bank policy, and indeed, when did that occur? Mostly during 2022 and into 2023, and right when you did that, inflation started to come down. This has 3 measures of inflation here: Dallas Fed trim mean, headline PCE, which is actually only 2.5 here, and core PCE inflation 2.8%. right now in the U.S. So the story seems to hold together pretty well that, that the aggressive moves in 2022 were successful. Whether you'll be able to get the very last part of this is still up in the air. Inflation is still above target. And most of this goes directly through inflation expectations. So I like to use this picture here. This shows CPI inflation expectations from inflation swaps going back to 2021. This has the 2-year is the blue line, the 5-year is the gold line, and the 5-year forward is the gray line here. So in the first part that's circled on the left-hand side of this chart, that was the first quarter of 2021. At that point, there was no inflation, no measured inflation, no one was expecting inflation. All the forecasts were that inflation would be 2%. And so these are the values that you should expect to see consistent with the 2% inflation target. And then as you go through to the right, and especially mid-2022, these blow out, especially at the 5-year and 2-year horizons, and in the 5-year goes up to about 3.5%, according to inflation swaps. So I would interpret that as doubts in the market about whether the US was really going to return or not in a timely manner, get fiscal policy under control, and get monetary orthodoxy. And the Fed hadn't raised the policy rate until March of 2022, and it wasn't clear how aggressively we were going to act. So at that point, they were predicting quite a bit of inflation over 2-year, 5-year horizons. Then the Fed did take dramatic action, and actually the biggest, steepest fall there is associated with the June 2022 meeting. That was the first meeting where we moved 75 basis points at one meeting, and it started to become clear that we're going to move that fast during the remainder of 2022. All of that brought inflation expectations under control. It also became clear that Congress was not going to pass another bill that was, had a lot of deficit spending in it. And as you got through the rest of the year, inflation expectations came back under control into 2023 on the right-hand part of this chart. So that's my explanation for the journey that we just went through inflation. So you tell me whether, maybe Olivia, tell me whether this is consistent with his story, because at the end he was telling something very similar to this, where credibility played an enormous role in getting this under control. So my story is the monetary fiscal response impulse to the pandemic caused too much inflation. To eliminate that, we had to return to rectitude on both fiscal and monetary policy. This has happened, and inflation fell. So, thank you.
We'll let Olivia get in his gigs in a little bit. But first, we're going to hear from
Well, thank you very much for having me. It's been great to be in this conference these 2 days. I learned a lot from the papers and the discussions. So in my remarks, I will talk about the big picture, where we are coming from, where we are now, and have a few thoughts about the challenges post-pandemic. So starting with the big picture, we had two colossal unanticipated shocks, the pandemic and the war in Ukraine, which led to an extraordinary increase in the prices of energy and other commodities, all in a space of less than 3 years, which makes it the most remarkable concentration of tail events. To give a sense of magnitudes, for many countries, the increase in energy prices alone was larger or comparable to what they experienced in the 1970s. And it was particularly large for the UK economy. The cumulative increase in retail energy prices since 2019 reached a peak of 115%. This was more persistent and stood far above the increase in the US, which peaked at less than 35%, and even the euro area, which peaked at just above 80%. So these are huge numbers on a component that enters directly the CPI average. And these differences are humongous. And so what explains them? Well, 3 factors. First, differences in domestic production capacity. The US is self-sufficient when it comes to the production of gas, and indeed it's a net exporter of liquefied natural gas and other commodities, whereas the UK and the euro area are net importers. Second, differences in the fiscal response to the global energy shock. Some euro area countries had very generous subsidies to energy prices, and so that led to a very heterogeneous impact of the shock on the economies. And third, differences in the scope for trade and technological diversification, with some countries responding very quickly and expanding their imports from North Africa or resorting to alternative sources of energy. Now, this large variation in energy prices got reflected on CPI inflation, as that fed into various indirect effects. Many goods and services use energy in different degrees, so that got fed, passed through quite quickly. Now, of course, this is not just a story of energy prices. With the pandemic, we saw a big rotation of demand from services to goods, and that led to another massive increase in goods price inflation, as Olivier discussed. Now, by simple arithmetic, in order to offset the direct impact on inflation from these enormous increases in the prices of energy and imported goods, one would need an equally massive deflation, that is negative inflation in services, which at the time would have been achieved with higher unemployment. And that was precisely what governments were trying to avoid. So to be concrete, to get inflation at target in the UK in 2022-2023, we would have needed a massive contraction in activity comparable to the financial crisis, if not higher. That would not have been consistent with the remit of the MPC, the Monetary Policy Committee. I'll discuss this in a little bit. And it wouldn't have been consistent with any notion of optimal macroeconomic policy. So there are two aspects of monetary policy that I thought were not very well understood or by commentators at the time. One is that monetary policy operates with significant lags. For the UK, it's reasonable to expect the impact of monetary policy to reach a level close to peak around 12 to 18 months following a change in bank rate. Taken at face value, that would say that only now we are starting to see the full impact of the tightening cycle. The second aspect is that monetary policy is, at the end of the day, an aggregate demand tool. Increasing interest rates can reduce inflation and inflation expectations by reducing current and expected aggregate demand. So when inflation is demand-driven, raising interest rates resolves all the problems. We have Olivier's divine coincidence. It can restore inflation to target and activity to its potential. But when inflation is driven by supply or cost push shocks that weaken activity, then monetary policy faces a trade-off, and increasing interest rates to reduce demand exacerbates the weakness caused by the original shock. Now, arguably, in the UK and Europe, inflation was overwhelmingly driven by supply shocks. Consumption in the UK today is 2% below what it was back in 2019. And in Europe is just marginally above that level. In both cases, way below the pre-COVID trends. The US looks different, with consumption 11% above its pre-COVID level. And so we could argue that demand propelled by the fiscal stimulus, as Jim argued, played a bigger role in driving demand in the US vis-a-vis Europe and the UK. Now, given this combination of lags and trade-off inducing supply shocks, the optimal policy prescription would be to look through the direct impact of the supply shock and focus on second-round effects, effects via expectations inertia or backward-looking wage catch-up, making sure that inflation returns to target in a reasonable period of time. And this is what most central banks have been doing. And indeed, it's this combination of lags and supply shocks the reason why most central banks have flexible rather than strict inflation targeting regimes. This is clear in the US dual mandate. In the case of the Bank of England, the remit explicitly says that in the presence of shocks that are large or persistent, the MPC, the Monetary Policy Committee, can balance the speed with which it returns inflation to targets so as to limit output or employment volatility. So in light of that, I mean, even assuming that the pandemic and the war in Ukraine had been fully anticipated, having inflation at target in 2022 to 23 by generating a dramatic or deep economic contraction would not have been consistent with the remit. In response to a large and transitory supply shock, transitory at the end of the day, like the pandemic or the war, the role of monetary policy is to return inflation to target over a reasonable period of time, trying to limit losses to output and future output potential. So the key role is making sure the second round effects don't sink, don't firm themselves. So where are we now? We have seen the unwind of the energy shock, and we are seeing it's also the unwind of its indirect effects, as well as an easing of all of the COVID-related supply restrictions. That unwind or reversal of the negative supply shock has led to stronger activity and has pushed down on inflation. Meanwhile, restrictive monetary policy have pushed down both on inflation and activity. I mean, coming back to what Olivier was saying, in the UK, V over U vacancies over unemployment are now back to their pre-pandemic levels. So there is some effect playing already there. So what we can say with these two forces, the net impact on activity will be the result of this tug of war between demand and supply forces. As we saw in the UK and the euro area, it has resulted in stagnation. In the US, we're seeing a much more resilient and stronger economy. But what we can be sure is that restrictive monetary policy is pushing down on inflation and has been doing so. Yeah, I sort of, my graph for the UK inflation actually doesn't have the number for today, which just came down from 3.4% to 3.2%. So it crossed, so what are the challenges ahead? There is a concern or a reality that climate change and geopolitical tensions will lead to more frequent supply shocks in the form of shortages in energy or other critical inputs. Now, what I want to say here is that the solution to this crisis in energy or other commodity markets cannot be found in monetary policy. Monetary policy cannot offset the real effects of these shocks. The best it can do is return inflation to target, which it will do, I'm sure. But the solution to these shocks, these real shocks, needs to be found in a real prudential strategy that limits, prevents, and mitigates the exposure and impact of those risks. I see that strategy should involve at least three legs or pillars. First, more investment in technological diversification, to reduce exposure to substitutable critical inputs. We saw some examples of substitution during COVID and during the war in Ukraine, but more thought has to be put in anticipating a crisis like this. We need more investment on technological or input diversification, and then at scale. This is not just about the private sector or public sector, it can come from both. The second leg is increased trade diversification, particularly amongst countries with lower geopolitical risk. Diversification of both input suppliers and buyers reduces exposure to domestic shocks and shocks to specific trading partners. Over time, that diversification through trade should reduce volatility and has reduced volatility. That's what we found in work with co-authors. And this advocates against simplistic solutions such as reshoring to build resilience. Closing the economy increases exposure to domestic shocks, making economies more rather than less vulnerable. And the third, complementing these previous legs, I think economies will need to build or start thinking about building safe inventory bases to be prepared for shocks in critical supply of energy, water, and other critical inputs. Now, there are some clear parallels between the supply of critical inputs and the financial system. Cross-border linkages, concentration risk, complexity. Holding inventories is akin to holding liquidity buffers. And the logic of diversification suggests that it would be very risky to concentrate supply domestically or rely on weak links. So countries need to diversify both technologically and through trade. There's a lot of human capital in this building and in central banks, and that hopefully can be levered to address this conceptually similar challenge. But at the end of the day, the solution is not in monetary policy. It has to come from other tools, and these strategies need to be supplemented with fiscal policy as well once the shocks hit. So I think governments may eventually have to start running stress tests to make sure countries have the resilience and preparedness and the strategies to deal with major shocks on the climate or geopolitical front. I'll pause here. Thank you.
At the outset, I'd like each of you to take just a minute or two to comment, if you like, on the presentations from the other panelists. So, Olivier, why don't we go back to you?
Good. I don't think we fully agree. What's interesting is that actually I had James' view ex ante. So in 2021, I wrote something saying fiscal is insane, there is going to be inflation. And I got many points for that, except that the reason I thought this would happen was basically that it would increase aggregate demand, would lead to very low unemployment, would put pressure on wages. It was very much a conventional Phillips curve type story. So I had the prediction correct, but the mechanism not. And I think James suffers from the same shortcoming. Sometimes people change their mind, especially when they do econometrics. So this was my prior, and then when I did the econometrics, it came out the way I showed you, which is that we couldn't get in any country much effect of V over U. The increase in inflation was largely, as Bill said at the beginning, a global thing, not the fiscal policy, US fiscal policy thing. So my conclusion is that I was wrong, and that anybody who still thinks that is wrong, and that it was a price story. It didn't have much to do with monetary policy. I don't think that monetary policy changed very much the price of energy in Europe. I don't think it changed very much the price of food. There are cases in which it may have had an effect, and when monetary policy affects the exchange rate and you import food, then you get large food price effects, which is exactly what happened in Japan. It's very striking. I didn't have time to show it to you, but when you actually look at the decomposition for Japan, you find that the food shocks are much more important than the energy shocks. And that's largely due to the fact that they import a lot and they had a large yen depreciation. So, no, I think that monetary policy played very little role. Not the reproach, but I think that's the reality. I don't think the decrease in inflation had much to do with a change in monetary policy. I don't think it was wrong for the Fed to wait because it thought that it was supply shocks which would go away. So team transitory was right conceptually, except that they did not anticipate the number of shocks which kept coming. So I think the up and the down really had very little to do with monetary policy. I will leave it at that, and I'm sure that James will fully agree with me.
Okay. Thanks very much. So both my colleagues here put a lot of weight on sort of supply shock story, a kind of transitory story. So I would challenge them to say, you know, would you really have been comfortable not raising the policy rate, let's say, at all or very little during this era, and what do you think would have happened? I think that expectations about inflation in the US would have broken down, and I would just refresh people's memory about the summer of 2022. So at that point, the Democrats were still in control of all three parts of the government here in the US, and you had the liberal wing headed by Senator Sanders, you know, really saying they wanted to have another bill, and it was going to be very, very substantial. And so, you know, you had a lot more prospect of fiscal deficit spending, and on a grand scale, not just a little bit, but on a grand scale. And you had the central bank not really having moved at that point. So I think it's credible to say that, you know, markets had reason to doubt, global financial markets had reason to doubt. They're probably not, it's not that it broke down completely the way it has in some other countries around the world, but it, you know, it did raise question marks over people's heads about, you know, what's going on and what's the real prospect in the U.S. Now that all changed around, maybe by luck, but you know, you ended up with divided government after the midterm elections, and you ended up with a very aggressive Fed that really wanted to get inflation under control. So I think this changed the story around, and my picture about inflation expectations said that this brought inflation expectations back into consistency with the 2% inflation target. Even though inflation was still high at that point, it started to come down. So I think, you know, when you say V over U had very little, by the way, I love V over U, and I think that's a great measure, so kudos on that. But that's saying that the inflation didn't have much to do with the Phillips curve, and I've been a critic of the Phillips curve because I just don't think those effects are quantitatively big anyway, even in normal times. It would be very hard to get big quantitative effects from Phillips curve type things for this episode. So I think you have to have some other explanation. And I don't think it's very satisfactory, sort of scientifically speaking, to say, well, my main theory doesn't work, my Phillips curve theory doesn't work, therefore everything was in the shocks. Because that's kind of like saying, well, I don't really know, you know, where the inflation comes from. I don't really have much of a theory of inflation. And it doesn't have to do with my main theory, which only has small effects on inflation. As to the question about why was the inflation global if it's U.S. fiscal policy, but the pandemic was global, and different countries reacted differently, but they all reacted in some way, or most of them reacted in some way. You know, the ones that are a little harder to fathom might be Japan and China, and I'd be open to thinking about that, but certainly Europe and the U.S., other parts around the world all had a fiscal response to inflation, and all had monetary authorities that wanted to keep interest rates low to help with the fight against the pandemic. So I've already said what I wanted to say. You know, would you guys actually advocate that we didn't need to raise the policy rate and we would have had inflation come back to exactly where it is today?
No. No, and I obviously voted for this one.
There you go.
Yeah, okay, sorry. Yes, so I mean, I think there was a case for raising rates to a restrictive level in order to offset risks of second round effects, and that was certainly the case for the UK economy, where we saw wages responding, and so there was. I think the question that Olivier is raising is how restrictive you want to go, and that's the quantitative question to address. But yeah, before we started raising rates, they were at the stance was not restrictive, so there was a case to at least going back to neutral, and I would say over that, given the risk of second round effects, both backward and forward looking. But again, yeah, the question is, as always, quantitative and what were the risks at different stage. I disagree that, the behind the curve mattered too much, in the sense that, when you do the counterfactuals and I did those ad infinitum, when you start raising rates a few months earlier, you can shave a little bit of the peak, but in the end, it's not really much, because most of it is driven, as Olivier said, by these price shocks that then unwind. And the risk is, if you do too much, is that you end up undershooting later on and causing an unnecessary contraction in the economy that was not needed. I think on your comment on the Phillips curve, my sense is that, first of all, that the Phillips curve is well and alive, and there's the usual slope to it, and we saw some papers on that during the conference. But I think, and you complain about, attributing it to shocks, but in this case, these are not abstract shocks that we are not observing. We are seeing the increasing energy prices. We're seeing the increasing timber prices, and so on. So this is not something that is kind of invented, or it's a clear shock that you need to fit into to the model, and it's a shift in your Phillips curve rather than a movement along your Phillips curve. I'll probably just say one more thing about the Taylor rule, because I'm uneasy about using a Taylor rule for rare events like these, and it does matter where the origin of the shock here, and the Taylor rule should take that into account. To me, the Taylor rule is thinking about using the same Taylor rule for normal times and these rare events is a bit of a stretch.
Can I come back and make a constructive?
Briefly, yes.
I had to have an excuse. No, but I think this issue is, it's true that the way we were trained long ago was to think that aggregate demand would affect the labor market would affect wages would affect, but maybe this is too restrictive, in the sense that maybe it also affects directly the goods market. The firms are unable to produce as much at the same cost, so there is price pressure independent of wage pressure. And if you just look at the overview, you may miss that. So here, I can give an econometric answer, which is in the price equation. Once we control for wage inflation, productivity growth, the energy price, the food price, and the shortages, there was no residual left. And I think that's where you would have seen it, which is that you would have seen that prices were going up more than could be explained by wages, energy prices, food prices. But I think and the point that I accept is that maybe thinking that everything from the pressure, from demand pressure, has to go through the other U is probably too strong. And one should explore more.
Okay, I'd like to, since we're running very long, I'd like to at least have some time for questions from the floor. So let's do that. Please, two things. State your name and your affiliation, and please be sure you actually have a question. Okay.
Anton Nakov, ECB. So some of you invoked large shocks for causing the inflation, and then the receding of these shocks for the disinflation.
Can you speak louder, because I'm more or less deaf?
So some of you invoked large shocks for causing the inflation, and the receding of these shocks for the disinflation. And I would like to challenge that, and not the fact that there were shocks, but the reaction to that. So, one would expect that when there are such large shocks, firms increase the frequency of price changes, like we've seen for example, evidence yesterday in Mark's presentation. And they don't have to wait for the Cavo ferry to come to start changing their prices. And this is precisely a time when prices are flexible, that monetary policy should be more aggressive in taming inflation. So, even more aggressive than a Taylor rule would prescribe. So if there's a metaphor that I can make is when, the iron is hot, is a good time to hit it if you want to change the shape. So,
Why don't we collect a couple of questions, and then you guys can discuss them, and I think then we'll be out of time. But maybe a couple of more. Yes, please.
Tommaso Monticelli, Bocconi University. So I have a observation on the monetary fiscal mix hypothesis that was put forward by Jim Bullard. So that story on the fiscal side especially sounds about right for the US in the run-up of inflation. So you had the government really literally putting money into people's pockets, and that shows up with such an enormous increase in the savings rate, also compounded by savings that happened during the pandemics. It's just that the fiscal story doesn't seem to play right in the coming down of inflation. So you mentioned a return of fiscal policy to orthodoxy, but in the U.S., but also in European countries, we don't see that. We didn't see that. So if you look at the fiscal primary balance in the U.S. remaining consistently in negative territory. So even if you embrace a fiscal theory of inflation, right, the elimination of the subsidies and the checks should not have been enough to define a return to fiscal orthodoxy. What the fiscal theory would have implied, would have requested a commitment, right, of running fiscal surpluses in the future. And even if the economy was running relatively hot, we didn't see any positive primary balance being run in the U.S. So my observation or question is whether we can really say that there was a return to fiscal orthodoxy in the U.S., but also in European countries where the EU fiscal rules had been abandoned, and the return to those is just happening very slowly and in a very clumsy way.
One more in the back, and then we'll turn to the panel, I think.
Francesco Zanetti from Oxford University. And I have a question that starts from what Olivier said, that the labor market probably wasn't really important on this occasion, but yet the labor market responded differently in the US and in Europe. And from what Silvana said, also the recovery was quite different. So I was wondering, maybe it wasn't important for monetary policy, but is there any still link between how the recovery played out and how the labor market reacted in the different jurisdictions? Thank you.
Okay, why don't we turn to the panel, and maybe this time we'll do it in reverse order. So, Silvana, you're up.
Yeah, so to Anton's question, I think that what you mentioned is, the likelihood that in this type of events, when you have very large shocks, the Phillips curve steepens and you have more flexibility in prices. And that makes total sense, but fast in the way up and fast in the way down, and that's what we have seen. This is the increase in these prices, but then the fast unwind, certainly in goods markets, and this is what Olivier captures in his work. So one aspect, and this addresses Francesco's point, in which I agree with Jim, is that demand through the fiscal stimulus played a larger role in U.S. inflation vis-a-vis UK or Europe. So that was a bigger impulse in demand and that gets reflected in these consumption figures that I showed. I mean, this is a quite stark contrast with a gap in consumption of 13 percentage points opening over this 3-year period.
President Bullard?
Yeah, I'm glad to hear I'm still president.
I can't hold myself. Say had it.
On the state-dependent pricing, yeah, I agree with that. And it was an overwhelming thing for the inflationary episode that, of course, as an FOMC member, you talk to all these people that are in all these different businesses, and they were just talking about how practically all they talked about was their pricing strategy and how they had to really speed up their pricing strategy. And some of them were talking about, you know, I put in a weekly meeting so that we were reviewing this every week and we were making sure, and then putting stipulations in contracts, all kinds of stuff. And so they would talk about, you know, I used to get this guaranteed for 6 months. Now I have it guaranteed for 7 days, or no guarantee at all, you know, and so on. So I think it really changes the pricing dynamic, and that's something that has been studied quite a bit, but I think this episode should provide us a lot of data about how that actually works and how that feeds into monetary policy. On Tommaso's comment about fiscal policy, the fiscal story sounding about right for the U.S. for the way up in inflation, but maybe not for the way down. But the San Francisco Fed picture that I tried to show showed that the personal saving component of the deficit spending you know, definitely faded over the last 2 years and now has completely gone away. So that component, if you think that's kind of the monetary component of what is going on. I mean, the fiscal policy does a lot of other things. You look at something like the CHIPS Act or infrastructure spending or something like that. Well, maybe that's improving longer term productivity in the U.S. economy. You should think about that differently as opposed to just the size of the deficit spending all by itself. So that's why I like that personal saving picture. And the longer-term fiscal outlook definitely does not look good for the U.S. Discipline does seem to have broken down. You do have divided government, which makes it seem like they won't spend as much as they would otherwise, but still does not look good. And then labor market in the U.S. versus Europe. The only comment I would say about that is that there's a lot of Europeans here, but my contacts in Europe said that, yeah, labor market's also tight, very tight in Europe by recent standards. Of course, it doesn't look the same as the U.S. market, but by European standards, you certainly had a lot of sort of declining unemployment, low, you know, high vacancies to unemployment and so on. So, but you guys have probably better picture on that than I do.
Okay, Olivier, I'll give you the last word.
Thank you. On staggering, I agree. I've always thought that the new Keynesian model, where it has only prices, it doesn't have wages, is putting much too much weight on staggering of prices. I think prices are adjusted all the time. The stickiness comes from wages, is my sense. But I agree with you that if firms are going to adjust prices every day, that's going to amplify and accelerate things. So I think it's more a remark about new Keynesian models with three equations. On fiscal, I mean, we all agree, fiscal is not under control. So let's leave it at that. On labor markets, there's a lot of interesting stuff. So first, VRU has gone up in all countries except Japan, I think, and Belgium. So clearly there has been something happening. But when you look deeper, there's this object called the beverage curve. And there's a difference. So one of the contributions of the paper is actually to construct a beverage curve for the 11 economies. And there's a dramatic difference between, on one side, the US and Canada, and all the other countries. The other countries continue to move on the old beverage curve. In the US and Canada, there was this enormous shift. Chris Waller said it would go away. I said it would not. Chris Waller was right. It has gone away, largely, and we don't understand this very large shift. And there's something there. The other remark I would make about Europe and the US is when COVID came, The US basically went for layoffs. Unemployment rate just exploded. Europe didn't. It went for partial employment. And we all thought this was great because it would keep the links. I think ex post, it is now clear that there is such an advantage to having done what Europe did. So I think there's a lot of things to look at. Some of them unexpected in a way, or different from at least my prior, and something to explore.
Thanks very much to our panelists. Let's thank our panelists and